shut everything off so that I turn. Hey, good morning out there. How y'all doing? A little bit of a Tesla analysis. Yeah, you guys get the Tesla updates or no? We're doing them, I think, 3 days a week. I'll have to check and make sure we're doing it. Like, we were running this shit so hot. We were running this shit so hot. On Friday, we had so much going on at the same time that they shut down, the computer shut down all of the USB ports. Not too bad for a Friday. Put this thing on here. Oh yeah, baby, let's do it. Good morning, good morning. How y'all doing up there? I actually lost my voice on Saturday. Friday and Saturday I lost my voice. Woo! Good morning out there. Happy new week. Hope you had a great weekend. Hope you had some time to breathe over the weekend. I know there was a lot of hot. Everyone was hot and bothered last week. So I hope you're able to get outside and touch some grass. I did. I tried to get out and get away and all that kind of stuff. Spend some time with the family and spend some time. I went out to dinner on Friday nights, and then Saturday went. My wife got very drunk on Friday night. We had a driver, so she doesn't normally drink, but she drank, and she was eating oysters and champers, and then in the beginning of the night, and then puking by the end of the night. She was not feeling well. She doesn't normally drink, and I was like, "Hey, have a taste of this, have a taste of that, taste of this, have a taste of that," and then we spent Sunday at the range teaching the younger ones how to shoot, and which is kind of an odd thing. We're coming into the open right now. We're going to switch over. I'm going to switch over real quick just so you can see what we're looking at here. Let me see if I can go to the opening bell position first. And we'll go over to the market brief in a moment. And Joe Donut just scared me. He was like, "Isn't the eclipse tomorrow?" And I'm like, "Oh, did I get the day wrong? I think it's today." I was led to believe that it's today this morning. I hope I don't have the date wrong. I'll find out here shortly. So just coming into this open here, I'm fascinated by this open for a few reasons. Yesterday, so I took the weekend off, right? Tried to decompress, get away, refresh myself. And as I looked at IWM and QQQ, they looked pretty rough. SPOOS didn't. SPOOS looked pretty good. I was like, SPOOS looks pretty good. Like, it can do its own thing right on its own. We'll take a look at Qs and IWM at some point this morning, too. So just on this open here, I'd really like to see some kind of a pullback here and maybe even a retest, possibly even to that low back there for a move up today, believe it or not. Now, I made some shit posting on Twitter this morning saying all-time highs. And I was shit posting. That's way up here. I was shit posting, but I'm really not in another way. People on Twitter were saying, "Why are you posting that?" I was posting it because I'm kind of I got two things here. I really don't care if they pin this until 12 or 1 o'clock, or if they pull it back and then we go up into this 523 or even higher today. But I was fascinated. Vol Wiz, Scott Murray, had brought up the CPI from February. And that's this right here. It's right here, February 12th. Now, it's not the same setup. But here's the 9th. I mean, this is the 9th right here. We get into the day before CPI and we just rip faces off. It was like nobody's business. You couldn't. I mean, imagine like the day before CPI, you're like, yeah, we're gonna roll this thing down. And it's gonna be a bloodbath, and they just ramped it all day long. Well, they didn't ramp it all day long. They ramped it till 12 p.m. to all-time highs. So to say we can't do that, there's a prior example of it happening. And today, I'm fascinated by it to see if they try to do it again today. Now, even if they don't, right around 12 this afternoon, all last week, matter of fact, earlier last week, up until I want to say Monday or Tuesday, gamma picture every day was kind of normal. You like know that it's going to change tomorrow or why it would change. But then traders were coming in, institutional traders are coming in and just unloading stock while loading up on short dated puts. Some of them were zeros, but some of them were like 1 or 2 dates. And not surprisingly, this morning I came in and put up the gamma, and I was like, here we go, another whacked out chart this morning. So they're looking, as a matter of fact, the put call ratio or the SPX net gamma, so the net of call gamma and put gamma last week was wild to watch. There was like no development puts, then there was tons of puts, but not huge gamma bars, like just small gamma bars. And now there's some saying it's vol control, it's this, it's that. But I'm with Scott on this. At this, unless something fundamentally changes, some professionals are coming in every day and they're slamming that put button. Not every day, but on every day we're up at 12 o'clock in the afternoon, just raining them down. And you know what it reminds me of too? It reminds me of when we came into the start of the bear market in 2022. I had never seen so many puts, 0 date puts. Even during COVID, I didn't see people were like loading up farther out in time, that kind of stuff. But specifically 2022, you just see them come in by the bucket loads and bucket loads. Now, when it was in that bear market, it wasn't at 12 in the afternoon. It was all day long, all day long, all day long, all day long. So anyways, that's what I want to see here is if there's any kind of pullback on the open and how high we can go. Now, if you read the market brief last night, I said to you, you just wait until this stuff resolves. That's the basic gist. We've got a bunch of data coming out this week. We've got taxes on the 15th. We've got banks setting the tone, I think, on the 12th. I don't know the exact dates off the top of my head right now, but there's a ton of volatility one way or another the rest of this week. CPI, it's like they set it up. You know, it's like, oh, it's year over year, where I think is right now, I think is 3.8, 3.9, something like that. We'll have to look at it, but the expectation is like 3.5 year over year. And I'm like, yeah, that's a pretty steep drop off for an expectation. So it seems like that's set up to some extent as well. So we are getting the pullback right now. We'll switch back, or we're going to switch over to a 1 minute chart here and see what's going on. Let's take a look and see what's happening. Coming back in to test the hourly trigger here. The close on Friday was right there, right where the half hour and right where the hourly trigger is the close on Friday. So we'll see if this holds up and continues to go higher or not. Oh, wait a minute here. Let's have this same area of interest that they keep coming back to. Came back to it this morning. That was that low from this morning. And that was also the low before the close on Friday. Pop that one in there. So I think I have, as of right now, I think I have to go to the Eclipse this morning with my kids. We're in the path, kind of. We're like right on the edge of the path. But then like a half an hour down the road, we are in the direct path of the Eclipse. So I got to do that today. Now that starts at, I believe, 1:48. So I was going to leave at like 12 and try to get out there and see what happens. So we'll see how this open starts, if the doom and gloom is going to come straight into the market early, or if we're going to bounce and see how high we can go. Now let's get over to the market brief really quick. Keep losing my... In one quick second. Sorry, I'm losing a monitor over here to the right-hand side. All right, so we all know about Yellen this morning. She was really nice to Z and everybody else over there, but she does want to protect the United States from cheap Chinese imports. We know that. I guess they respect her in China as well. This is the China deal back on again, China deal back off again. Hold on one second here. I got to buy another $100 in cables. Okay, so I'll get back to that in a minute. So she wants to stop Chinese imports coming into the United States, and we had problems with that back in the 2000s. Cheap Chinese steel, cheap Chinese products that destroyed. Well, I don't know if I'm in complete agreement with that. We like that stuff in this country. It helps this country to boom, believe it or not. But at any rate, now she's talking about she won't rule with possible tariffs on China green exports. That's all the EV tech, solar tech, all that kind of stuff. U.S. offers TSMC up to $6.6 billion for Arizona factories as Biden pushes for chip security. Jaime Dimon this morning says AI may be as impactful on humanity as printing press, electricity, and computers. I can't agree-ish with that. There's a lot of danger there. This morning, I want to quickly go over and just let you know that we had the EU bond auctions this morning, but then at 11 a.m., not so much of a big deal, but 11:30, excuse me. At 11:30, we've got the 3-month bill auction and the 6-month bill auction. You want to be aware of that. You guys already know about CPI coming out, and everybody's going to be watching CPI. It's the big to do, right? Let me go back over here. And that's on Wednesday. So I don't know if we can get there today, tomorrow, for CPI. If we can get to all-time highs, we have like 2 days to do it, and so either today, tomorrow. I'd like to see 523 today if possible, and then all-time highs by Tuesday if possible. Before we do CPI on Wednesday, we also have on Thursday we've got initial claims, produce PPI. Core PPI, blah, blah, all the PPI stuff as well on Thursday. And then on Friday, we get the import price index. We've got consumer sentiment as well. And then next week, we roll into a bunch more stuff. We've got Monday, U.S. retail sales. Tuesday, building permits. And then we've got the beige book on Wednesday. We got claims again on Thursday. So another big week ahead of us. Oh, we got Fed minutes too. Forgot about that. We've got Fed minutes. Where are the Fed minutes at? Right here. On Wednesday at 2 p.m., which is kind of a big one as well. So you got the Fed minutes, 2 p.m. on Wednesday. We've got CPI Wednesday as well. And so we got some big news coming out, big data. We roll right into, I want to say bank earnings are on the 12th. Could be wrong on that, but I think it's on the 12th, the bank earnings. So it's like boom, bank earnings, boom, tax season ends, pay all your bills, all that kind of stuff. I do think some of the tax stuff is probably done at this point. I don't think everyone's rushing out to pay their tax bill or take their money out of the stock market on the 15th exactly. So some of that stuff is probably waning at some point. We are bouncing right now on the hourly trigger. We'll see if we can head down all the way down and close out that 517 or not. So expectations for today, I posted on, I wanted to show you guys something here really quick. I did post this morning on Trade the Trigger this morning. Now, this handle here we're supposed to be using. We haven't been. But I did post about the SPX Gamma profile for this morning. And then here I posted this morning. SPY, there is a pullback risk at 520 as we come into the open to 516 for a trip to 523. Right now we're bouncing off the hourly trigger and not trading. I said 516, but it's 517. I should edit that to say 517. But at any rate, you get the gist. But 523 should be the target for SPY today, is my point. If you don't already follow that handle, it's at tradethetrigger.com. So if you want to see that stuff in the morning, that's the place to be catching it. What else? All right, so we've got all the news out of the way here. Let's go back over to, let me see here, main screen here. And bring some of this stuff up. Get rid of some of this stuff here. We'll take a look at the bottom right-hand side here. You got the nice little squeeze on IWM. I was expecting IWM to be a little bit more bearish this morning. It was looking very weak over the weekend. I wasn't expecting the squeeze off of them right away, but right down in here, looking for a dip to buy down below and something like this to the downside, but then a further move to the upside and closing all this stuff up here. So far, they're holding on just fine this morning, so we'll pay attention to IWM. QQQs, same thing. I was looking for one more down move over here, at least count-wise. Let me look at the Qs over here. One more down move in the Qs as well. And this been holding down here, so and they just blasted down right here. I'm not sure if we continue to go down, but it would not shock me to see us go down one more time, and then you get your move to the upside as well. So a little bit of weakness on Qs, a little bit of weakness on SPY. No weakness on IWM this morning. If they join the party, right? If they are able to join the party and not blood out, they don't start blooding out down here, like weakening SPY. But the idea here would be, if this is SPOOs right here, right, you'd have SPY kind of dogging, right, going up, but dogging at the same time while IWM and Qs pull their shit together, and then we can move higher. So we'll wait and see if they can join the party or not. If they can't join the party, down below here, be looking for a dip buy. As of right now, we are bouncing off the hourly trigger. Still bullish on SPY. We'd like to see SPY get above the 1 minute trigger, like right about here, and get a new high right here. Would be nice. A nice start to the day would be right there. We didn't actually tag 520, did we? So that would be your next tag right above. Oh, we did. We kind of tagged it. So kind of right there. Right there. Crude this morning blasting off. Silver, another point here on silver. So silver came in at 28 bucks. That was the price target above here. They tagged it almost perfectly. I never like seeing silver or gold. Every time I see these big tweezer reversal bars on gold or silver, I'm like, yeah, that shit's going down for a little while. And I'm going to expect the same here with silver, some kind of a pullback. Every time I see that, it's like, it's only on metals for some reason that I see it. But anyways, on silver, would like to see it at least pull back to its hourly trigger, if not a retrace. I'd prefer the retrace to go back down here, minimum 27 bucks. We'll take a peek at it, see if it gets to some consolidating. NVDA, look at this, blooded it straight down. It was looking great, right? Blooded it straight down off the opening bell, blasting straight down right here. It had a great morning. It was looking beautiful, and they're just pulling it back right now. Let me clear that out right there. CL looking great right now. Bitcoin getting up to $72,000. Got a price target on this of 80,000. I do warn you guys out there with all the crypto bros telling you 84,000 that you're likely going to be a bag holder up there at that 84,000. Dixie this morning getting blooded to the downside. We'll see if that bounces and ricochets to the upside. SPY recovering on that bloodletting on Dixie. TNX looking strong right now. Don't forget we've got bill auctions later on. IWM just kind of putting it around. GCT coming. They had a nice tag down here on their daily trigger. I'd like to see if I can jump on this. I've been wanting to buy this GCT and I haven't had the chance. They're trading 32.56. I'd like to buy 28 bucks if possible. So I'm still monitoring GCT. I want to get on this trade and hold this for the year if possible. SPX. Let's take a look at SPX this morning. Let's take a peek at this. Oh, hold on. Sorry about that. SPX. Today's gamma, a little bit different than usual, right? We actually lost a bunch of this gamma that developed down below last week. That was from all those short-dated puts. Those are all gone, which means they're likely going to come back in and put them in again today. And we had 5,400. The gamma from 5,400 was came off last week, and it's back on again to the upside. So we want to get above. We really want to get above. This is by the dip down here. We are still in volatility. We really want to get above this. It's really important. This local resistance to get above it. We have not been able to as of yet. We've been told no once, twice, 3 times. You only get so many chances here. Can't be like, hey, yeah, we're going up here. We're going to trade 5,300, and yet, you don't get 5, 6, 7, 8 tries. You can. I shouldn't say you don't. There's a reason we're banging on that door. And we have prior examples of that as well. If you want to see the last prior example of this, I believe it was the last couple I showed you. Let's take a look at 1 or 2 of them here. Let's see if we can take a look at SPY and a daily chart. Try to show you guys these. Last time we did something like that was right over here. And we just banged around over here. But there's a little bit of a difference here, too. Talking about 1, 2, 3, 4th time's the charm. And we're kind of getting there right now. It's kind of wonky over here, right? It's like 1, 2, 3. And this is kind of your last chance here. You don't really get more than, I'll give you 4 chances. I'll give you 4 chances to get up there. But like 5, 6, 7, 8, I'm like, nah. And they haven't really done it. We haven't done it in the overnight, right? Haven't done it in the overnight once. So nobody's put us up there at this point. Although it looks like the same stuff, right? Here, let's go look. It all looks the same. When I look at the PPOs, PMOs, market breadth. But the thing about market breadth is market breadth can be up for 1 day. Like it's going to recover and rotations happening. And you come back like 2 days later, boom, we're blasting straight to the depths of hell. So I put more quality into PPOs and PMOs. And those look great. They're pulling back nice and low. We haven't had big price moves to the downside. So I still have some faith in PPOs and PMOs saying, don't expect it to be as bad as you might think it's going to be. Just right in here on this daily basis here. Grind, push, all that pushing to get up here. And then it's bam, down, bam, down, bam, down. And where are we going, right? You can tell that that they want to move it higher. So, and how high is that? All right. How is it 530? Is it just a new high? From my perspective, it's a new high, but it's also a new low. Like boom, high, low, and then 550 above. 550, 560. Now I know a lot of you out there are paying attention to people that are pushing their own ohm, right? They're telling you that this is the high. They're telling you that you might get another 3% out of the market this year. If you look at statistically, that's not true. Statistically, for the move that we made this year, we should see another 7 to 13% on average, somewhere in there. Sometimes even more. We rarely do red for the rest of the year at this point in the year. Now, I do realize what people are telling you. I do realize that the ohm pushing, what it really how it really impacts right now is I was asking earlier in October and December, like, what do you do? How do you create volatility? Like, what are you going to come up with? You need a story, right? If everything is honky dory and peachy, what's the story? So I noticed that there's a huge, like, it's almost like the hey, we're gonna cut 13 times this year. So then, like, the trade is enacted, right? And then of course we know that we're not gonna cut that many times, but it doesn't matter. They're gonna trade it, right? And then all of a sudden it's like, oh no, now they're not gonna cut at all this year, getting zero cuts, right? And it's like, okay, let's take that trade. And then all of a sudden, I'm like, are they going to switch the story? How many times are we going to switch these stories this year? And just to trade it. It doesn't really matter if it happens, doesn't happen. It's more to create a story and a reason to go up and down, for the market to go up and down. Now, part of this still does have to do with the range expansion that we were discussing last week, that people don't like going straight up. They don't like it. They don't like trading all-time highs. They like a nice, beautiful pullback, so that they can put their money in the market, and then they can let it run, and they make, 5%, 10%. They take all their money out of the market. They get a nice little pullback. We're racing as high as we are, like bam, 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 higher and higher and higher. You can't participate, right? Can't sell it. Can't buy it. I feel like you're left behind, and that roar is loud, loud, loud right now. And then also the politics, political events. You got an election. We got people trying to create shit with Iran. You've got like all this like noise, just like lots and lots and lots and lots of noise. It can't be easy to have your laptops open right now. There's no possible way. I don't know what to read right now. I read not so much this past week, but last week, early week. I read every single argument they threw the kitchen sink at the wall. It was like, fuck it, tell them that this is bad. Tell them if the opposite happens, that's even worse. Tell them if I don't know, the third choice comes out that's worse than the first two bad choices. Whatever it is, bad. Everything is bad. Like bad, bad, bad. Doesn't matter what you have to say. Hang tight on me. And so I can see how you're left, or even myself being left, saying, "What the fuck is this? And what the fuck is that? Like, what does all this stuff actually mean?" And what it really looks like is just pushing a narrative. Need to push a narrative, right? Need silver to go to $28. Need Bitcoin to go to $80,000. This is gas. Gas is in season. Make the story to get gas where it needs to go. Or this is the end of seasonality for a sector, and I want to get my last pay out of it. It's really that simple sometimes, or at least as a cash market trader, it seems like it's that easy sometimes. It's not. It doesn't have to be rocket science. It can be as simple as every year I work down at my local office, and every year I buy XLP at this time of the year, and I'm going to pump it. And then whenever the XLP season is over, I'm going to pump it right towards the end of it just to get the last payoff that I want to get on it, right? That kind of stuff. So, anyways, today's Monday. We've got one more day, and then we've got CPI, and we've got Fed minutes. We'll see if they can ramp it up or not, if they can crank this bad boy up into Tuesday close. What else do we got for you this morning? I think that's it. Let me see if I got anything else over here. Gamma this morning. Let's take a look at. I'll take a look at the at the money volatility curve. See if we're expecting any vol here, and we've got vol coming in until the 10th, and then volatility starts to blow off from there. So right around the 10th, 11th, I can show you this. Current volatility is cranking right now. You can see it right there. It's expected to blow off on the 10th. I believe that is on the Fed minutes release on CPI. Then it should push down and off into the 24th. So if you're looking for a downside move if you're looking for any kind of volatility, it should end once we get to, no, wait a minute. Sorry about that. Hit the wrong button. should end as we get into Wednesday's news and start to cook off from that point. I'm also going to take a peek here at the SPX CTA positioning. This is cause for concern. I'm going to want to show you guys this. Let me go back over here again really quick. Now, not necessarily. Let me see if I can bring this down a little bit. There we go. Hold on here. I bring that over a little bit like that and bring this over for you right here. There you go. Whoop. Hold on here. Okay, so now not necessarily it's cause for concern. But it's not sell the world yet, right? We had some pullback over here. You get some more pullback over here. We still have not lost CTAs being long. Now, if they do begin to sell down here, right, there is cause for concern. And I want to show you what that looks like here. These are professional investors that are trend followers. That's the basic gist. And they're a little bit weak right now, right? You can see that, a little bit of weakness, but we still haven't lost this. So what I want to show you here is this. How do I show you this really quick? Let me go to trigger screen. If we begin to lose, go a 30-minute maybe. I'm going to go to the 1 day. That's better to go to. If we begin to lose the market, right? If we begin to lose the market, we have an actual correction, right? Which everybody wants. I think even myself would like a correction. I don't think anyone out there doesn't want a correction. But we can say whatever we want that doesn't make it so, right? We start doing this shit. We start cranking higher. Or we just do range expansion. That's not really it's correction, but it really isn't, is it? I don't think this is what the bears have in mind, right? I don't think they have in mind this range expansion. You know what kind of correction they want. So if CTAs do sell, they tend to sell like this over here. Start ripping and blasting down. This is back in October. Or excuse me, July, sorry. Here's September right here. But then October right here, they started selling. We got this like really big, like down move. Sorry, I should rephrase that. They started selling, CTA started selling back here in July. But then they started selling here and here, all the way down into October, I believe 12th or something like that, is when they started rebuying again. Now, we haven't started this yet. And there are some key levels that need to hold for this not to happen. But right now, guess what is weak? The weekly trigger is weak. It's max bullish right now. You can actually see it right here. Weekly trigger is max bullish. Now, the monthly trigger is just getting started. So that should hold just fine. And the daily trigger is losing velocity right now. So any of this stuff right here, now, we're currently kind of sitting right here, right? And this is what they want to do with CPI, right? Blast it down, give you a breather so you can exit the market, and then we blast down to the weekly trigger, and then we blast down to this monthly trigger. Now, let's take a look at that over here and see what that means. So just over here, is anyone expecting us to trade 430? No. I don't think anybody is. You might, like Chase might be, but nobody really is. So this down here is strong. I'm going to show you this right now, what I mean by this. So, or at least and bring some of this down here for you. We have a series of new lows in velocity on the daily trigger. You see that? That's cause for concern for me, at least. We're topping out here on weekly trigger. That's cause for concern for me because it means the weekly trigger possibly won't hold. But the monthly trigger looks great. This is the start of accumulation. And this is also saying to expect more accumulation. We have a lot more to go. A lot more up to go. Let me show you an example of that too. Which is right up in here. You can see that, right? This monthly accumulation all the way up, all the way up, all the way up. And we haven't done that yet, have we? Now, timing this is a different beast. We can easily, look at how small this chart looks now, right? We can easily go up here and trade 530 like it's nobody's business, right? Come back down to 5,000. Right here, trade 550. I know you're like, there's no way, Cap. But then blast down to this, wherever this monthly would be, like right somewhere in here. Right? So you have this whole election season nonsense, or election. You have all this earnings season nonsense, right? You end up trading all of earnings season. As you come out of earnings season with all the big heavies reporting, then we start blasting down, and you catch yourself a nice dip buy for early summer, grind higher. And then we get that bloodbath into late summer down here. This would be your election volatility. And they turn around into fall for a run that lasts into possibly March. And that December, March run should take you to the 6,000 that everybody's looking for. So just right now, my point behind this is inconsequential to velocity here rolling over. You could easily see weekly go higher. You easily see one or two more rips on the daily trigger or daily velocity, and then still hold the monthly the entire time. And the monthly's like, yeah, fuck you, we're getting that, and we're going higher, right? So you get that higher on monthly velocity, and you get that nice pullback for the velocity for the election season. So as of right now, this looks just like range expansion, not so much doom and gloom, although I'm sure that if you're staring at a 1 minute chart, or you're staring at a 1 hour chart, or if you're staring at a 1 hour chart, or a 4 hour chart, a day chart, you're going to look back and say, oh, yeah, we went there, but it took 3 months for us to get there, or a month to get there, or whatever it is. Just not in the next 15 minutes. If that makes any sense. All right, so that's all I've got for you on market update for this morning. We didn't get any of this. They told you no, fuck you. We're going to turn it around. Maybe I'll get that 517 down below. 516. We'll see if I can catch it or not. What else do I got for you? I think that's it from my side. It's 10:04 in the morning. I'm going to take a quick break, get some coffee and some water. One thing that did happen last week was I ended up losing my voice. Every weekend I'm losing my voice on by like Wednesday, Thursday, and then by Friday it's gone. This Friday when I got off the stream, I couldn't speak for 2 straight days. I didn't speak until Sunday. I don't want to lose my voice anymore, so I'm going to take a quick break right now as the market's still opening up. See what happens here. See if we can get that pullback from the market brief last night or not. And still looking for an upside move into CPI on Wednesday. Give me like a few minutes. I'll be right back with you guys in just a moment.
More offensive than last week when the operative term was coercive moves.
No, and she was very clear that she does not want to see decoupling, and she welcomed American investment in China. And to your point about the brewery, it was her last stop tonight, actually, of the whole 4-day tour. And she went to a Chinese brewery that imports American hops. So it was a good example of how American businesses can export to China. So she was here to welcome the trade relationship, said it's one of the most important bilateral relationships out there, but when they have disagreements on things like overcapacity, IP protections, as they have in the past, she wants to make sure the communication lines are open. And I think that's where the most progress has come from with her as Treasury Secretary. The communication lines have been open, and that's why she said this afternoon that undeniably the relationship is in a better place than it was a year ago. The bigger question, though, David and Carl, is what happens after the election, right? I mean, I did ask her about President Trump and where that relationship would be if he gets reelected in a year. She obviously wouldn't comment on that, but he's threatened 60% tariffs. The Chinese are still worried about the tariffs that he put in place last time that the Biden administration has kept in place, and she said that was raised in the meetings.
Yeah, well, yeah, former President Trump, certainly an issue. Finally, Sarah, I know you had a chance to look at some EVs. We saw a video of it earlier, but I'm curious as to your own personal take on it. I mean, was the quality, equal to what you're accustomed to? I'm just sort of want to get your ratings here, so to speak, on these Chinese EVs.
I thought they were beautiful, actually. We were very impressed with the EVs. There's this one called Avatar that my producer, Donna Burton, was in love with and wishes she could get at home, especially the ones that were SUVs. They're sleek, they're polished, as I mentioned, a lot of them, there's the Neos and the BYDs, but a lot of them are actually collaborations with some of the Chinese tech companies like Huawei or Baidu themselves, which make them feel very high tech. I went into one that was a collaboration between Baidu and Geely, the Chinese automaker. It's said to be self-driving, but you still need a driver in the car. Although I definitely wouldn't feel safe driving it here in Beijing because they are more aggressive and crazier drivers than even in New York City. It's very, very crowded here, and it was a lot. But the cars they looked great, and I'm sure a lot of Americans would be happy. By the way, that Geely Baidu car that was an SUV self-driving, the basic starting price is $30,000. So you can see why American manufacturers are concerned about it.
Yeah, without a doubt, and it's something we're going to be discussing for quite some time to come. Sarah, we'll check in with you again a little bit more. Of course, get a lot more from Beijing from Sarah Eisen. Let's get to the broader markets right now, though. Our next guest says the market is priced to perfection and is taking everything in stride. And Taiwan Semiconductor Manufacturing, by the way, one of his top holdings, or at least the fund's top holdings. We're talking about Chris Ailman, California State Teachers Retirement Systems, CalSTR's Chief Investment Officer. He joins us now. CalSTRS has, by the way, $331 billion in assets under management. It is the largest educator-only pension fund in the world. All right, we got all that out of the way. So why do you sound, Chris, like you're a little, I don't want to call it pessimistic, but perhaps not as constructive on the market as some of the parade of guests we might bring on here on CNBC?
Hey, David, I would say I'm realistic. Come on. This market is doing so well. Think about the fact that at the Fed pivot back in November, they were expecting 6 cuts this year, then only 3. Now some talk about maybe not even any. Market's taken that all completely in stride, set new highs. Now, so I like this market, but it doesn't mean it's going to grow to the moon. And I think that's what people have to realize.
Yeah, which means what? In terms of if you had to sort of predict as how things will go for the rest of the year, are we kind of done with the big appreciation, given the fact that, to your point, we may no longer get those rate cuts that had been assumed or almost assured at the beginning of the year?
You know, David, I realize now in my career, it is so hard to predict the future. I think the market probably has some.
By the way,
look,
NASDAQ looking gorgeous right now.
And it's unknown what that's going to add to productivity. I mean, Jamie Dimon had a big statement today in his letter. So there's a lot of optimism. But look back, over time, you're a market pro. The market can have a pullback of 10, even 15.
Dude, do you guys have your,
So I think people have to just realize.
Do you guys have your
straight up new high after new high? We're going to have some seesaw.
Do you guys have your things for today?
Pullback. It's interesting. Everybody comes in buying every time there's a pullback.
So
Do you guys have your Eclipse goggles for today or no?
Growth,
Let me know if you got your Eclipse goggles for today. You guys ready to rock and roll or what?
I mean, do you stay? Is your closeness to quality?
I got mine.
Even from here?
Carl, I'm surprised by the lack of volatility. We don't have that many 2% days. Normally, we've got quite a few of those during a year, at least 20, and we haven't had those. It's been this slow grind higher in the market. So it's going to be a combination. I think the Fed should back.
You got clouds there? So we were supposed to have clouds, and we don't.
About what
the clouds blew off this morning. We didn't get any. They said we were going to get clouded out, but then I woke up this morning like clouds just parted.
Through the election, 2025, all bets are off. I don't know what that year is going to look like.
Yeah, well, as you point out, it's going to be
Yeah, I'm still in calls from Friday. I haven't sold them yet. I'm waiting for 423. Maybe all-time highs by Tuesday. Today, tomorrow, somewhere. Today, tomorrow, I don't know. I want to see us get ramped up. I think we ramp. I'll be honest with you guys. If we're going to go down on CPI, I think they're going to squeeze us higher.
I think comments about having Einstein on your phone, and that is great. So we're all going to make better decisions. We've got to ask better questions, but it doesn't mean that everyone's going to be using it. And oh, by the way, every once in a while, it gives you a mistake and a problem. So it's going to make us better. It's going to make us more efficient. It is, I don't know if it's as big as the steam engine, but it is a major advance, probably as much as the iPhone. So we'll see, but it's going to take time to roll out.
I think 523 is minimum, but I would not be shocked if we saw all-time highs.
It's been a whole year since.
You just got to make sure IWM gets on board. QQQs get on board. I'm bullish here. If you don't know, I'm bullish. I'm not in bear camp. If they pin us until CPI, they start throwing the puts on at 1 p.m. today, 1 p.m. tomorrow, that kind of shit. Yeah, I'd be like, yeah, maybe not, but I really don't care either. If we're at all-time highs or 523 and those people come out to play, I'll just close shop and run it with them.
Now you actually can get a spread. Corporates are super tight, but there's private lending. I'm seeing a lot.
I kind of think price matters into. I think, or not price. I don't think price. I don't think price matters. I think they're going to come out and try to sell this market today at 1. I think they're going to try to sell it tomorrow at 1. So wherever price is,
put all your eggs
won't matter to me whether we're at all-time highs, 523, we're trading 518. They're gonna come out and try to set this shit up at like 1 o'clock in the afternoon both days, leading into CPI.
Sense that maybe we get rate cuts there before we get them here. Are you sensing that?
I'm as surprised as anybody. You know, Carl, it is amazing, but Europe and non-U.S. stocks are setting highs. Not as fast as the U.S. market. The growth rates aren't quite there. But, you know, maybe Japan is finally going to come out of its doldrums for 30 years and turn it around. And yes, we're seeing strength out of Germany and out of parts of Northern Europe. So the global economy is doing okay. And that's a good sign. That means diversification, which we're very diverse around the world. We're getting some benefits of that. We'll see if I don't think it can outpace the U.S. I would be surprised at that. I think our Fed does a better job. But, you know, hey, we got a problem with our deficits, and that's not going to go away. So we've got a big anchor we're dragging around in our economy. And so there are going to be opportunities around the world.
You know, I actually, let me end it there, though, on that concern you just raised about our deficits. Are we going to revisit that, you think, in terms of interest payments and having an auction that fails? I'm just curious, given you mentioned it, Chris, where your sort of head's at on that.
You know, David, I think that is going to be the exact point. I've been telling my board to pay attention to the tail on Treasury auctions. I know it's esoteric for a lot of people, but right now we're fine. There's still an appetite for our debt. But boy, as you get into 2025, U.S. debt is going to be, the interest payment on U.S. debt is going to be such a drag on the deficit and on the budget that it's going to slow our economy. We can't run around with this much weight. And, you know, I'll use the phrase, the U.S. budget can use Ozempic, but it's not going to turn it around and it's not going to lose weight as fast as other people do. So they really need to focus on it. It's going to be a drag for whoever is the president next year. It is going to really be an issue going over the next 4 years. Just like climate change, I think those mega trends are working against us, not for us.
All right, to be continued, Chris. Always appreciate it. Thank you.
Thank you.
As we go to break, 30 minutes into trading, some of the movers we're watching today. Tesla shares rebounding from last week's big sell-off. News of a robo-taxi debut in August. Morgan Stanley does reiterate an overweight today. Taiwan Semi moving higher. The Biden White House giving the company up to $6.6 billion to build out its plant in Arizona. A lot more on the other chip names to watch here. And then watch Boeing and Southwest today. This engine cowling fell off a plane during takeoff this weekend. FAA is looking into that. We'll get the latest as Squawk on the Street is back in a moment.
So looking now to the fear and greed index, 62 out of 100, which indicates greed, while the crypto fear and greed index is at 76 out of 100, which indicates extreme greed.
It's another ugly headline for Boeing this weekend after one of Southwest 737s lost its engine cover, this after takeoff. Phil LeBeau joins us. He's got that story, and it may not be Boeing's fault, I guess, Phil, although that doesn't seem to necessarily always matter in these things.
No, right now people have Boeing in the crosshairs. Frankly, they've got the airlines in the crosshairs in terms of concerns about maintenance and whether or not, as we see more flights added, the maintenance of the aircraft are up to snuff. And those concerns fueled by this video out of Denver International Airport yesterday where there was a Southwest plane. This video is scary for anybody who was on this flight. As it's taking off, the engine cowling, the covering on the engine ripped off. Now, there was not an incident in terms of, it was an incident where there was nobody injured. The plane safely returned back to the airport. But look, understandably, you see this, you sit there and say, what is going on here? In terms of this cowling incident, Southwest, we've reached out to them. The maintenance team there is now investigating this incident, as is the FAA, which they do with all of these types of incidents. The plane, by the way, was delivered in 2015. Why is that important? Yes, it's a Boeing 737, but it's not a MAX model. And this has been in the Southwest fleet for 9 years. 9 years. So it's a maintenance issue. Boeing and GE will assist in the investigation as Southwest looks into what might have happened here. As you take a look at shares of Southwest, remember that the airline posts results on April 25th. No doubt this will be one of the questions we have for Bob Jordan, not just about this incident, but overall aircraft and airline maintenance and the issues that have been front and center over the last 6 months to last year. And then as you take a look at shares of Boeing, keep in mind that tomorrow we will get Boeing's orders and deliveries not only for March, but for all of the first quarter, and then we can extrapolate that in terms of what we might see for the full year. That's really what's moving the Boeing shares today, David, because when you look at the concern about manufacturing at Boeing, the question is, will they have to slow down production as they did in the first quarter for the rest of this year? We'll get some indication based on the numbers that we see tomorrow.
Yeah, some of the anecdotal reporting suggests that production has really slowed to a crawl, Phil. Important news. That's our Phil LeBeau on Boeing today. Still to come, a big week for the Fed and the economy, as you know, including Fed minutes and, of course, key inflation data. We'll get you ready for that. Is the AI narrative breaking down? Apollo's chief economist, Torsten Slok, will talk about what the numbers may be telling us after the break.
to learn more.
Welcome back to Squawk on the Street, a make or break week for markets with a host of Fed speak on the agenda, as well as Fed minutes, and of course CPI and PPI inflation data. Apollo Global Management's chief economist Torsten Slok joins us this morning. Torsten, your chart of the Mag 7 turned into the Fab 4, just showing the splintering of the basket in recent quarters, got a lot of attention this week. I wonder what you think that says about the AI environment right now.
That's a very important question, Carl, because I think that last year and for quite some time, it was really simple. And the market loves simple stories. It was all about the Magnificent Seven. You don't need to do your homework. Everything will go up because the Magnificent Seven are all fine. Well, now guess what? Looking at it today, exactly as you're saying, you have, of course, Tesla down. You also have Apple. You also have, of course, some fairly significant developments when it comes to Alphabet. On the other side, you still have NVIDIA up. You have Meta up. It has just become a lot more nuanced. So the bottom line, Carl, to your question really is that there are some very important developments that you just simply cannot escape. You have to do your homework. You have to figure out what of these companies are actually benefiting going forward. And is it just one AI story, or is it really actually much more complicated than that?
Do you think it cooperates with the vision that the market is digesting this narrative, processing information, and broadening to other sectors, which, of course, bulls have been waiting for forever?
Yeah, I do think so, and I think it's important that this is spreading to other sectors because now there is more nuance in what sectors, what industries are actually benefiting and what other industries are not. But that's very important because it used to be the case in 2022. It was all about rates and inflation. And now suddenly homework has come back. Doing your homework and figuring out what should my stock picking be? What should my credit selection be? That's both in public markets and in private markets turns out to be really, really important. So therefore fundamentals, yes, we can debate, and as you and I do often, what the discussion is about inflation, the Fed, and unemployment, and so on. But really, at the end of the day, for individual names, you have to look at it from a bottom-up perspective. Who are the winners? Who are the losers? And it just turns out to be a lot more complicated than just simply buying the Magnificent Seven.
Commodities, obviously, Torsten, moving to the front of the conversations given the events in the Middle East. People starting to worry what kind of pressure that's going to put at least on headline inflation readings. Do you think it's the most important story right now?
Well, I think that if you combine that with what we saw last week when we saw ISM prices paid for manufacturing, the fact that manufacturing is beginning to recover and beginning to show some more upward momentum, including on prices paid, it does suggest that maybe goods inflation, which, of course, as you know, went up first a lot, and then it came down to more normal. Now the fear you can have is that maybe it's beginning to reaccelerate exactly because of geopolitical risks and also because of the manufacturing sector coming back. Combining that with both shelter inflation and supercore inflation also showing some more signs of life, you do begin to worry about the Fed here that this repricing of rates, I think, is very important because it is telling you that we've been waiting for this slowdown for so long. Why is it everyone is expecting this slowdown to come in the next several quarters, in particular with the tailwind of the stock market up $10 trillion since the November FOMC meeting? We have a dramatic tailwind to consumption and to capex over the coming quarters that will continue to support inflation to the upside.
All right. Torsten, way to make a splash with some of the graphics lately. It's good to see you. Torsten Slok joining us from Apollo.
Thank you.
After the break, Treasury Secretary Janet Yellen. Let's get to Sarah in Beijing with more on what she has ahead for us. Sarah.
David, you heard a lot about how she was concerned about overcapacity. The Treasury Secretary also had a pretty stark warning for China as it relates to supporting Russia in its war against Ukraine. You'll hear from her on that and also what she spoke about regarding TikTok and that legislation moving through Congress with Chinese officials. When we come right back here live from Beijing on Squawk on the Street.
All right, we're going to do Tesla really quick. Someone asked for me to do Tesla this morning. Get rid of that one. Get rid of that one. All right, someone asked for Tesla before the open this morning. Let's see what we can do here. Trading higher now, trying to get above 520. Hopefully we can get 523 by end of day at minimum, if not all-time highs. And just keep on squeezing. I would love nothing less than all-time highs. All right. Let's have a look at Tesla. Tesla's still parked.
Athletics.com.
What's going on with Tesla over here?
Welcome back, everybody. I'm Contessa Brewer with your CNBC News update. Former President Trump issued a video statement this morning saying abortion laws should be left to the states. In a 4.5-minute video, he did not take a position on a national ban promoted by some of his allies, but he took credit for the Supreme Court.
Kind of scratching my head with Trump, too. Well, first of all, they're really harping on the...
Khan Yunis after Israel said its forces are withdrawing from the second largest city in the Gaza Strip.
They're really like, oh, we got to bring up the Trump stuff this early in the election.
Operation killed
like, why?
Thousands of militants in the former Hamas stronghold. And Nashville police arrested country.
I shouldn't say this because you guys don't like politics in the stream.
A chair from the
I get it.
top of a bar. They say
the one thing that I'm scratching my head over here is looks like they're going to break above here.
Story venue. Wallen posted a $15,000 bond overnight. He faces 3 counts of.
It's a nice little dragon formation. It's beautiful, nice and bullish, gorgeous, looks great.
I'm going to send
break above.
Long toss.
Come on, baby, get above.
In Beijing. Hi, Sarah.
Break above and then do the dip. Don't come all the way down here. I don't want you to see. I don't want to see you up there. I want to see you get above and then hold right here as the 1 minute comes up. That's what I want to see.
On the ground, both in Guangzhou in the south of China, the manufacturing hub, and then here in Beijing, where she met with high-ranking officials. The highest was Premier Li, who's the #2 leader in.
So, like, the Trump thing, the thing that's bizarre to me in the Trump thing is, oh yeah, baby. Yeah, it's still not helping me. I need to go a lot higher. I didn't add any more this morning either. I just left it. I should have sold them earlier this morning on the bell, and I did. And I was like, fuck it, we'll just hold them today and see what happens. The Trump thing is bizarre. Like, some of the shit that I saw over the weekend, I was like, he could do nothing and be fine, and he could possibly win. But he's being so divisive right now. I'm just scratching my head. I'm like, it's like the perfect opportunity for a populist to come in and run against him. So the whole thing's bizarre to me. The whole thing's bizarre. He doesn't have to be so divisive, and he'd probably have a pretty good chance of winning. But he's like getting more and more divisive as time is passing. And I'm, personally, as a Democrat, like, so I'm a Democrat, right? Personally, I don't want to fucking vote for any of these fucking guys. I don't want to vote for a fucking 80-something-year-old. And I don't want Kamala Harris as my president, I'll be honest with you, 100%. But then when I see the shit that I was like, maybe I'll throw my vote away. I saw that shit this week, and I was like, this fucking guy's making a case for fucking straight-laced Republicans, middle-of-the-road people all vote against him just for the divisiveness. Just kind of scratching my head over the playbook. I don't know what the playbook is. But, like, I don't know. The whole thing's bizarre to me. I feel like I'm living in the upside down or something like that right now. Then I posted this thing on Twitter where this, like, MAGA person was like, I'd vote for Putin today. And I'm like, have you ever read Crime and Punishment? Like, have you ever read anything about, like, Yeah, but I'm not. Oh, let's stop with the politics. The whole thing's just bizarre to me. So, all of it's I feel like I'm living in the upside down or something. The whole thing is like I'm not quite there yet, but it's probably going to get to a point where I just turn it all off and just be like, fuck it, it's all off until the election. Start muting everybody on Twitter and shit. That's what I did last election. I just started muting people. And then I came back and I went through my entire follow list and started unmuting them again once the election was over. I feel like this election is going to be like really like divisive. Like it's like the culmination of the shitification of the internet. I was talking to Joe Donut this morning, and I was like, this doesn't really matter which politics are, but this is kind of fascinating. I was like, we were talking about, we were discussing, is there anywhere left where America would tune in, where they would trust? Forget your politics. Like, doesn't matter if you're Republican, Democrat, I don't know, a Nazi or a fucking, I don't know, anti-fascist. Like, no matter what you are, like, independent, libertarian, I don't care. I was like, because this morning I was like, I think probably the last place might be like 60 Minutes on Sunday. I remember they used that for COVID, right? That was like the last, you'd be like, oh, we're going to watch 60 Minutes on Sunday because this person's going to be on or that person's going to be on. But I was trying to think of like, is there any place left on the internet or on TV where everyone would tune in or watch an interview or watch, I don't know, something that's not political or not trying to sell a point? I can't think of anywhere. Like, I can't think of it even. You know, we had like famous interviewers. You know, like that's all the news that's fit to print. You know, you had like Walter Cronkite, all these different people throughout the years, and it's like, is there anywhere that you could be like, can you watch this one show or this one interview or this one? Are there any great interviewers left anymore? I don't know. Joe brought up Lex Friedman, and we were discussing this because I watched this other guy. He has like a show on YouTube or something that he talks about. He's like an ex-army guy, and every once in a while I catch him talking things that are very propaganda-ish and not politically, like government. And I'm like, yeah, I know that talk. I'm like, I was in the army. I know that talk. And but then this guy the other day says he doesn't listen to Joe Rogan anymore. He's like, I don't listen to Joe Rogan anymore because he's one of the biggest like he switched from interviewing people. I guess like Lex Friedman asks people questions, then shuts up, I guess. And then Joe Rogan used to do that, right? Now Joe Rogan's like, you'd be like, okay, Joe, interview this crazy person so we can learn about this conspiracy theory. Then Joe Rogan started being like, yeah, fuck yeah, that shit's real. I'm going to start expounding upon it. Or I think that's what big complaint today. But this guy was saying the same thing, and this guy would be like the guy that would be pushing Joe Rogan to no end. So I was kind of scratching my head. I'm like, man, everywhere I look right now, it's like, I don't know what to think anymore. Like, I don't know what to think across the board. I'm like, everything's lopsided. It's all the upside down. Everything's like the weird upside down right now. And it's all bizarre, to me at least. And we were thinking about that this morning. I was like, is there anyone out there? Do you have anyone out there that America that has that reach too? That's the other part of it. It has to have that reach, like where America could go and just listen to a broadcast. Wouldn't have to be interviewing. Could be like the news or something like that. I don't think there is. I don't think there's anything. Now I'm talking about everybody. Like it has to be something that's neutral across the board. And I don't know that there is that anymore. or perceived as that, or perceived that. I don't mean like fucking boomers showing up to watch this or that. I'm just saying, is there anything out there? I don't think there is. And I'll be honest, I don't personally like Lex Friedman. I'm not a fan of him at all. I don't trust him. I don't like him. But is there anybody out there that could? I don't know if there would be or is right now. Everything out there seems like it's there's something to push. Like push this, push that, push this. Or maybe they're not, but we just don't trust them, right? Maybe it's just like, fuck that Democrat and fuck that Republican or fuck that MAGA guy or fuck that Libertarian or whatever it is, whatever your sauce is out there. So we're gonna look at Tesla here. Let's go down here and look at Tesla. So Tesla, oh boy, Tesla has some bad shit. Let's look at Tesla. We're going to switch over really quick. I know you don't want to, but we're going to. So, Tesla right now, we've already discussed this, right? We actually started this discussion right here. I believe it was right here. This is when we began the discussion. I was hoping for one more retest, and then I moved down. I didn't get the retest, did I? And we should have gotten the retest. And I said this is the only time this is the only time I was afraid of taking that trade. This is the one time I've lost that trade was right there too. And why was I afraid of it? Because there was a bigger down move coming, a major down move coming, possibly down to its quarterly trigger, which currently sits way down here. Sits way, way down here right now. Currently, it's at 77.93. Now, these things what these things do is, what these triggers do is it shows accumulation distribution over time. Going all the way back to the start of a ticker's life, a ticker's life, or even the S&P 500, NYA, doesn't matter. And tries to see what accumulation distribution happens over time. Now, they left behind so the morning of this low, I wanted to buy this low. But I wanted it a couple dollars earlier. It's a couple dollars lower. I was a fucking cheap ass. I ended up chasing it, and I bought it, I think, at 130 or something, and rode it all the way up. Nicely, too. But there's a momentum problem here coming down, raining down on top of Tesla. So it's not that this can't be bottom. It's not that it cannot. It's that you can't say, fuck yeah, everything's okay again until you start doing that kind of stuff, Like that kind of stuff at minimum. Like the daily chart comes up, we come back down. There's a lot of work to be done, I should say. There's a ton of work here. And the real problem is you've got some velocity coming down on Tesla right now. It's real. It's there. There's another issue with Tesla, too, which is this kind of shit down here. When you start looking at this stuff down here, it starts showing this velocity stuff down here. It's like, yeah, has velocity bottomed out yet on weekly? Kind of, but not really. It's pretty low on monthly. These are the three that matter. Well, these are the two that really matter. But then we're getting a series of lows here in accumulation on a quarterly basis. And so what's scaring me about Tesla here is it's not so much, I shouldn't say scaring. Whatever this ends up being, whether this is bottom or if there's say we squeeze up here and then we get that correction that everybody's looking for, the real dip buys down there. I will say this. Whether you buy it here and DCA it down here, I still think it's a great trade. They do have some very true existential risk to the company. Elon has said it. He said it recently that there is risk to Tesla. Myself, I want to buy. We have someone in my family has bought a Cybertruck. We have family members that work for Tesla and for other EV companies, and very close friends too, lifelong friends in our family. We are very close to Tesla in our family, and have been since the start of Tesla. And if you don't know that, that's true. I even posted a picture of my mother-in-law sitting in a Tesla Founders Edition Cybertruck. So, it's hard to say here. Like, and I just went looking at the new Chevy electric truck, and the fucking thing gets 440 miles to the charge, and it looks like a truck. That is something to say, truly. I like the look of the Tesla Cybertruck. I think it's badass with a nice wrap on it and stuff. But and that's not the only threat, though. All this Chinese shit is a huge threat. If you're a Tesla bull, you should love what Yellen is saying today. And that actually goes back to Trump too. I always have thought Biden was a Trump light. I'll be honest with you. If you're a Democrat out there, to me, I find Biden to be an edible Trump. He's not so far away. If you look at a lot of what Trump stands for, a lot of what Biden stands for too. And one of the specific ones is China, and the risk of China to the U.S. and the risk to our companies, risk to Tesla. Now, you might think Elon Musk is a fraud, but Tesla's done wonders for the car industry, pushing it forward. Starlink fucking changed the world, or chip. I don't know if you. I sail. I've spent a lot of time in my life off grid, and Starlink's banger. The boring stuff to me, I know you guys think it's like tunnels for bullshit, but I think it has more to do with saving the human race if needed, or off-world, that kind of stuff. Now, whether that's a fraud or not, it still, in my view, pushes the envelope. We've always had that person in our we've always had that person, especially in the U.S. We had who's the guy that I always talk about from the guy was the pilot, ended up going crazy or whatever, but he was the same way with the U.S. military, and I feel the same way about Elon. You got to have that one person in the room. You got all your people that don't want to change anything, and this is accusatory towards the airlines, towards military, towards car makers, towards everything that you consume, your baseline consumables. Unless you have somebody out there pushing the envelope or that third option, nothing ever changes. We actually, it hurts us as a nation. Yeah, Howard Hughes. He's the one. If you guys ever read Howard Hughes' Wikipedia page, it fucking reads like Elon. Squeezing up again on SPY. So anyways, Tesla here, right? Can this be the bottom of Tesla? Sure. How do you like Tesla like this, though? Are you going to long it? Are you going to long it only to have it come down here, and that's your real dip buy? That's more probable. Something more like this is the more probable trade. So, and 140 is probably my target right here. Now, can we get down to $80? I think if you do get down to $80, this is my target right here, $140. Right there.
So in 10 minutes' time now, at the top of the hour, we see the release of the New York Fed inflation expectations.
Now, can it go lower? Yes, it can. And if it goes lower down here, I'm going to expect some really bad news. And I told you that back here, too. Up here, when I got caught up here, I told you that you'd get bad news, and sure enough, they brought the bad news, didn't they? So if you do see it go down here, you're going to see some Well, it's either bad news or it's merger, acquisition. Elon's not the CEO anymore. Something. If it does go down to this $78, but I don't see it going any lower. Anyone out there telling you it's going lower than $80, I 1000% disagree. And if we go lower than 140 to trade that $80 down below any of this range down here, you're going to see something really nasty come out that's unknown to the market. Let me get rid of that one. Just leave that one over there. So yeah, if you want to buy this, buy it. I've got no problem with buying it, although I do think you're going to hit 140 as your actual buy down below. So that's my Tesla. That's my Tesla take. I don't think it's like this is just like when we have a bear market, right? You buy a little bit here, you buy a little bit here. I'm trying to buy this down here. Now, my one problem I had the last time I bought Tesla was I sold it too early. I will not sell Tesla again if I can get that 140. I will hold it probably for, I said this the last time and I didn't. I made a lot of money, so I didn't should have just fucking held it and just waited to add down here. So if we get down to 140, I'll be a buyer and a holder probably for a long, long time. $140. I don't see anything lower than 80. If it was $80, I'd buy that too. I would. I realize the problems that Tesla has, but I don't think we've seen the end of Elon or Tesla. So yeah, somewhere just like that for Tesla. Main screen. What are we trying to do now, right? Let's try to get back on a 1 hour chart here. Well, that's looking pretty bullish right there, isn't it? Oof. That's looking like it wants to fuck to the upside. Spooz looks like it wants to get down and fuck to the upside. Why does that do? No cheap calls for Cappy down here. They don't want to give Cappy any more cheap calls, so I guess I'm going to be sitting here waiting to see if we blast up. That looks pretty good, right? Let's look at that. Just boom, 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 boom. And what do they want to do? They want to send this thing higher, right? Price target, upside price target. Right there. 523.46. And I don't know if we can get there today, but I'd really, really like to get to all-time highs by, how about tomorrow at the close? I will warn you. If we do go up there, here, I will warn you of this. If we do go up there and we do trade that and then that right there, I guess it would be a little bit higher at that point. If we do trade this by CPI, sell the fuck out of it. Sell it, sell it, sell it, sell it, sell it. If they do it into a close, sell it. If they do it into 1 p.m., sell it. I think that's what they're going to do, and then they're going to sell the news on CPI. So hopefully we can get up there. Hopefully we can get up there for CPI. We can get a new high. I'd really like to see the all-time high for only one reason only. You guys probably already know. Just for rights, just for claiming rights. I want it for just claiming rights. I want to say all-time highs on Twitter. One more time for you. All-time highs. Now, if we can get that all-time high, do daddy the right way. There's a 30-minute chart right there. Let's go back to 1 minute. It's not going to look right when it changes time frames.
Now, at the top of the hour, we expect the release of the New York Fed inflation expectations.
Don't forget, we also have some bill auctions at 11:30. Is it me and Tom Lee? Yeah, I'd like to see all-time highs. I'd like to see all-time highs, and then I'd really like to see the bulls all pumped up. This is how much of a sicko I am.
With the latest and be on the bleeding edge.
Like, watch the bulls get all amped up, be like, woo!
Offer or
and then have these guys just come in and sell them right in the middle of the afternoon.
The price of 1 month.
Depths of hell.
Save 92%.
Trade 5,000. go down 300 points, then blast back up to 550. And just make everybody upset. Yeah, so Tesla 140. How about this too? If Tesla gets 140, so you should trade this up on Tesla. It should trade down to 140, and then you ready? You're gonna trade from 140 to 300. It's gonna go up 100% in value. That's true. 100% in value if you get me 140. $100% in value. I don't know if we can get it in one day. I think it's 2 days. But you got to rib all the bears on FinTwit. You got to piss them off. Okay. What else do we got this morning? JPM Morgan now sees Fed starting rate cuts in July instead of June. JPM economists push back their forecast for the Fed Reserve's first interest rate cut. The cycle following the strong March employment report. They now expect the U.S. Central Bank to begin easing monetary policy in July rather than June. What else do we have here? AI could augment virtually every job. I like the way he argued that. I don't think it changes every job, though. Not for a long time. Yellen saying, I'm confident that inflation will continue to come down. Yeah, there's a kind of setup here, right? You don't want, I got to preface this with you guys. You do not want to see inflation come down quick. I don't want to see inflation coming. I want to see it come down. CPI, I would love to see year over year come down like 3.5, 3.6 at most. At most. I don't think it actually comes down that far personally, but and I hope that it doesn't, to be honest with you. The longer we take to bring inflation down, the better off we are. It extends the bull run. Though I don't want to see inflation rising either. I think that'll send the market fucking down to the depths of hell. Now, there's one other part about inflation that we have to talk about, which I think I've brought up in the show before with you, which is if you were to ask, and this is true, if you were to ask 7 out of 10 people
from the New York Fed's inflation expectations.
Wait for this news. Another minute. Before this guy comes back on, the news squawk comes out back on the talk, I want to continue on with this thing about inflation. I read an article on Reddit not too long ago.
Seeing the New York Fed inflation expectations, year ahead expectations on inflation are unchanged at 3%. The March 3-year ahead expectations for inflation at 2.9%, which is up from February's 2.7%. And the March 5-year ahead inflation expectations at 2.6%, down from February's 2.9%.
It's good for bulls in the long run. I'll say that. It's not necessarily negative. It's farther out in time. It keeps the bull trade alive for longer. And that's the discussion we were just having. You don't want inflation coming down
From
fast.
the New York Fed survey is the household view on personal finance improved modestly in the month of March.
That's good.
And says the March labor market expectations were mixed in this report as well.
So I want to point something else to you out
The New
here.
York Fed stated that March's fear of missing debt payments is the highest in 4 years. And
I want to point something out to you here.
Personal finances improved modestly in the month of March.
So I want to show you this. So this means it's negative, right? That this information or this news drop is negative, but in truth, it's not. It's not for the bulls. And this goes back to why is the market going up when it should be going down? Now, you might have an initial bad reaction here at the moment, but it's bullish. Trust me. You do not want, or it's bullish, in the, it's not, this is all betting too. This is all gambling, but they're telling you it's going to take longer to fight inflation. Not that it isn't coming down, it's going to take longer to come down. And that's good. I know it doesn't sound good, but it is. This initial reaction is negative, but it does. This is the short-term window here. You don't want to see things like, yeah, we're going to hit 2% inflation next month, year over year. You don't want to hear that shit. Normally, we'll slam down off that and we'll ricochet up. You'll start to see unemployment begin to ramp. You'll see the Fed chasing and all that kind of stuff. So even though this comes off as negative and then, 1 minute bar or whatever, it's not negative. It's actually kind of bullish for the market. So anyways, on inflation, we're getting ready for CPI, right? So on inflation, there was an article that came out that was on the front page of Reddit from the news subreddit. There was like 4,000 comments. And I scrolled through all of them, scrolling through, and I'm like, oh, these top comments are fucking wrong. Then I scrolled through more, and 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 I scrolled through more. And I kid you not everybody's young on Reddit, especially on that news subreddit. I was shocked at the number of people. That were. Oh, you want to hear what the sounds are? Which sounds? I don't know. So the number of people that thought that bringing inflation back in line would mean that pricing would go back to pre-pandemic levels blew my fucking face off. Absolutely blew my face off. And there was no arguing it. That's what everybody wants. I can't deny that everybody wants that. But I told you, it's coming back. When you're like little in the middle 1 minute things and all that, ain't gonna make shit difference. So I'm shocked by that people would think that they're gonna get pricing back to pre-pandemic. It just doesn't happen. Inflation it constantly goes up. Bringing it back in line just slows the rate of inflation. You're never getting that back. Even though you want to get it back, you wish you could get it back, it ain't gonna ever happen. But I was really beside myself with people thinking that would happen. It could happen, but not under the.
Now at 11:15 a.m. Eastern Time, S&B's chairman Jordan's due to be speaking in Zurich.
Not that it can't go below pre-pandemic pricing, but not for the reasons that you think it is. It can, but not for the, hey, that we're fighting inflation, we're going to get it back to pre-pandemic levels. That ain't going to happen. Under no circumstances is that going to happen. Unless it's for a different reason. It would have to be for a different reason. But not the fight against inflation is not going to be the reason why it goes that low. Hey, Rip Bucky, how are you doing? Good morning, brother. Welcome back. Happy Monday. So we got two more news events today. We've got we have two bill auctions. We had some euro bond auctions this morning. Got 2 euro bill auctions. Maybe that'll do it. We have 2 euro bill auctions at 11:30, and then don't forget about those people that are coming in on up days at 1 p.m. BCE, thank you, appreciate that. You didn't have to do that, man. You don't have to tip me, brother. You need more Doom, please. If I was a bear, I would be saying, my mantra would be, give me all-time highs into CPI so I can sell the fuck out of it. That's what I would say. I can sell the minutes, I can sell CPI, sell the news. That's what I would be saying. Let's see if they can get above this or not. All right, so that's what I got for you guys from the news squawker this morning. What else do I have here? More Doom so we can go higher. I know, I was thinking about that too. I'm like, we're in the back end of the Doom, aren't we? I was thinking about that this weekend. I was like, this weekend I was thinking, I was like, we just had a huge roll in for COVID. I was like, then we had a huge roll in 2022. I'm like, how many fucking bear markets do they want? I'm like, they want a bear market every 2 years? Like, no more than 2 years, Captain. We want to bring that average down to a year. The market is resilient. That fucking Tesla ain't doing shit. Silver coming back up again. Oh yeah, silver. Let me check the daily candle on that. Make sure that was a. No, you haven't gotten. You know, I gotta say one thing. You have not gotten the. I'll say this for silver, gang. You haven't gotten a red candle on a daily yet. You got it on the 30-minute, but not on the daily. Until you get the red candle on the daily, silver's still alive. You need that one daily red, that big fat like green candle one day, and the big fat red candle. NVDA trying to fight its way back,
Australia,
still limping
the UK
along.
and US are considering cooperation with Japan on advanced projects.
CL tagged its high here, trying to get back and trade 87.50 now. Bitcoin with a little bit of roll here, trying to maintain itself up to 82,000. Dixie's still rolling over here. TNX waiting for the auctions. IWM's not looking for a new low. It's still looking pumpy, dude. I projected a new low in IWM. They're buying it right now.
Trades from macro headline risk with Financial Juice Pro.
It almost looks like they're running a good CPI, doesn't it? I'd be interested to see if CPI comes in low. Cool. Does the whole story of rate cuts in July change to June? Keep an eye on GCT down here for a dip buy. SPX getting a bid right now to squeeze higher. Rotation still going on. That's another thing that I did this weekend is I started looking at charts. And I was looking at tech, and I was like, fuck, there's a ton of rotation going on in tech right now. A whole ton of rotation. And we're coming into seasonality for tech. Did you know that?
In 5 minutes' time now at 11:15 a.m. Eastern Time. Expect comments from S&B's Jordan, who speaks in Zurich.
Squeezing higher right now, trying to break through some of this sellers above here. They just don't want to fucking pay me here, do they? I might have to add some shit here. Hold on. They're trying not to pay me on 523. Also on 521 right now. What else we got here? That's all I've got so far. I think that's what I got for this morning. Let me see if I can pull anything up on the right, on the left-hand side here. Let me read some stuff to you here. SP 500, NASDAQ 100 DJI futures are all in line with fair value despite a jump in treasury yields following the March employment report and a decrease in the probability of a rate cut at the June FOMC. Jaime Dimon believes the odds of a soft landing for the U.S. are lower than what markets are pricing in, while President Biden announced plans to provide relief to student loan borrowers and will warn China against aggression in the South China Sea. People's Bank of China increased its gold reserves for the 17th consecutive month. Single stock-related news, Tesla CEO Elon Musk announced the introduction of the Tesla robotaxi on August 8th. Union leaders are pushing back against Nippon Steel's proposed M&A deal for U.S. Steel. There is no other economic data of note. We've got Morningstar's DBRS confirmed the U.S. Is long-term foreign and local currency, issuer rating at AAA. At the same time, Morningstar DBRS confirmed the United States of America's short-term foreign and local currency issuer rating at R1 high. The trend on all ratings is stable. Goldman Sachs this morning saying the macro backdrop is alluring but not uncomplicated for the S&P 500. In addition, since the October lows, U.S. equities have added 12 trillion of market cap. Whew. Yeah, that's a lot, but it really isn't. Therefore, to say it again, I want to be sober as risk reward has changed. The plan is stay in the fight, but simplify your portfolio to the highest conviction components with consideration for a more reflationary tone, preference of cyclicals over defensives, and take advantage of still low implied volatility to add options to risk, manage along the path. I think that implies as long as 5,000 holds, look for higher highs. If we begin to lose 5,000, start to de-risk yourself of the market for a major pullback down to the possibly the monthly trigger, at least the weekly, if not the monthly trigger. Currently, the weekly trigger sits at 482. So the next 3-4 weeks, if that can come up to closer to the 500 mark, as long as we hold that 500, we should be good to go to the upside. The only way that we do not is if we lose that 5,000, we start to get trend sellers stepping in to the downside. The New York Fed March year ahead expected inflation unchanged at 3%. 3 year ahead, though, expected inflation 2.9 versus 2.7. I don't know that that's real. I think it's more of buying time for us to get where we need to go at 6,000. So it's more bullshit, just like the 613 rate cuts, now 0 rate cuts, all that noise that you hear out there. See if we can hold this. Looks like a little bit of rejection going on above. They don't want to give us a new high. We did back test the 5-minute trigger already. So if we do fail to get the new high here, they're going to send us right back down to the hourly trigger. So be careful of that. They're also setting us up for the bill auction that comes out at 11:30 this morning in the next 16 minutes. So be careful of a bad auction that sends us down to 518.32 at least. Just pinned in here waiting for that auction to come out.
Fed bids for 6-month bills total $4.1 billion, and Fed bids for 3-month bills total $4.1 billion.
Maybe I got the time wrong. Maybe it's 11:15, not 11:30. Let me check the times again. Yeah, I got 11:30 here. what else happened this weekend? I went to a restaurant this weekend. So I went to one of the best restaurants in Detroit this weekend. So if you don't know, I'm a foodie, and I like to eat. I eat a lot in Oakland and San Francisco, New York, Chicago. Anywhere I can get to, I'll eat some of the best restaurants in the U.S. And actually, my next two restaurants I have are I have a reservation at Alinea, and then I have a reservation at a place called Illis. That's in Brooklyn, and I don't know if I want to go. I was thinking of canceling them after I went to the Selden Standard this weekend, and it was great. I had a great experience. It was really good. Kitchen was competent. Service was outstanding, impeccable. It was really good. And but you know what did bother me was that like the U.S. food scene is, to me in general right now, boring as fuck. It's got like, it reminds me of like, it's all like decade old shit. What's that right down here? It's like you go to these restaurants and they all have the fucking burrata. And they all still throw the steak on the menu that's been cubed up like a brick. I'm not talking about meat glue and all that other shit, but there's so much of the U.S. food scene that's just, I don't know if it's COVID that did it, just laziness. Or you know what it could be? You know what I keep thinking that it is? I think that it's because like ethnic cuisine is banging right now.
Jordan's full speech on
it's like hot as fuck right now.
Interested?
That's like 5 years, 10 years.
The majority of the speech is around central bank digital currencies.
Ethnic food is just crushing the U.S. food scene. Yeah, it's like all repetitive. It's all like repetitive. A lot of, I don't know if it's stealing. I get that there's like an aspect to like, oh, I made this over there and now we're gonna make it over here and all that, but there's a ton of like, I'm talking about like the best U.S. food scenes. There was a time too when like you go to a good 1-star Michelin restaurant, they just got their star that year. You go eat there, that shit would be banging. But it's just so tiring. Yeah, it's boring, man. I'm fucking bored out of my skull. And I don't want to say that about Selden Standard. It's consistent across like the American, like James Beard, Michelin fucking food scene is like yawn. And I know part of that is like, I know there's some guy that's like, I gotta have the steak, dude. But they've been saying that shit for 20 years now at this point. Last 10 years been repetitive. It's like, oh, they're doing that. Oh, they got the salted cod. Yay. And I'm trying to be like, yeah, I know it's the end of winter. It's appropriate. You're waiting for the spring stuff to come in that's local and all that, but I think it just seems like tired. Does anybody else notice that out there? I notice that too. If you do, I notice it. What else have I noticed? I also noticed that there's a rise of no more Psalms. I've noticed an afterthought being put into finding good wine. Now, good wine's not expensive. It's cheap.
At 11:30 a.m. Eastern Time, the US sells $70 billion in 3-month bills, prior high yield 5.23%, and a prior bid cover of 2.83. And the US sells $70 billion in 6-month bills, prior high yield 5.125%, and a prior bid cover of 2.85. We also expect comments from Bank of England's Breeden, who speaks on a panel organized by the Swiss National Bank in Zurich about toward the future of the monetary system.
And there's this whole like I keep trying cocktails and I don't finish them. I'll have like 1 or 2 sips and I'm like, theoretically it sounds great, but then it just tastes like overpowered of some dog shit. So I'm like, oh, this sucks. I'm like, I bet there was someone that created that cocktail. Now they just jam it into a glass and go, here, tastes like clover, buddy. All clover. I'm just like, that's gross. It's not easy cultivating a good wine program. It really isn't. It's a pain in the ass, and you gotta get you have to get makers to allocate you so many cases. Then you have to accumulate this shit, and then some of it's like traveling. You're like traveling to Europe and shit. You're traveling like Spain. You're traveling to fucking Austria. You're traveling to places with reasonably priced wines that are banging small producers, and then like hoarding them, and then being able to sell them within a year or two. A lot of like whites, rosés, and stuff don't really last long, right? Flavor profiles get fucked up over time, so it's like intensive to do that stuff. I didn't get my cheap calls down here, so I didn't get any cheap calls down there. Hopefully, I can get some cheap calls down here. I own a bunch of calls now. I own 521, 523s. Looks like they're just lining us up for these auctions here. 11:30. 11:30 doom and gloom for bill auctions. But I noticed it again this weekend. I was like, fuck me, man. You know what's crazy, too? Here's another fucked up story. So, we ate at, we had no time, right? So we went out and ate at I don't even know the name of this place. I think it's called Carrabba's. Last month or so, we went and ate at Carrabba's. This is one of the worst meals I've ever eaten, and it was expensive as fuck. It was super expensive. I felt like I was taken for a ride. We got like 3 things to share, 4 things to share. It was expensive. It was all hell. One of the things that I got was I got meatballs and spaghetti. I don't normally get that stuff, but I got meatballs and spaghetti. The meatballs were disgusting, and the spaghetti sauce tasted like they opened a can of tomato paste, poured some water into it, let it cook all day long, burn away, and then they served it to me like unconstituted again. It was disgusting. This is how crazy it is. So I went there, right? We had to go there. It didn't choose to or anything, but I was like, man, this is disgusting and it's expensive. How do they get away with this? And then my kid wanted me to take her to Olive Garden. I think I told you guys this. I had to go to Olive Garden. My kid wanted to go to Olive Garden or something. So I went to Olive Garden, and I didn't want to eat anything there because I'm like, this is Olive Garden. This is for kids. But I ordered, what did I order? I ordered carbonara. It tasted fake, but it was passable. I ate it, and I'm like, I can eat this. It was edible, and it was dirt cheap. So I'm telling my wife, I'm like, how is it that I went to this other place with you and it was gross, double the cost, unedible, didn't eat it, just left it there. As a matter of fact, the 3 plates that we got at Carrabba's, I didn't eat any of them. I think I took a taste of each dish and said, this is disgusting, inedible. Yeah, get back up there. I went to Olive Garden and I ate
11:30 a.m. Eastern.
I ate like a $14 plate of carbonara, and I was like, yeah, I can tell this is fake, but it's passable.
3% and a prior bid to cover of 2.83. And the US sells $70 billion in 6-month bills, prior high yield of 5.125%, and a prior bid to cover of 2.85. We also expect comments from Bank of England's Breeden, who speaks on a panel organized by the Swiss National Bank in Zurich about towards the future of monetary system.
I went and ate at another Beard House. I'm not going to name this restaurant because it's a friend. I went and ate at another James Beard restaurant, and this was, I don't know, a couple months ago. Went and ate at a Beard House, and the service sucked. And I fucking hate those restaurants. I didn't say anything. I was like, I'm going to be nice. I'm like, I'm never coming back here ever again. And the food was okay. They could have made up with the service. I feel like it's two-parter. Like, you got to have the good service and the good food in case one of them is off, the other shines. So like makes things better. I think it's like a two-part thing. There's a lot of chefs out there that are like, fuck the service. They can wait all night long as the food is good. But whenever they're off, the whole experience is ruined. I'm never coming back here again. You kind of need both, in my view. And I was pleasantly surprised with Olive Garden of all places. It's funny too. Is my wife and my kids were like, "I bet that was the worst meal you've ever eaten." I'm like, "No, it was good. I ate it. It was fine." I even warmed up the carbonara late night one night, and I ate it. And I was like, "This is pretty good for what it was and for what it cost." And that's the key point that I'm getting to. It was like, if it's edible, it's not overpriced, I can eat it. If it's really good and it's overpriced, I can eat it for sure. Like Culver's, when they're on, man, woof, that place is good for a burger joint. Place is banging. When they're off, I don't want to pay the money. 3 minutes left. Doom and gloom on bill auctions. It's really weird. The food scene's really weird right now. Culver's is, so I only go to Culver's. Here's my Culver's story. So I hate going to Culver's because if they're busy, it's still pretty good. But if you want like the best Culver's, you go when they first open. They have one by a Home Depot. So if I'm ever over at the Home Depot on like a Saturday morning, I'll like drag my hungover ass up, and I'll go to Home Depot, and I'll do my thing at Home Depot, and then I'm like, oh, that Culver's is open and it's not busy yet. I bet they're all primed up and they're ready for the lunch rush on a Saturday or something, a Sunday. I'm like, I'm going in there right now. I'll get like the baddest burger. If you guys don't have a Culver's where you live, it can be almost a perfect burger. Not guaranteed the perfect burger. Like I've had better, but for a chain, it can be that burger. Yeah, I don't know what it is.
Results of the 3 and 6 month bill auction, as well as comments from Bank of England's Breeden.
If you've never been to one, if you catch them before they go into their day, they're like primed and ready for their first customer. Like, first customer's in the door. Let's make the best burger of the day today. Sometimes it can be awful. I can't disagree with that. I've been there when I've been like, damn it, I just pissed away $50 on the wife and kids. God damn it. Should never come here when it's busy. But they give you the ketchup, right? And they've got the little packets of the malt vinegar. Oof. Like they think about everything. Like they got malt vinegar so you can squish it into a little ketchup thingy. I get down on like malt vinegar with some ketchup. And I'm not down with that mayonnaise shit that you do in Canada. But some sweet, sweet, sweet malt vinegar and a little bit of ketchup. The other thing that they do right there too is they never get my order wrong. However I order, they get it right every time. A little bit of blood right now, waiting for that release. Just a programming note with you today. I've got to take my children to the thingy at 1:48 is the eclipse where I live. At 12 p.m. I got to grab my children. I'm going to go watch the eclipse. I'll take some pictures if I can. I'm going to try to take some pictures. I've got my glasses here. I don't have a great telescope anymore. I got a crappy. I used to have a great telescope, but I don't anymore. I just have like a beater telescope. I used to have one with a camera and all that stuff, but I don't have that anymore. But I'll try to take a picture of it for you.
High yield 5.12%, 5.12%. Bid to cover ratio 3.0, 3.0.
That's an A.
The US sells $74 billion.
That's an A2.
Bills and awards 27,
2.85 and 2.86. Not an A. I'll give it a B.
Month high yield 5.225%, 5.225%. Bid to cover ratio
2.79.
Bid cover ratio 2.79, 2.79. The US sells $74 billion in 3-month bills and awards 95.93% of bids at high.
Every bear out there is like, I can't wait to the day that the Fed doesn't show up and buy. When nobody shows up to the auction. It's like a bear's wet dream.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
A couple of years ago in the summertime, the Fed released a white paper on their operations, and it was hilarious to read it. Nobody read it. I think Jedi Marcus put it out, posted it on Twitter. He got like 2 likes. He got like 2 likes on the post. It was boring. It was dry. But when you read it, it was hilarious because the Treasury Department was basically like, here's the deal. Anyone that doesn't buy any of this shit, we're just going to warehouse it, but we're going to take it off our books and we're going to try to sell it in another 20 years, 10 years. They're like, we're going to be the last resort no matter what. But we're going to take it off the books. And I was like, okay. All right, here you go. The fraud goes on. U.S. 6-month bill bid to cover actual was 3. The forecast was 2.85. U.S. 6-month bill high yield actual 5.12. Forecast was 5.125. That one's kind of neutral. U.S. 3-month bill high yield actual 5.225. Forecast was 5.230. Kind of neutral-ish. 3-month bill bid to cover actual 2.79. Previous was 2.830. Dixie getting blooded right now. TNX kind of parked. Kind of putting around right now on all these tickers. Not seeing too much. GCT coming into an area that I have interest in. SPX just parked right now. Nothing too much going on right now. Market digesting. Saying I gotta do this again. Hold on here. Yeah, I got that all right. Nothing's changed. Everything is as it should be. A little bit of blood right now. We'll find out if this holds or not. 520634. We're going to find out if they're still there or not. Got an SPX here. I want to see if these guys are come right in and buy this or not. I'm bidding it up all morning. Bidding it up here, 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 here. See if they step back in the half back and buy it again. Right about there. Right about where we are. Adding some more right now.
According to a program, BTC Azeri light crude loading set at 532,000 barrels per day in May.
There's that lower low at 517. They hate that fucking hourly trigger, don't they? Just keep pounding away on it. Let's check the 30-minute hourly trigger, make sure this is going to hold. Or the 30-minute velo. I don't know. This might break. We're on 30-minute velo. We're at a high right now on 30-minute velo. I'm suspicious of it. I don't want to see the breakdown here, so we'll keep an eye on it. This will be the tell right here. They were up here. Don't roll. Hourly velo's kind of weak here, just so you know.
The White House says National Security Advisor Sullivan is to meet Monday night with relatives of Hamas hostages at the White House. The White House says the proposal has been presented to Hamas and we're waiting on its response.
Everyone's talking about how Wednesday is the day they'll do something. Is that right? I don't want to become a seller here. I'm going to have to sell this. In a few minutes, I got a couple things I got to do.
The White House says there's no date set for the new Rafah talks. Come on, Bulls. I took my coffee out. This is water time. SPX down here at least looks like they're trying to buy this. See if they're still here or not. If they're not here, they're going to rain hell on us. We could trade all the way down. Well, I got a couple places we could trade. But go back to that. We would definitely trade at least that right there. That is definitely on target. Find out if they're still here or not. $5.15, $5.14, right there. All the way down. Come on. Down there, believe it or not. It's a doozy right there, right? S&P Global Ratings says AI will reshape US tech's credit quality.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Oof. I haven't added 516Ps yet, but I've got them set up. I'm ready to pull a fucking ripcord here if it gets crazy. It's kind of it down here. Come on, Bulls. Tell you what, if the Bulls lose this, 5-17 definitely on tap. 5-14, 13-50 likely on tap as well. God, they won't let that fucking thing get up either, will it? I'm sitting in a bunch of RGF, and they just won't let it fucking get above 40 cents.
A major ground operation in Rafah is imminent.
I'm going to read this to you here in the background. Discussions between Israel and American officials regarding a potential Israeli Defense Force or IDF offensive in Rafah, a town on the southern Gaza Strip, are ongoing. According to sources cited by Israeli public broadcaster CAN, no action is planned until talks with U.S. counterparts are concluded. Someone's saying that the operation is about to begin. Some reports coming into that right now. Prospective Operation Rafah is intricately tied to the resolution of a hostage agreement. Israeli delegates, including Strategic Affairs Minister Ron Dermer and National Security Head Taki Hanagbi, excuse me if I'm pronouncing that wrong, are anticipated to participate in discussions. However, the departure may be delayed until the following week. The delay could hinge on the outcome of negotiations and developments in the ongoing talks with American and Qatari officials. During recent engagements, Shin Bet chief Ronan Barr and Mossad counterpart David Barnea met with CIA Director William Burns and Prime Minister of Qatar. American involvement has been characterized as influential, with diplomatic sources indicating the U.S. pressure could play a pivotal role in facilitating agreement amongst all parties. Israel's Minister of National Security Admar Ben-Gvir saying, if the Prime Minister quote, if the Prime Minister decides to end the war without an extensive attack on Rafah, in order to defeat Hamas, he will not have a mandate to continue serving as Prime Minister. More trouble for Netanyahu. Either way is doomed to attack Rafah or not after failure to dismantle Hamas with 6 months of ruthless bloodshed. That's just a comment from somebody. Has nothing to do with the price of stock market. Breaking, Iran has reportedly informed the U.S. that it will refrain from responding to the airstrike in which senior IRGC commanders were killed in Damascus if a ceasefire is something or other. Ceasefire is attained. The White House saying just a minute ago that there are no signs that major ground operations in Rafah are imminent. That comes from Walter Bloomberg. So it looks like some people are trying to egg on that the Rafah is starting, but the White House is saying that there's no indications of it. The White House is another one saying there's no indication of an imminent major ground operation in Rafah. This just could be somebody trying to do a hit and run on the market, maybe. White House is saying, this is coming from Live Squawk. White House says a proposal has been presented to Hamas, waiting on its response. There are no signs. Same thing. Same stuff, but no signs of imminent. Also breaking right now, Israel Prime Minister Benjamin Netanyahu has set a date for entering Rafah, Gaza in the coming weeks. So that's nothing imminent today. Whatever whispers that you're hearing of that starting, there seems to be some reputation of that happening. There's people saying that it started, but it's not a news source, just like people on Twitter. Looks like the market's waiting on this news to come out. Hold your panties. It looks like the implications here would be not so much that Rafah matters to our market, more that a ceasefire deal matters, or that whatever, was it Iran or something like that, saying they're going to do all kinds of bad stuff. Bring it on. Testing 518.32 right now. Hourly trigger is not strong, by the way, right now. Any break of the hourly trigger, we should see at least 516 or 517 and possibly as low as 513 and a half. And not to mention that we're coming into that 1 o'clock hour in the next hour. I gotta head out of here soon too. It's kind of it for the bulls here. Don't hold the hourly trigger. Blood and guts to the downside. Be prepared for it if it happens. Any rejection above here. And yeah, I know we gotta go, buddy. Excuse me. Like always when I'm about to do something, I'm like, every time I'm like, I gotta go to the dentist. They're like, no, we're gonna crash the market right now, bro. We're gonna go to all-time highs right now. Like every fucking time. And I got calls on, so I'm gonna leave these calls on. I'll be back. I should be back before the end of the day. Unless I get caught in some kind of people are talking about crazy traffic. I've never lived in the. I've seen eclipses before, but I've never been caught in traffic. Supposedly, in the Midwest, that can happen. They'll stop the highway or some shit like that, but they clog up the highway. But I think I'll be back by like 3 for the end of the day today. I'm gonna leave them on right now unless we start blooding it. But what sucks is I can't take puts because it'll be like 5 minutes and then it'll be done. So I'm just gonna stay long. I got a shit ton of cheap calls and stuff for the upside, for the close today. Same thing for tomorrow. My thesis is still to the upside, for a new high or for an all-time high, coming into CPI. So we'll see. Unless maybe they did start that ground operation or something like that. Looks more like doom and gloom to me, but not real, not material at the moment. So I'll be back with you guys at I think 3 p.m. somewhere in there. And I think at the latest, the 148 is when the full eclipse happens. So I'm assuming that it's going to start here soon, and then it should be boom, done. And then once the eclipse starts leaving, I start telling the kids, hurry up, get in the truck, we're out of here. Damn, watch me get smoked here. I don't want to sit here and stare at this shit. All right. I'm not gonna. I'm gonna leave it up. Hold on, I'm gonna do it like this so we don't. I want to make sure it doesn't run off the screen here. There we go. All right, so if I leave it like this, it's not gonna run off the screen. It's gonna follow the screen. So this should be fine. You shouldn't lose anything here today. Nothing should run off the screen. If you guys are going to watch the eclipse, I don't know where you are. You might have already started seeing the eclipse depending on where you live. Let's take a look down here below and see how low they want to go. Yeah, there ain't shit down there, dude. Ooh, baby, do you know what I want? I want that red bar to the upside. I really want to touch that red bar. Yeah, there isn't much down here, dude. We'll be blasting to the downside. I'll drop this one down. Hourly trigger is weak too. Velocity is on the top right now on the hourly velocity. So keep your eyes on this. And I'll be back with you guys at 3 p.m. I'll leave the stream up. I'm going to put CNBC on for you, and I'll leave the news squawker on, and I'll see you guys in just a little bit.
A note out today in which he talks about the trend being broken. Broke the trend the S&P did from the October lows. As long as SPX remains below 5250, and of course we are below 5250, we would view this as a valid change in tone. And the 50-day moving average is 5083. Keep an eye on that too. Hasn't been tested.
Yeah, so they're bearing it up right now.
That seems likely to get a test, Jim. So you've got a couple of tests, let's just say, as the week begins. Technically, and then rates are certainly a test. And that's before we even get to PPI, CPI, and earnings.
Yeah, I'll get to the technicals in just a second. I want to come back to what Steve was saying on the CPI, which you mentioned as well. You know, it's been 2 months in a row that we've had bad inflation reports. I mean, inflation meaningfully above expectations. If you get a third one in the row, folks, I don't like what's about to come out of my mouth, but if that happens, I fear that you're going to start to hear Fed speak about another rate hike, and that's where the game changes. Okay, so that's why this report matters so much. This is an
fun. Thank you, Addy. I appreciate it. I couldn't see the things.
By the S&P 500. So it is clearly digesting the fact that any rate cuts are most likely to happen in the second half of this year, that maybe we're going to get 2, not even likely 3.
God, these talking heads are so terrible.
And as some Fed speakers like Neil Kashkari, the Minneapolis Fed president, has been saying, maybe you get no Fed cuts this year. The markets are fine with that. What the markets will not be fine with is if we pivot back to rate hikes, and that's why this CPI is kind of important. I'm not trying to be overly dramatic.
No, I mean, I think that given what happened with prior reads. Now, I could take a little bit of issue with, you know, if it's a little bit hot, it puts hikes back on the table. I think if anything, it just continues to push off cuts.
I want you to be right. I want you to be right, and I hear you a little bit. Okay, there's always a rounding number, but let's, you know, the first one that we got that was bad was January. Everybody was like, it's a blip. Second one, you're like, maybe inflation's not coming down. You get 3 in a row that are hotter than expected, and it means inflation is not under control. Now, the ameliorating circumstance here, and here's another controversial, I don't mean this to be a hot take, but the idea of the Fed raising rates into a presidential election cycle. We all know, we're taught in business school and, you know, at our father's knee that the Fed is independent. But still, they've got to think about what the implications are politically if they're raising rates in the back half of this year.
One thing on the 3, when he mentions 3 in a row, that's actually an important number because most, you know, or I wouldn't say most, but a lot, at least the ones I know, look at an average of 3 months for employment for basically all economic data to show that it's a trend.
So Goldman's Tony Pasquarello, he addresses, Jenny, the most important issue for markets right now. I think we can all agree with this. When do higher rates begin to bite? And he's talking about the stock market. This was the most asked question of the week. The history book suggests that a 2 standard deviation move in a 10-year note, equivalent to around 60 basis points today over a month, is when impingement really kicks in. Given we closed the books at 420 last week, the simple rule of thumb argues that a move towards 4.80 is where things would get tricky for stocks. I don't think anybody's going to disagree with that.
Nope.
There were some suggestions that 4.50 is a line, a significant line in the sand.
Watch Dixie, that might be a big turn to the downside here.
Your own answer.
Okay.
When do higher rates begin to bite?
I think 480 is probably realistic. And I read the Jamie Dimon letter this morning. It was fantastic. I encourage all of you to read it also. And what Jamie says is, he's like, look, when we saw interest rates go up by 2%, we saw the market come down by 20%. So does that then suggest that if we see interest rates on the long end at the 10-year go up by 50 basis points, does that mean a 5% correction? I'm not sure how linear it is, but it definitely hurts. And we see it all the
chip
time
supply
when our
shortages
clients are
have
calling us
ebbed
and
in the
asking
AI
us,
race.
should I put money in bonds? Right? And at 5% or almost 5% on the 10-year, that question becomes more valid. If money is moving into bonds, you cannot justify a 21 times multiple on the S&P 500. I don't know if it goes from 21 to 19, 21 to 18. I don't know where it goes, but at 480 on the 10-year, it gets to be a competitive threat for equities.
See, Jenny makes great
Do you
point.
want to stay up to date with the
Doesn't she,
latest
Weiss,
and be on the bleeding edge of
we
news
have
for non-farm
justified the higher
payrolls?
multiple,
Then
certainly
sign up
compared to the
today and
10-year
get our
averages
special offer
across
of
the
Financial
entire
Juice Pro for a year's worth of our
major
service
average
for the
spectrum.
price
We
of
are
1 month.
above the
That's
historical
92%.
average for everything, okay? We've justified it in large respects, in part, new trends. AI, GLP-1s. We've also justified it because of the new trend of rate cuts, rates coming down. So you could say, well, you can carry a higher multiple.
Yep.
If rates aren't coming down, in fact, if they're backing up, then we need to question the multiple, don't we? Unless earnings just blow you out of the water, and they're not expected to blow you out of the water. They're expected to be pretty decent.
They're expected to be decent, but let's keep in mind the revisions. I think we've seen larger revisions since I think it's 2019 in terms of downward revisions in the S&P earnings. Look, Jenny is right? Because obviously if rates are low, it's a higher multiple because there's more growth. But that was my point earlier. And I don't think you have to look at the 10-year. I think you can look at the 2-year. Now, if you want, you can look at a 1-year. But if, as an equity investor primarily, I don't look for the 10-year to high. It's a high unless it's a high rate. I'll look at the 2-year, right? Because I've got a 5% yield just about in the 2-year, and that will allow me to wait out anything and get a good return. And that's going to be the one that is also going to go, the value will go up, the rate will go down.
So Raymond James says the recent rise is ultimately going to be reversed. Don't you think and look, the reason why the market hasn't had a major hissy fit over the rise in the backup in rates is because aren't rates going up for the right reason?
Yes.
As Janet Yellen, the Treasury Secretary, told Sarah Eisen over in China, let's listen to what she said, because she makes the case of why we have the backup.
The U.S. is firing on all cylinders. I mean, in terms of short-term performance, inflation is coming down. The job market is very strong. Growth is really been a lot stronger than I would have expected at this stage. We had 3.1% growth last year. Inflation's coming down. Labor supply is up.
So,
is the Secretary wrong?
No, she's right. But, I mean, that's happening in spite of higher interest rates. Certainly she's not suggesting because of, but here's where I'm going with this.
No, but rates do rise. You know, if you say rates can rise for the right reason because growth is good.
Eventually, there are some negative circumstances that come out of this. We know what they are, right? I mean, auto sales are not going to thrive if we get interest rates going higher from here. They're doing well in spite of higher interest rates. Credit card receivables are hanging in there. We know delinquencies have picked up, folks. They've gone back to the normalized curve of where they were back before the COVID pandemic. But, you know, if they go higher, you're going to see those delinquencies get worse. It is not easy to be a young person making money and keeping up with the cost of living these days. So you can't go much higher here.
At the same time, you got Chris Harvey at Wells Fargo raising his S&P 500 target to 5535. That equities still have some upside. And yeah, there may be more volatility while you have rates backing up and all the like. But at the end of the day, you're about, Jenny, to start a new trend for the Fed, we think. And that is a regime of rate cuts. In a period of time where growth remains pretty good and earnings hang in and the new trends and everything kicks together and offsets what is a, you know, okay. So it's a little upsetting to some of the bulls and their nerves are being tested by the backup in rates. But overall, stocks can still do quite well. 55.35.
Here's the thing. To get to 55.35, you're not going to get multiple expansion, right? We're not getting past 21 times. Or maybe we get to 22, but that's getting pretty stretchy. So what you need to get to 55.35 is E. You need the earnings to work. And I think that's where things get a little tricky. And that's where these higher interest rates and which end of the curve they're higher at gets particularly dicey. So to your point, Steve, like the short end's really important. If the short end comes down, and that actually boosts corporate earnings because a lot of borrowing is short. You know, it releases maybe individuals are out there and they're like, okay, I can't get 5% on my money markets anymore. Money flows in. Corporate earnings are better because their interest rates are fine. Then earnings can work. What I worry about is that and this is bringing it back to Janet Yellen for a sec, that Janet Yellen is correct in this moment, right? And when we were talking about interest rates at the long end coming down and that they kind of have to, what if they don't? Because what I think happened last fall was very interesting. When we saw the 10-year bump to 5%, why did it bump to 5%? Not because the Fed was doing anything, right? Not because there were different expectations for cuts or hikes. Why? Because the U.S. credit, when the world saw how fiscally irresponsible we are, the U.S. credit at the long end of the curve bumped up. And so I think that's where things can get dicey. If the long end sustains, right, and maybe earnings can't work as hard as they need to get to the 55.
Haven't we learned our lesson of being right in the moment has been really all that's mattered for this market.
For sure.
Or you missed it. Because if you were preoccupied for the last 18 months with the what if, you lost. You were not invested in the right things. You were not fully invested in equities. You missed an unbelievable rise in stocks from the, I'm not saying you have to be fully invested in equities. You can be invested in credit.
You knew where I
I know
was
you were
going.
I get it. My point, though, if you spent the what if over the last 18 months and that colored your investment.
Right.
You know, can I
your thesis,
can I field this?
You missed. You missed.
Right.
Can I field this? Because there was a period of time, namely 2022, where I was feeling pretty stupid. And I was here on the desk being optimistic, and I saw a lot of things going right, but the market was going against me. And I will tell you, just factually, the numbers are in your favor to be optimistic. Now, I am not saying go suck nitrous oxide, laughing gas, and become a silly boy about it. But the truth of the matter is markets go higher over time periods. They go higher. And if this market is going to go higher, the 55-35, I'm sorry, whose estimate was that?
Chris Harvey at Wells.
So you know what? That's roughly 20 times the current estimates for next year's earnings. That's not outlandish. Now, folks, we're at 5,100 at my firm, Cerity Partners. We're not raising it just yet. We need to see a little bit more in terms of those earnings.
Here's Adam Parker.
But it's not ridiculous.
Here's a checklist from Adam Parker on why he thinks the market continues to go higher. Accommodative Fed, check. Gross margin expansion. Well, that remains to be seen, but he's optimistic about it. Input costs are coming down, prices not necessarily. So then you can have gross margin expansion. Earnings growth for several years. So we've had, earnings decline for 3 or 4 straight quarters. Now we're coming out of that malaise, and we're going to have earnings growth this quarter. Now, it may be ratcheted back from where the expectations first were, from 10% to now 5%, but why can't that scenario Weiss work? You gave a look with a little bit of skepticism
because there's a lot of hope in that scenario.
Is there hope?
Well,
of
we
what?
don't have an accommodative Fed yet, do we? We have a restrictive Fed. And it's going to be restrictive even when they cut 2, 3, 4 times.
But
it's still restrictive.
But the market is anticipatory. It moves before you have.
It does.
The market started to go down before you got the first hikes.
It does. It does.
Now it's going up because you're getting ahead of the first cuts.
It discounts the cut in the market up to a year in advance. So the question is, have we seen that discount already, given where the level of the market is, number one? Number two. Number two, we don't know. We know that historically that this level of rates has caused the economy to go into a recession, right? And so now you can argue we're on borrowed time. That's in fact what Jamie Dimon argues. In other words,
well, so Dimon he takes issue with the fact that the market is pricing in almost a given that you're going to have a soft landing. He says markets seem to be pricing in 70 to 80% chance of that. And I'm paraphrasing a little bit. I believe the odds are a lot lower than that. He also talks about interest rates soaring to 8% or more in the coming years, that they're prepared for a very broad range of interest rates.
Right. And that's my point. So it's already assuming a soft landing. It's already assuming the economy is going to keep going as strong as it's been. So what will the surprise be? The surprise could be that the economy actually slows, that we're seeing more and more people come back to the workforce because they've depleted their earnings. So now they've got to go and earn some more. So that's a good thing because it brings down labor costs. The point is that there's a lot that has to go right in that scenario. But here's what isn't it amazing that over the last month that we've seen rates back up despite the geopolitical risks? Actually, despite the geopolitical risks from last week, where Iran is saying we are going to retaliate and what that could mean for oil. So maybe that's the bull case for rates, in a backwards way, that you find safe landing.
Which groups do you think have the most to live up to as we enter earnings season? I know that's the easy answer, and I ask it with almost like a wink of maybe it's not. Maybe it's all of these other sectors that had the broadening on the belief that you were going to maintain a strong economy and have rates come down. And now those are the ones that are going to be more questioned than mega cap.
Look at energy.
Look at Caterpillar. Look at the move that's had. Look at the move Deere's recently
Look at the move that JP Morgan has had.
Without a doubt. Well,
I'm just saying it's across a whole bunch of other. The stocks that have done best are not just mega cap, especially since the beginning of March.
Absolutely right.
So do the banks have the most to live up to, given what a lot of these stocks have done? Defense stocks have done quite well. Industrials have done incredibly well.
I still think
chips have done amazingly well.
I still think it's mid-cap tech, even though it's the easy answer. Sometimes the easy answer is the right answer. Because they've got, I wouldn't say air under them, they've got the most inflated multiples on near-term earnings and going forward. So,
you know, you get the banks to start off really this week. Yes, we have some others that are relevant to the desk in Delta and CarMax, but what about, Jimmy, the banks? Because you're going to get your Citi pretty early in the game here, along with JPM.
Yeah, and I think with both of them, these are more macroeconomic indicators. I was just talking about the credit card delinquencies a second ago. That's what I'm looking for. That's one of many things we can look for. And I expect those are going to be okay. Not great, but okay. You know, one of the things when we talk about financial, Scott, we're often talking about capital markets with this kind of tone of, geez, capital markets haven't quite come back. And it's true from the IPO point of view, they haven't quite come back, but you know where they really have come back is debt issuance, ironically with higher interest rates. But debt issuance has been very high, both in investment grade and high yield. That's very positive, not only for investment banking revenues, but actually for trading revenues, because it increases the volumes that are being traded. So financials actually look pretty good for this setup. I do, if you'll allow me to go back to your earlier question of what has the most to prove, I would say it's actually materials, which have had one heck of a run here and are now sporting as a sector a market multiple that equal to the market, S&P 500 overall, whereas their earnings are expected to decline this quarter year over year 5%. So there better be some massive turnaround. Maybe it'll happen. Maybe what, Steve, you're talking about with commodities in general get pumped up by what's going on in the Middle East. It could happen, but that's it. I'm not saying it won't happen. I'm saying that's where there's a lot to prove.
Why, Steve, do you still think the most pressure is on the mega caps?
Because I think they're the most visible, number one. I think it's got the highest aspirations from AI, and it's really too soon for AI use cases keep filtering through. And AI's been around for 10, 20 years, but I'm talking about the new ones they can take the next level. But the spending is there. So you've got so many people that have coming in, tourists that have come in. Look at Facebook. I mean, that stock's up 2 or 3% every day. Why? And that's not the most expensive of them.
Another record high today.
Yeah, so that's why I think it will be, because that's attracting the most capital.
Target today gets raised to 585, Jenny, at Oppenheimer from 525. They bumped the estimates, and they bumped the target also, for obvious reasons.
For obvious reasons.
AI driving revenue upside.
Well, the challenge with Meta is that you don't know what the cap is on how much they can earn, right? And it seems at this point to be unlimited. At this point, both the multiple and the earnings growth rate are high teens, low 20s. They're kind of evenly matched. There's a lot of potential there. They've maintained their efficiency. So there's, you know, it's a hard one because you don't know where the ceiling is.
Amazon, top pick at Morgan Stanley. That hits a 52-week high, Jim, today.
It hits an all-time high. And you know what? I've been saying it's a relatively new purchase for me. I've been saying that its earnings are subdued, that actually if they just cut back a little bit on the R&D spend, these earnings would look a lot better, and that multiple, which I think is around the high 30s, is even cheaper. We don't have to talk about Amazon Web Services. We know that's growing well. The retail system is growing well as consumers are employed. I think there's a lot to like in Amazon.
Weiss, price target gets bumped to 215 from 200. This is at Morgan Stanley, named the top pick, material upside to retail profit, and also they have increased confidence in the ability to deliver continued earnings and free cash flow that are pretty nice. Let's just say that.
Yeah, look, it seems like every week we're seeing, or maybe multiple times a week, price increases, targets on Amazon, on Alphabet, on everything. So I tend to ignore them. I own the stock. I'm staying with it, but none of them are cheap. It's just a question, am I willing to stay there in advance of them growing into their valuation?
None of them are cheap?
I think Alphabet is cheap, actually. I do think Alphabet's cheap, roughly a market multiple. And I think it's been, you know, maligned for really the wrong reasons.
Apple's gotten cheaper.
I think Apple deserves to be cheap. I think Apple was overpriced for years.
The chart's terrible.
They've had no growth.
The chart is terrible.
No growth in revenue, no growth in earnings.
I mean, look, on a fundamental point of view, I would disagree with you, but on a chart point of view, it's don't add to it here.
They've been flat in revenue and earnings for an extended period of time, for a couple of years. How can you disagree?
I would love some appreciation for being the OG on Apple's doing nothing.
All right. Well, actually, let me defend it. I'll defend it.
No,
We're going to be 2-on-1 here. No.
Can either of you disagree that revenue and earnings have been flat for an extended period of time?
Yeah, I've been saying it for since we were at Englewood Cliffs.
I think you're missing it.
Disagree, so you can't.
I can't.
You're missing a few things here, and I'm not adding to it here, but I will add to it when it stops going down, when the chart doesn't look as bad as it looks right now. Why? I mean, the service margins we know are better than the product margins. The ecosystem with the iPhone, I don't know anybody. Nobody in my life goes out and buys an Android. I mean, nobody. I don't know if I self-select friends that way, but
that's not the question.
Let me finish. The fact of the matter is this company generates so much cash flow that they buy back a ton of shares. And I don't care if net income is flat when it'll eventually inflect because the earnings per share are going higher as the denominator goes down.
You put on financial engineering versus true
I don't
fundamental.
consider that financial engineering. I consider that economic outperformance. You can only do that if you have the cash flows with which to do it.
You've owned Apple many, many times, so you don't own it now.
I don't. I haven't owned it for a long time.
What's a long time? I mean,
a few years.
None of the issues that you raise necessarily have colored your opinion on owning the stock in the past.
No, it has. It has. The lack of innovation and the lack of...
No, but you've owned the stock while you've criticized the lack of innovation or perceived lack.
I have. I used to own it way in front of earnings releases, because new product releases, because you have to sell on the news, right? That's been consistent.
Well, a lot of times this stock runs up right into the number.
Yeah, and
now it's been down into the number. So the pressure in some respects, you could say, is a little lighter. Right. You're also going to have the ramp into what we think is going to be an AI announcement in June.
Yeah,
on the
who knows? Now they're talking about robots in the home. We're a long way away from
it's that, right? It's right at support. It's right at support from last November.
So when I've owned it in the past, it's been a lot cheaper. Trading at this premium to the market, I have no interest in owning it. When I owned it in the past, revenue was growing, earnings were growing. Now they're not.
Okay, or you could say, which you do, like sometimes you're a trader, sometimes you're an investor. In Apple, it strikes me that you've been more of a trader than an investor. Yeah, that's probably the easier answer there, right?
I mean,
you've played it as a trade, but doesn't seem like
my kids still own it. You know, they've owned it forever, and I mean, they've got such monstrous gains in it. I'm not going to sell it. I can wait out. I don't think it's going to go down as much as tax payment would. And at some point, maybe it reverses and goes higher.
I'm going to buy it when it's got a 4% dividend yield. Won't that be amazing?
Yeah.
Can't wait.
You wake us up when that happens. All right, coming up, we'll do our calls of the day. We have a bullish analyst note today on BlackRock, one on Schwab and Netflix. A few more, too. We'll find out how the committee's playing that next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Com.
All right, we're back. Let's do calls of the day now. We're going to start with BlackRock. Target goes to $1,013 from $1,000. Wow, they're generous over at Morgan Stanley. Jimmy?
It's actually, a pretty bold target. That's a 25% price rise from where we are now. I think it can actually happen, though, and I really think this is a simple story. Asset prices in financial markets are going higher. They are higher by a meaningful amount than they were at the beginning of the year. BlackRock is an assets under management business. Their fees go up as the assets go up, and there are flows coming into their business because they've got all sorts of different products, including crypto that they've started this quarter. So I think all the cylinders are firing here. It's a large rise to get to 1,000, and I think they'll do it.
Okay. The earnings, by the way, are before the bell on Friday. Charles Schwab, price target to 74 from 68. Jenny, at Barclays, the earnings are a week from today.
Right. So if BlackRock was a bold price target increase, this is an unbold price target.
It's a slow news day, Jenny.
It must be.
$13 on $1,000.
I mean, we're talking about a $2 price increase, so 2% increase. But the point of the upgrade is very important, which is Schwab is doing an incredible job. They've just seen assets grow to $8.9 trillion, which is up 20% year over year. They saw $31 billion coming in February. And you may remember about this time last year, Schwab got slaughtered. Why? Because after SVB and after people started paying attention to their cash balances, money moved into money market funds. There was all this cash sorting. Everybody thought that was too expensive for Schwab. And so it's since recovered from them. This is a great company with really serious earnings growth ahead and trading at about 14 times. So I'd take a look at it here. I think there's more upside than 2%.
Been a lot of love lately for Netflix. We get 2 more price target hikes. Weiss today, we go $7.25 at Cowen. They reiterate buy. And JP Morgan goes $6.50 from $6.10. They reiterate overweight. April 18th earnings, 52-week high today. Weiss.
Yeah, look, I keep saying it's too small a position for me to get very excited about this. I'd love to buy more. I should have been braver when it collapsed before. But look, they're the winner, period. End of story.
I need to make one correction. I said 14 times on Schwab. It's 19 times. Sorry. That's significant.
Okay. All right. Thank you. Transocean, Jimmy, price target to $9 from $5.50. So we're at 661. That's Susquehanna. They do upgrade it as well from neutral to positive on favorable crude prices.
There was a very important piece of news last week. The Deepwater Asgard, one of their rigs, got a new contract, actually a contract extension at a day rate above $500,000 per day. That is, to my knowledge, the first contract above $500,000 since before the pandemic, actually going back about 10 years now. That's a huge moment. It indicates that supply in the offshore drilling market is very, very tight. Why this is positive for Transocean is because they've got 11 cold stacked rigs that haven't been used in years. There's very little going on in new build. Exploration and production companies clearly need these rigs. That's why the plus $500,000 contract for Deepwater Asgard occurred. That means it's highly likely that these cold stacked rigs are going to be brought back online. That's in no analyst's models that I've seen.
All right, the headlines now from Contessa Brewer. Hi, Contessa.
Hey there, Scott. National Security Advisor Jake Sullivan will meet the relatives of Hamas hostages tonight. It comes after CIA Director William Burns was in Cairo over the weekend working on a possible hostage deal and a ceasefire between Israel and Hamas. Sullivan last met with the families of the hostages in January. A program meant to give patients early access to promising drugs may not be as beneficial as first thought. According to a new study from the Journal of the American Medical Association, many cancer drugs that were granted accelerated approval by the FDA program were still unproven after 5 years in use. The program originally was created in the early 90s to fast-track HIV medications, and now 85% of the early approvals go to cancer drugs. And Uber Eats is launching a short-form video feed, a lot like, I guess, TikTok, to help restaurants boost visibility and showcase their menus. According to TechCrunch, Uber Eats emphasized that the videos are not ads and that merchants would not be charged for placement. The feature is being tested in New York, San Francisco, and Toronto, which is exactly what we need. More content when it comes to food. Scott.
Always. Contessa, thank you. Contessa Brewer. Up next, a new gold rush. Bob Pisani sitting down with the head of the world's largest gold ETF. Metal hitting another fresh all-time high. There's the chart. We're back in 2.
to learn more.
All right, welcome back. Gold hitting another fresh all-time high today. For more on what's driving this record run, let's get to Bob Pisani now with today's ETF Edge, and it's been quite a run, Bob.
So just keeping an eye on the markets then. S&P 500 now flat on the session, with the dollar just below flat, down spot 0.7%.
Bonds. What is driving gold? Let's talk to one of the world's great gold experts. George Milling-Stanley is the chief gold strategist at State Street Global Advisors. George oversees and helped launch the Spider Gold Shares, GLD. That's the world's largest gold ETF. 20 years ago when he was at the World Gold Council, and I covered that one. We go back a long way. Good to see you. Why is gold hitting a new high?
I think it's a whole bunch of reasons, never just one thing. We've got decent jewelry demand throughout the emerging markets. China's economy is recovering. We're looking for a rebound there. We've got good, solid central bank demand. And investment demand seems to be coming back. It's been there in bars and coins. It's also coming back in gold ETFs right now.
So China, demand strong. India, demand strong. They're the two biggest consumers. And central banks are buying.
Yep.
Okay. Are young people buying gold? I keep getting asked all the time. Is this here in the United States? Do they have any interest, or is this an old fuddy-duddy kind of thing?
I always thought it was my cohort and older, right? The oldest baby boomers and even older than that understood gold best. But State Street did a survey just recently, and we found out that millennials had overtaken not just Gen X, but also my generation, the boomers as well. They have much more enthusiasm for gold, and they own more gold than we do.
Why do they own? What is the enthusiasm based on? Why are they excited?
I think that they've realized the real benefits of diversification. They've realized that, gold has this twofold promise. It can, over time, it can help to enhance returns, and all the time, it is going to be reducing volatility, reducing risk. That's a great twofer.
But there's a lot of competition out there, even for young people's dollars. Bitcoin ETFs. Isn't that not competition for gold? Do you have to advertise gold more now that the Bitcoin ETFs are out? Or is that not
I don't think so. They do different jobs, Basically, the contribution that Bitcoin, whether they're ETFs or in any other format, make to portfolio performance is based entirely on returns. It doesn't have that reduction in volatility, which is one of the main reasons that people like gold.
What about gold as a hedge against inflation? You and I have been talking about this for 20 years. The academic evidence is really very mixed, that it's not necessarily a hedge against inflation, yet people continue to believe that. Why are people holding on to gold right now? Is it a hedge?
I think it's a hedge against inflation. I think it's a hedge against potential weakness in equities and in the dollar. I think that all of those things are really important. And the important thing is the real purpose of gold, in terms of being a hedge against inflation, gold is a very good protection against sustained high inflation. Inflation over 5% a year for more than 2 years, gold really performs very well. Anything other than that, not necessarily.
These central banks, why are they so interested in suddenly buying more? They've always held gold, but why are they buying it all of a sudden? They seem to be pushing up their holdings.
Yeah, I think emerging market central banks have come to the realization that they own more than 2/3 of their official reserves in US dollar-denominated debt and less than 5% in gold, and they think that is a dangerous skew.
So even central banks have to diversify. We always talk about diversifying here on CNBC. Even central banks have to diversify.
Bob, it's good for you. It's good for me. It's good for every investor, including central bankers.
It's good to see you, as always. We got much more coming up on gold and where to invest coming up on ETF Edge. That's 1:10 p.m. Eastern Time. etfedge.cnbc.com. Scotty, back to you.
All right, Bob. Appreciate that. Thank you, Bob Pisani. Up next, the $6.6 billion win for Taiwan Semi. That stock rallying after landing some big money from the U.S. government. Steve Weiss is in that name. We break down the trade. We'll do it next.
50% off.
Welcome back. Chart of the day is Taiwan Semi. That after winning that $6.6 billion grant from the U.S. government, the CHIPS Act, for its Arizona factory. So there's the stock today. Good for about 1.5%. Weiss, what do you make of this news? What do you think it means for the stock longer term?
For long term, it's great. I mean, if you take a look at Taiwan Semi, it's one of the cheapest semi stocks out there. It's less than a market multiple this year and about 3/4 a market multiple for next year. Compared to Broadcom, for example, great company, but after this year, the bounce back in revenues for Broadcom, it's got single-digit revenue growth and earnings growth versus this company, which has mid-20s EBITDA growth, et cetera, et cetera. So one of the reasons is obviously it's in Taiwan. The other reason being that it's capital intensive, the business they're in, because they're a foundry. But nonetheless, the growth is the growth. So I think the stock is way undervalued here.
Okay, Applied Materials, that's AMAT, upgraded to overweight at Cantor today. The price target to 260. That from 220. They talk about secular tailwinds from AI and a cyclical recovery. Jimmy, you own that name specifically, along with NXP and NVIDIA, as we know. But give me something on AMAT.
I will. You know, it's not just a cyclical play here. It's more of a secular play. We just were mentioning the CHIPS Act. And the basic fact is that semiconductor plants are being built all over this country. There's news in the last couple of days that Samsung is going to increase its capital expenditure spend in Taylor, Texas, outside of Austin, from $17 billion to $44 billion. That's an incremental $27 billion that they're spending on new chip plants. You know what needs to go in there? Capital equipment for semiconductors. That includes Applied Materials equipment. It includes ASML lithography equipment. But the basic fact is there is a secular trend here towards building more semiconductor plants, which applies positively to AMAT and ASML.
All right. So KeyBank is out with some price target increases today and a downgrade. So they take NVIDIA to 1,200. They take Qualcomm to 205. They take Micron to 150. They do downgrade Skyworks, though. And that's from overweight to sector weight. Now, Jenny, which you own this stock, which I'm like, okay, so you own Skyworks, but you won't own Apple. Skyworks, a lot of the chips have done amazingly well. Skyworks has not, maybe because Apple hasn't, and it's a supplier. So Skyworks is down 7% on the year. I want to know why you own it if you're so against owning Apple.
So it's just different, right? So what Skyworks does is they make chips that enable communications like Wi-Fi, satellite, network radio. And what I think is interesting about what Jim said, Steve said, and this report where some are upgraded, some are downgraded, is each of these semi companies has very unique characteristics, and they're unique within like the secular themes, and they're unique within the cyclical themes. And so what KeyBank is saying is they're saying the reason that we're downgrading Skyworks is because it's going to be difficult to grow now as smartphone growth matures. But what do we know? We know that regardless of whether smartphone growth matures or not, all we're doing is consuming more and more and more. And so as that happens, there's perpetual demand for what Skyworks does. We think, and this is where we disagree, we think that it's not a smartphone growth maturity thing. It's just a cyclical impact to Skyworks, and that's why they were down. Because if you look at their earnings are down like 19% this year.
So
wait, just follow me for 1
isn't
second.
Apple and a slowdown in its own smartphone sales just a cyclical event as well?
Yes, but if you think about it, as new smartphones are made, more and more of Skyworks chips need to go on them. So even though
Apple ones too, though.
Apple ones, everyone. So even if you're buying even if your upgrade cycle on a new phone has slowed, the next phone you buy is likely to have way more chips. The next computer you buy is going to have way more of Skyworks chips. So what we saw following the pandemic was a huge pull forward. Right? Then there was all this inventory distortion. We think that Skyworks is just about to come out of that. And so if you look at them, this goes into why do you own it versus others. You know, in our disciplined growth strategy, which is where this is, we have a 5% or better free cash flow yield to get into the portfolio. This has a 9% free cash flow yield on it. It's minting cash. This is the one that's trading at 14 times earnings. And if you look at their earnings, they're down 19% this year, but then next year they're expected to grow by 18%. And then about 19% the following year. So as we all know with cyclicals, you need to be early because the thing changes fast and furious. So I think there's a slight disconnection from as simple as I don't like Apple. I don't like Apple not for the company, but I don't like Apple, which has been true all along because of that valuation, right? I have said their earnings are growing mid-single digits. The multiple is 23 times. The multiple is 12.
Well, the multiple, but you can't.
But that's what I've complained
all-along
about.
point that you're making, Apple's valuation hasn't always been 23 times.
As long as I've disliked Apple.
It's been a lot cheaper, especially it's been half that when you back out the cash.
But as long as I've been complaining about Apple since I've been on this show, and as long as I've been saying Apple should be dead money, my argument has not been against the company whatsoever. My argument's been on valuation, where I've said their earnings are growing mid-single digits.
Israel's Prime Minister Netanyahu says a date has been set for the Rafah invasion in Gaza.
So what's the difference with Skyworks? 14 times earnings. Once we get past this year, 18% earnings growth, 19% earnings growth, and minting cash. The valuation is different. It's not just a story that I'm telling, it's a valuation difference.
All right, we're going to talk to Mike Santoli next for his midday word.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
In 10 minutes' time at 1 p.m. Eastern, we expect comments from Fred Goolsbee, who's appearing on a local Chicago radio station, WVEZ-FM.
Done.
All right, we're back. Our senior markets commentator, Mike Santoli, is here with his midday word. So I'm looking at your writing today. Yeah. You've made the point, too, that as we sort of assess where we are, that bull markets don't typically end at a time when the economy is good like this.
Or because it's good.
Or because it's good. The line, yes, that's better said. The line that sticks to me in your note today is a patient, ambivalent Fed can be fine with Wall Street if the economy stays firm while rate cuts are awaited.
That's right.
Expand.
Well, I mean, first of all, the inflation question is so central. And the reason that the market would have a problem with the Fed being more patient and pushing it off is if, one, the economy were suddenly weakening below the headline data. And there are some people making this case, by the way. Some people are pointing to, oh, it's all part-time jobs. Don't get excited about that jobs number. There's actually some loosening up. Consumer companies talking about demand and traffic falling off. Now, I'm not saying that's the prevailing view, but if you really thought that were the case, then you got to worry about a patient Fed. The other piece of it is the Fed has told you if inflation more or less tracks what they expect, they're cutting. So if they're not cutting, it means inflation's not tracking the right way. So those two things created a little bit of an issue for the market. I think what's happened here is nothing about the big picture has changed in terms of this bull market kind of earned the benefit of the doubt with how broad it was and how persistent it was. But it doesn't mean the short term you can't have some friction, and you're dealing with yields breaking out of their range. You're dealing with oil pushing up against the upper end of its range. And I think it makes sense that we are hesitating here, let's say.
All right, we'll see you on closing bell. We will continue that conversation. Mike Santoli up next. Two big winners, two big losers from today's session. We're back right after this. After this quick breakdown, we're still holding on to gains on the S&P and the Dow. We're back. Two big winners, two big losers. MicroStrategy reiterated buy at benchmark today. Now, it's obviously getting a nice bump from Bitcoin at 72,000. Weiss, you still in Bitcoin or no?
Yes, I do, Scott.
Okay. It's been volatile lately.
Diamond hands, remember.
Yeah, I know.
Yeah.
For the moment. For a trade?
They'll turn to paper soon enough.
In 5 minutes' time at 1 p.m. Eastern, we expect comments from Feds Goolsby, who appears on a local
Tesla,
Chicago radio station.
I am still short, and I'm thinking of short more.
You are?
Solar
Okay.
City, great synergies. Funding secured. We're not discounting the latest ones by favors. We're not discounting vehicles and robo-taxis August 8th. The lemmings are going into it. I would short it right here.
Okay.
Sell if you own it.
All right. So, Jimmy, we have these talks with Paramount and others, let's just say. Now, what's your point now on this stock?
Besides the fact that I'm an idiot, which I'll make every time we talk about this, I will say
we finally agreed on something.
All right, but let me just say this. There's a lot of news items coming out. None of them make sense. The idea we talked about this Friday, the idea that they're going to raise $3 billion in equity capital at this price, to me, just doesn't make any sense. They got $2.5 billion of cash on the balance sheet. They have no meaningful debt maturities until 2027. The idea that they're going to buy Ellison's studio for stock makes no sense at this price, which they've been turning around the company. The idea that they turned down a deal from Apollo for $26 billion makes no sense. Here's my point. When things don't make sense, just sit back, don't do anything. I'm certainly not putting new money into it, Scott. I don't recommend anybody put new money into it, but I'm not selling on all this ridiculous noise either.
You probably wish you sold it already a long time ago.
I can't even
I think that was implicit in your first comment.
It's so, I'll be explicit. I am an idiot for owning Paramount.
I love that. That's my favorite soundbite. Been doing this show 14 years. That's my favorite soundbite ever.
Final trades next.
Shortly expecting comments from Fed Goolsby.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
The billionaire investor Mark Lazary will join me on Closing Bell today, 3 o'clock Eastern. That's an exclusive. Talk markets, talk the Fed, talk his new sports fund as well. So we got a whole thing to discuss with Mr. Lazary. Look forward to that. We'll do final trades right now. Farmer Jim, what you got?
Delta Airlines reports Wednesday. Traffic is good. Prices are high. Should be a good report.
Stephen Weiss.
Uber. It's the other side of the Tesla trade. It's a good opportunity with the stock down.
Okay. And Jenny?
Sticking with cars, Aptiv 12 times earnings growth, 20% earnings.
All right, we are green across the board. We'll see you in a couple hours on Closing Bell. The exchange is down.
Scott, thank you very much, and welcome to the exchange. I'm Deirdre Bosa, in for Kelly Evans. Here is what is ahead. The market has been resilient so far in the face of more hawkish Fed talk. Where it goes from here, at least in the near term, that could come down to one chart, says our market guest. She is here to tell us what she's watching. Plus, Treasury Secretary Yellen, she's in China, and our Sarah Eisen sat down with her in an exclusive interview. We have the headlines and why our guest says investors should prepare for rising tensions. And the 3 buckets of AI and 1 value pick for each. That is all ahead, but we will begin with today's markets. Dom Chu with the numbers. Hi, Dom.
Hey, so Dee, they're green. We're pretty much green across the screen here, but they're modest moves. And to kind of put things in context, we're just up about maybe 1 to 0.2% for the major indices. The S&P 500 is at 52.11 right now, up 7 points. At the highs of the session, we were up roughly 15 points. So again, modest moves higher, but we were down 0.7 points at the low. So that kind of gives you the trading range so far today. The Dow Industrial is 38,943, up about 0.1%, 39 points there. And the NASDAQ Composite, 16,277, up 28 points, about 0.2% gain there. So markets at this hour, green, modestly so. One place we're keeping a close eye on is the semiconductor space. And it's not just because of the big CHIPS Act funding grant for Taiwan Semi, but a slate of analyst commentary out between Cantor Fitzgerald, KeyBank, either raising target prices or raising ratings outright. Names like NVIDIA, although it's down 0.75% right now, Applied Materials, Qualcomm, Micron, all catching a little bit of a bid here, thanks to some, in part, tailwinds from analyst calls. And by the way, for more on that story, just head over to cnbc.com/pro. Subscribers there can get the full story and analysis on some of those big calls. Watch the ETFs there as well. And then one stock, the only member of the $1 trillion market cap plus club that has not hit a record high anytime in the last 6 months has been Amazon.com. And Amazon shares are at $185.63. The reason why I'm showing you this is because at one point today, we did hit a 52-week high, but we are now just a couple dollars away from hitting a record high for Amazon. So that catch-up that's been in place since 2023 up to here is now trying to come to finally a record high. We'll keep an eye on that, Deirdre. I'll send things back over to you.
Dom, thank you very much. And we've also been tracking a shift in the dynamic at the Federal Reserve when it comes to the path of rate cuts. That dynamic is going to have some implications for investors ahead of the central bank's next meeting. Senior economics reporter Steve Fleeceman is here with more. Steve, it's nuanced, but it's there.
Exactly nuanced, but it is definitely there. The Fed has been unusually unanimous over the past several years when it's come to policy cutting to zero in the face of the pandemic. Everyone agreed. Hiking over 5% to battle inflation. Everyone agreed. Now, some divisions are showing when it comes to the issue of cutting interest rates, with some in a new hawkish wing expressing more skepticism about reducing rates, greater risk about the inflation outlook. We call it, what is it? Where is it here? It's the new hawkish wing develops. These folks sort of one cut, maybe none at all. Neil Kashkari last week talking about the issue. If inflation stalls, maybe no cuts at all. Others may feel the same way. Kashkari said it out loud. Chris Waller has said already he thinks it's probably prudent to hold longer than previously thought at the current restrictive rate. Add in Lori Logan talking about the Dallas Fed chief, talking about meaningful risks to continued inflation progress. Fed Governor Bowman gives a whole speech about all of the inflation risks that are out there. And of course, Raphael Bostic on our air and elsewhere talks about the idea of his base case is one cut and not until the fourth quarter. Now, where's the chair? That's what matters the most for this whole discussion. I say he puts himself in the center by saying the recent inflation readings have not materially changed his outlook, and that it will still likely be appropriate to lower rates at some time this year. Notice he's not telling us how many, but then there's Mary Dale from San Francisco, Loretta Mester from Cleveland. They're still on board with their baseline being 3 cuts at least. All of this hawkish speak, though, resonating with markets where the probability of a June rate cut is hovering around the 50% line. Oh, I don't have that here. That's right there. You can see that's down from 65% before the strong jobs report. July is now down to 68%, so you can say that's kind of in play too, all right? JP Morgan economists on Friday night shifting their call for the first cut to July from June. Others maintain their June cut after the strong jobs report. So the divisions at the Fed, they're not enormous. It seems most would cut if the data support it. Most would back off if the data clearly show inflation accelerating. But hawks and doves revealing themselves by their level of concern about their risks and their outlooks. Those concerns are pronounced enough, Deirdre, to raise questions about the number and the timing of rate cuts this year.
Yeah, a ton of Fed speak to sort through, which you have been doing. Let's stick around, Steve. Let's get to our next guest. She says that while the market has been fairly resilient alongside more hawkish rhetoric so far, the level of the 10-year could become a deciding factor in where the market goes from here, at least in the near term. For more, let's bring in Lizanne Saunders. Lizanne, you just heard from Stephen. You know, it sounded to me like this should be more of a plot twist than it actually is playing out in the markets. They've, as you have said as well, been very resilient.
It has, but at the index level, there's been a lot of churn under the surface and rotation and leadership shifts. And I think that reflects some of this uncertainty as it relates to Fed policy. Obviously, the economy has been resilient in the face of the market expectations going from 6 or 7 cuts starting in March at the beginning of the year to now maybe even less than 3 cuts and not starting until mid-year. But because of economic resilience, you saw that leadership shift toward the traditional cyclicals, energy and materials, to some degree, industrials, financials. And I think that's where you get a better sense of what the market is doing and what it says about the macro environment, the Fed environment, and uncertainty there. But, we're still playing these gymnastics around, when will they start, how many cuts? And it's just a silly exercise at this point because it's going to be a function of the data. And every week brings another, set of data points that could move that needle.
Yeah, Lizanne, you called the FOMC, I think you were joking here, the Federal Open Mouth Committee, because we've had so many comments over the last few weeks. Is it too much?
Well, it adds to the uncertainty. We're not in the Greenspan era where his voice was the only one that had the microphone, that had the megaphone, and it is the way it is at this point. There are times where they're very aligned, and you don't get a lot of volatility associated with Fed speakers. This doesn't happen to be one of those moments, and it wouldn't surprise me if at the point we get some sort of action on the part of the Fed that you might not have everybody on the same page. So, let's assume the next move is a cut. It wouldn't surprise me if there was maybe a dissent or two at that point.
Okay, Steve, this all raises the stakes for CPI
I
and
just
PPI.
want to comment on that last comment, which is I take a little bit more comfort that there's more disagreement. Kind of bugs me when everybody's on the same page, makes me think that perhaps the committee is victim of its own kind of groupthink. And I think Lizanne would agree, there are differences on the outlook in the market, and those should be reflected, I think, on the Fed. So first of all, you asked the question, is it too much Fed speak? When we get to a point where the market is dramatically mispricing the Fed ahead of a meeting, then I think there's too much cacophony. But we're not there yet. The market shows incredible intelligence, incredible ability to discern. I think we'll be talking for a long time why the market, after one of the Fed meetings, started pricing 6 rate cuts.
Right.
I didn't hear that, and I thought that was wrong on the part of the market. But the onus always goes on the Fed and their own communication. If the market got it wrong, then somehow the Fed got their communication wrong.
Well, we're looking to the speakers, but then we're also looking at the data, right? So which one is kind of having conflicting signals? Is it how they're interpreting
it? It's together. It's the data and their interpretation of the data that you have to do. That's why we presented this nuance analysis there, which is that data into what? Into the brains and the minds and the outlooks of the Fed folks, and then out with policy.
Right. So then when it comes to that data, Lizanne, we're looking to CPI and PPI this week. If you were in the camp that you want to see a rate cut sooner rather than later, what do you need to see? Is sticky okay as long as inflation isn't reaccelerating?
No, I don't think sticky is okay, at least not in terms of a green light for the Fed to cut. I agree with Steve. I mean, the market was way over its skis. And it actually wasn't because the Fed wasn't providing the right information. I think they were, and they were pushing back on the notion of a pivot as soon as March with 6 or 7 rate cuts. That just didn't make any sense based on the data. And what I find interesting is the parlor game of will it be June, will it be July, how many, is often not expressed with because, and then fill in the blank, because we'll see a rolling over again in CPI or PPI or PCE or, core services X housing. I think it's a function of the data. The Fed, it did express some hope, at least, maybe confidence, that the recent uptick, especially in things like the 3-month annualized change, had a lot of seasonal components to it. But this is sort of the test case because we're past the point where you can continue to blame seasonal. So if you don't see a rolling over in inflation, I think that is very supportive of the Fed staying in pause mode. And I wouldn't be surprised if you heard some of that rhetoric.
As Lizanne always done, she really put her finger on the issue of what separates the hawks and the doves here, which is those who saw these January, February numbers less of a bump and more of a trend, that's what makes them more hawkish right now. Whereas some were saying, you know what, you got the January seasonal effect that kind of continues into February, and we're still confident, which, by the way, I want to say extends to even the hawks there. Their baseline forecast is their confidence that inflation comes down. And then we had like Tom Lee on this morning, and he's like, I am confident in the outlook for rate cuts because of my personal or my company's outlook on inflation. If that's where you're at, then go ahead and trade it.
Okay, let's take the other side of that, right? He's optimistic, and Jamie Dimon is someone else who has talked about the economy recently. He tends to have a more pessimistic view, but he kind of reiterated that again in his JP Morgan annual shareholders letter. What is he seeing that perhaps maybe Fed members are not on the economy and the possibility of a soft landing? Lizanne?
Well, so I think that there are, tiny little cracks, even in the labor market data. Friday's report was pretty much positive across the board, but you could quibble with other indicators within the labor market outside of the jobs report, like the increase in layoff announcements, the increase in multiple job holders. So I think the concern may be that those tiny little cracks start to widen out, and that some of the leading indicators like layoff announcements work this time as a tell of what is yet to come down the pike. I haven't read the Jamie Dimon note, so I don't know specifically what he was focusing on, but anybody that has a weaker economic outlook, it's usually because they believe there will be a faltering in the labor market.
Lizanne, we're going to have to go real quick, but could you give us the Charles Schwab view and or your view about inflation? Are you confident inflation is coming down?
Generally, but not in a straight line. And I think it may be a stretch to get it to the actual 2% target anytime soon.
Lizanne, Steve, thank you very much for being with us.
Thanks for letting me do that little bit of reporting.
Of course,
right there
anytime. Take a look. We're going to make this actionable now. Take a look at the CNBC Magnificent 7 Index. You know who those names are. Up more than 70% in 1 year. AI, of course, one of the main catalysts here. But my next guest is focusing on names beyond big tech. For the next leg of AI growth, he has arranged them into 3 separate categories: AI enablers, supporters, and users. And he brings a top value pick in each. Joining me now for more is Aaron Dunn, co-head of value equity at Morgan Stanley Investment Management. Aaron, thanks for being with us. What is a value pick? How do you determine that? Is it a more reasonable valuation? Because we've seen sort of the valuations in the AI space just kind of go to the moon over the last year.
Yeah, our team really focuses on intrinsic value. So we look at what's a really an undervalued stock or an undervalued company in the marketplace. That's how we define value. It's not relative value. And I think, when you're looking at some of the growth rates, they're pretty eye-popping for a lot of these stocks. But we really focus on, for our clients, is finding opportunity in the market that has been overlooked, in our opinion. And as you said, there's a couple of buckets. I put some ideas in here, and we can talk about those.
Yeah, please do, because a lot of the focus, at least in this early stage, has been on chips or the semiconductor, seen as the picks and shovels of the AI shift. Where else are you looking?
Yeah, so in the enabler side, that's what I would we'll start there. And I think Micron is one that we've held actually for quite a while. And the reason we initially entered Micron was because you have a consolidated memory chip business. It's an old commodity business, as most tech people would suggest. But when you have a consolidated industry, you start to have better pricing power. And what's really occurred with that, you had a down cycle. And the one reason we really liked it was the balance sheet was exceptional, right? They entered the downturn with net cash on the balance sheet. So that gives us a buffer of safety. What has happened for Micron, though, is with NVIDIA's GPU development, they've also developed a high bandwidth memory, HBM. So this gives, it sits right along next to the GPU. They've got a really good position with NVIDIA as a partner in that. That also allows 30% energy efficiency savings. NVIDIA talked about that as well when they had their most recent.
Shortly expecting the Fed reverse repo operation.
Conference. And so, in our view, there's a lot here to like about Micron. And if you go back to the kind of 2021, 2020 period, there was a real shortage of memory chips.
Right.
And we really had a pinch. We feel like you're back at that point also. So
protect
there's
your
a couple
trades
things
from
going on with
macro
Micron
headline
that we
risk
think
with
you
Financial
still
Juice
get a
Pro.
really nice valuation.
Now only $99 a year for our
I
real-time
want to
service.
ask you about another name, Snowflake. It feels kind of controversial for let's call it AI enthusiasts right now. It was seen sort of as maybe this earlier play, a lot of data analytics, but others have pointed out slowing growth, been slower to embrace AI in terms of M&A activity. It's sort of abrupt CEO transition. Where are you on this name?
Yeah, so Snowflake's not one we hold or we invest in, so I don't really want to
74
speak to that
counterparties
as
take
an investor. I'll just say,
$448.597
I think there's a
billion
lot of
at the Fed
places
reverse
here
repo operation.
within the spaces we operate where there's a lot of opportunity, and we do look for management changes and stuff, as you mentioned with Snowflake, and I think that's a key way to create value for our clients. But I think just focusing on the rest of the value chain within AI gives us plenty of opportunity.
Tell me about the AI supporters. You say that they're the least understood area today and perhaps some of the best opportunities.
Yeah, there's been a lot of discussion about it. And I think when I say supporters, I'm thinking utilities. Utilities were the worst relative performance in 40 years last year as a sector. It's off to a slow start again this year relative to the market. But it's actually very interesting. The compound annual growth rate of electricity demand for many decades prior to the 2000 period was 4% plus, and then we entered this period of really flat demand. What we're seeing with AI today is a reemergence of growth within the utility sector. So how do these hyperscalers develop and provide or get the electricity they need to develop these data centers? And that's going to be through the utility sector. You saw a nuclear deal that Amazon did to secure some nuclear power. That's considered green, or it's more increasingly be considered green energy. So we would look at a company like NextEra, clear leader in renewable development, got a lot of competitive advantages across the sector for helping municipal utilities across the country and their own pipeline, frankly, to develop renewables to supply to data centers. We think that's extremely interesting.
Thank you so much for your picks. Certainly, the shift is going to require a lot of compute power. Thanks for being with us, Aaron Dunn. Still ahead, we are sticking with AI from value investing to venture capital. The former CEO of Amazon's One Medical joins us with how he's finding the next generation of healthcare innovation. But first, Treasury Secretary Janet Yellen says she's keeping everything on the table, including tariffs, if China doesn't slow its government subsidies. Our Sarah Eisen sat down with her today and joins us next with what the visit means for U.S.-China relations. The Exchange is back right after this.
This is The Exchange on CNBC.
will.com.
Welcome back to the Exchange. Treasury Secretary Janet Yellen is wrapping up her second trip to China since taking the position, meeting with a number of Chinese officials. She also sat down with our own Sarah Eisen for an exclusive interview. Sarah is in Beijing. It's late night there, Sarah. I know you've been on air all day.
We've been on air all day. It's 1:20 in the morning, but this is a big story. And Janet Yellen, Treasury Secretary, just wrapped up a very busy few days. First in Guangzhou in the south, which is the advanced manufacturing hub, and then here in Beijing. We followed her from the Great Hall of the People, where she met with the #2 leader, Premier Li, to local lunch with the Beijing mayor, to meet with students at Peking University. Overall, she was very well received, and she said this afternoon in a news conference at the ambassador's residence that Chinese-U.S. relations are on a firmer footing, a better place than they were a year ago. However, she did deliver two tough messages, confrontational messages in particular, as they relate to China and the economy. She did spend a great deal of time complaining about overcapacity, or China flooding the world with cheap EVs and solar panels. And she also threatened real consequences if Chinese companies help Russia help fuel its war machine against Ukraine. So I asked her whether sanctions on Chinese companies were coming. Listen.
It's not only Chinese companies. We would feel that particularly any financial institution that facilitated trade in dual-use goods or strictly military goods in violation of our sanctions and aiding Russia's military, we would consider sanctioning. The president issued a recent executive order that would enable Treasury to impose sanctions on financial institutions that are found to be doing this in a systematic way. And we've not used this tool yet, but it is one that would be available. And what I've tried to make clear is that we stand ready to act if we see significant violations especially by financial institutions.
And that warning came on the day that Russian Foreign Minister Sergei Lavrov arrived here in Beijing for two-day talks with the Chinese about strengthening their relationship. Look, the message was received okay, in part because of Yellen's cordial nature. Also, she is a well-respected economist. We saw that in a number of meetings here. They wanted to know what she thought about the overall economy. And also, the U.S. is coming from a place of strength right now. That dynamic has shifted a bit, where China's economy has been weak and disappointing. I got a chance to ask Secretary Yellen about the recent jobs report. Showed more than 300,000 jobs added in the month of March, another month with the unemployment rate below 4%. She said it's evidence that the U.S. is firing on all cylinders right now. And she still thinks, despite some hotter reads lately, that inflation will keep returning down, keep trending lower, down to that 2% level. Listen to what she said about that.
I think it will continue to come down over time. That's my expectation. And, I'm hopeful that we can certainly get into the twos.
Returning to the twos, so she's been pretty consistent in calling for a stronger U.S. economy, defying a lot of economists in the past few years who were expecting a recession, saying we're going to get a soft landing. She said it's been even stronger than she expected, which also gives her a little bit of leverage in these discussions with Beijing. I also just wanted to mention, Deirdre, that she took a lot of time for cultural visits, sites that are of importance to China. She did a private tour, for instance, of the Forbidden City at twilight. She spent 11 hours of talks and meetings with the vice premier, He Lifeng, including a 1-hour boat cruise in which I'm told they exchanged gifts. He gave her a portrait of herself on that cruise. She also went to a brewery today. That's how she wrapped up the trip. And it was a Chinese brewery, but she did have a beer that was made with American imported hops as an example a positive trade relationship where the U.S. actually exports to China.
You know, that food diplomacy is so important too, especially the Chinese and just people at the level who are watching and so fascinated as to where she's going and what she's doing. I know on social media, it's a light with everything, following her every move. Sarah, I wonder how you're experiencing it. I know that you've been out. I heard you talking about EVs as well. I remember when living there as well, you couldn't access Twitter, Gmail, Facebook, Instagram very easily, and that's still the case. Does it kind of put it into perspective how popular TikTok is, for example, here in the United States, when many of our major apps, our major tech companies are still banned over there?
Yeah, it's been really interesting to see the shift. Certainly, social media is big, and we've been monitoring the Weibo app to figure out the sentiment on the ground and some of the anti-American sentiment. They have their own version of TikTok here, as you know, that's not called TikTok. And interestingly, since you mentioned social media, that did factor into the discussions. The Chinese raised it in discussions with her. I asked Secretary Yellen about it. She said that they were concerned about it, didn't really want to go into whether they would allow a sale of U.S. assets, for instance, to American investors or companies, but did reiterate that President Biden said that he would sign the legislation if it does pass the Senate. So clearly the Chinese are watching that. And on social media, the reaction to that is that folks say this is just another example of the U.S. politicizing economic issues, using national security to try to squash successful Chinese companies, and they look at TikTok as an example of that. But Deirdre, no question it's been an adjustment as far as using electronics here, not being able to access certain things. The cameras on every corner where you turn, the surveillance cameras, that was sort of a shock as well.
A very different approach. Very different approach to privacy, and so their AI is developing a lot differently, and that's part of what TikTok is about. Sarah, fantastic reporting on the ground there. Thank you for bringing us all of that.
Thank you.
So our next guest says the market may be reassured by Yellen placating Xi, but investors should prepare for rising tensions. For more here, let's bring in Derek Scissors, Senior Fellow at the American Enterprise Institute. Derek, thanks for being with us. You're skeptical of this trip. You say that the U.S. does need to maintain communication, but, and I'm reading from your notes here, the U.S. doesn't need 2 trips in 9 months by the Treasury Secretary. Why do you take that view?
Yeah. Well, I mean, what has happened in the last 9 months that the U.S. and China need to have face-to-face talks with the same person over? Nothing is the quick answer to that question. Secretary Yellen would say we need to talk about overcapacity. Overcapacity is a 20-year issue in China. There's nothing the U.S. is going to say to them that they don't already know. And adding to that, overcapacity is really an issue for the Secretary of Commerce and the United States Trade Representative. When Secretary Yellen says all trade remedies are on the table, she's not in charge of trade remedies. That is not the real reason for her visit.
So who should be there then? Or anyone at all?
Secretary I mean, if we really are concerned about a flood of Chinese goods in certain sectors, and we feel obliged to take actions that we would prefer to avoid because we would prefer to avoid the flood of goods, Secretary Raimondo and USTR Tai are the people in charge of those measures and in charge of that issue. And they're not going there because of the reasons you mentioned in your report. Secretary Yellen is very popular in China, but her popularity in China is not a good reason for a visit.
So then what would success look like, Derek? Is this just sort of to keep the peace, or do you think that there's actual concessions to be won from China?
Oh, there are definitely no concessions to be won. And in fact, Treasury was saying that beforehand. Again, the Chinese system lends itself to overcapacity. They announce strategic sectors that get government support. You never hit market demand when you do that. You're always going to overshoot. So a visit by a U.S. cabinet official saying this is a problem, that's not going to do anything. The way you would have had success is to say, look, we don't want to take these corrective measures, but if you continue with overproduction in EVs or whatever, what have you, we're going to put new tariffs and quotas on. It's not to set up a dialogue to talk about it. This issue has been beaten into the ground. We don't need to talk anymore.
Well, how do we know that's not happening behind the scenes? Because it feels like the broader point here is stabilization, right? You can't afford to have a more aggressive China, a more aggressive President Xi Jinping. So do you have to maintain sort of the status quo? And what's the actual threat you think that China does become more aggressive and moves on a region like Taiwan?
Yeah, I mean, if you're going to make an argument that we have to be nice to Xi Jinping all the time because otherwise his behavior will be worse, that could be true. That's fine. And then we send somebody who's a friend of China to try to placate him. But it won't last. And this would be my warning to the market. Your report stated this very well. Secretary Yellen is very respected in China. She's also going to turn 78 this year. And if President Biden wins re-election, she will not be the Secretary of the Treasury. We're going to lose the people of her age who remember a period of U.S.-China cooperation, and we're going to get younger people who see Xi Jinping as aggressive. So perhaps this is the right thing to do for the next 6 months, but it will not work in 2025 because we're not going to have another Secretary Yellen to make these visits and try to calm everyone down.
Is that what you mean when you say investors should prepare for rising tension? You don't see anyone else coming up in the pipeline who can be as popular?
Yes, I mean, you have a situation where Secretary Yellen has had a long and respected career, and she's very friendly to China. And, you know, that is a rare thing now. Younger people tend to remember more of Xi Jinping and less of the days of stronger U.S.-China cooperation. So even if President Biden wins, she's not going to be Treasury Secretary in 2025. And certainly if President Trump wins, she isn't. So we're going to get somebody who is very different from Secretary Yellen and not able to make these kinds of trips to try to keep the relationship under control.
Derek, thanks for your insights. Derek Scissors.
Thank you.
Coming up, Boeing back in the spotlight after a Southwest flight lost its engine cover during takeoff. We'll look at what's behind the latest headache for Boeing and what might be to blame. We're back right after this.
Welcome back to The Exchange, everybody. I'm Tyler Matheson with your news update. Israeli Prime Minister Benjamin Netanyahu announced this afternoon that there is a date for an operation, a move militarily into Rafah. In a video statement today, Netanyahu said that an operation into Rafah was necessary to defeat Hamas, but did not provide any additional details. The announcement comes as negotiators spent the weekend in Cairo working on a possible hostage deal and ceasefire with Hamas.
Fed Goolsbee says Fed lender of last resort system is functioning well, according to
filed a
WBEZ.
last-minute appeal to change the trial's venue and to stay the gag order, a source tells NBC News. Trump's team filed a special Article 78 motion to work around a New York state law that says an appeal cannot be filed until after a trial. And Beyonce tops the Billboard charts again. Her new
Do you
album,
want to stay up
Cowboy
to date
Carter,
with the
debuting at
latest
number
and be
one
on the bleeding edge of
Billboard
news for
200 and on
non-farm
the top
payrolls?
country albums
Then
chart,
sign up
making her
today
the
and get
first
our
black
special
woman
offer of Financial
ever
Juice Pro
to top
for a year's
the
worth
list.
of our service for the
Deirdre,
price of
back
one
to you.
Nothing
month.
she can't do.
And save
Thank you, Tyler.
92%.
See you soon. Still ahead, from startup to IPO and then a $4 billion sale to Amazon. Our next guest has seen it all, and now he's investing in the next generation of healthcare. We will get his strategy and where he sees the most opportunity for disruption. That is next.
Fed Goolsbee says the economy was on a golden path in 2023. Fed Goolsbee says the economy remains strong and
Sam's
jobs
Clubs.
data confirms that.
After underperforming last year, healthcare stocks, they're off to a better start this year with the S&P Healthcare Index up nearly 5% so far in 2024. My next guest says after a 2-year slump, the healthcare funding market is finally picking up as AI gets leveraged in the sector. He runs a venture capital firm backing healthcare startups that focus on innovation with tech and AI at the forefront. Joining me now is Amir Dan Rubin, Healthier Capital founding managing partner and CEO.
Fed Goolsbee
also
says
the former CEO of
Fed
primary
has to
care
determine
provider
how long
One
to be
Medical,
restrictive on
sold to
monetary
Amazon.
policy.
Amir, thanks for being with us today. Certainly, I usually sit in San Francisco, and a lot of the VCs and founders I talk to believe that healthcare is one of the most exciting spaces for AI disruption. Where are we seeing that disruption now at the earlier stages, and what's the opportunity?
Yeah, great to be with you. I think we're going to see it all over healthcare, both on the demand side, how consumers
and employers interact with healthcare, and on the supply side, how we deliver healthcare more efficiently. Healthcare is a fifth of the economy, close to a fifth of the economy in the US, about 11% of GDP globally. So it's a massive opportunity. And really, consumers are struggling getting access to care. And then on the
Hamas
supply
rejects
side,
latest
we're having
Israeli
to struggle
ceasefire proposal, says Hamas official
labor and
Ali
clinicians to get
Baraka.
easy access. So automating a lot of healthcare is going to be really, really important as we head into the next decade.
Now, traditionally, though, healthcare has been a really tough industry to disrupt. We've seen the tech giants try and do so, from Amazon to Apple to Google with Verily. Is that changing? How is that going to change in the age of AI?
I think it is changing because I think we've learned something in these last few years with the first batch of, if you will, digital disruptors. In healthcare, we often have to disrupt from within. We have to understand that we have commercial insurance and governmental programs, Medicare and Medicaid. We have FDA, we have privacy concerns. So as we apply technology, we need to overlay this technology on top of this infrastructure. And we're seeing a batch of companies do that now. Just as an example, I'm involved with a company, Ezra, that uses AI to accelerate MRI scans, so reduces time in scanners. And it's received FDA clearance. Or these other couple of companies, Octave, which connects people with therapists who take insurance. And recently at Cigna's Investor Day, they announced a big relationship with Octave. Or Amai is a program for serious mental illness that connects patients with serious mental illness with insurance in a clinical model. We're also looking at some really interesting company to automate on the supply side, looking at a company now that can help clinical researchers look for grants, normalize their data, and use large language models to apply for those grants. So these are all examples of companies, I would say, disrupting from within the ecosystem.
When we sort of look really broad, how AI, and the application so far has been chatbots, is going to affect people, affect humanity. There's this question of, is it going to make people more or less lonely? We couldn't have sort of seen all of these unintended effects of social media either. So I wonder what you think the impact is going to be on mental health.
Well, I think a few things. I think today, if you try to interact with the healthcare system, can you get somebody to answer the phone? Can you get a response if you have a question? I think these front-end aspects of interacting with healthcare, checking my insurance, checking for availability, I think those are things we can automate. The care, the compassion, the behavior change, I think we'll leverage technology, but this is where we hope to make
Goolsby says the
humans
US economy
more
is looking
productive
like
and give them
normal
more
boom
time and
time,
space
and the
to
economy is
interact with
getting back
people.
into better
So I think
balance.
of itself, it shouldn't be a detriment, but we have to manage.
For sure. I do want to ask you, because you sold your company to Amazon. It was one of Amazon's biggest acquisitions, One Medical. And Amazon itself has sort of this mixed record in healthcare. And I wonder, what do you think it ultimately wants to do here? Does it want to get into the employer healthcare market? Because so far the success has been mostly on the consumer side.
Well, I think Amazon looks to problem statements where there is a significant gap between what people want and what's out in the marketplace. And if you look at the combination with One Medical and Amazon, One Medical had a membership subscription program that combined digital health and in-person care, and Amazon had a membership subscription program. And so that was a very nice combination. I think the other interesting thing about Amazon is Amazon can combine great technology, if you will, the AWS side of the house, with logistics. And so at some level, it also has a long-term perspective. So it's willing to work through things in the long term. So I think Amazon has the kind of capabilities, the long-term perspective, the consumer focus, the ability to combine logistics and technology that's quite unique.
The Amazon flywheel. We could put it like that, too. Thank you so much, Amir, Dan Rubin. Thanks for being with us. Coming up, Boeing is back in the headlines after an engine cover fell off a Southwest Airlines plane during takeoff this weekend. We will have the latest. That's next.
Get your slip-ins.
Another troubling headline for Boeing this weekend after a Southwest plane lost its engine cover on takeoff.
US to award Samsung $6 to $7 billion chip subsidy next week.
Hey, Deirdre, this is video that I think anybody who saw it, if you were on this flight, you were going, what is going on here? This was shortly after takeoff at Denver International Airport. Part of the engine covering, what's known as the cowling, was ripped off. It did not impact the engine, which continued to function, but they did come back to the airport, made an emergency landing. No injuries were reported. Couple of things to keep in mind here. The part of the engine that blew off here is the covering, the cowling. That's there in case there is ever an engine failure, and it can keep the parts from flying into the fuselage. Southwest Maintenance is investigating, and while this is a Boeing 737-800, keep in mind that this was delivered in 2015. And I know the headlines, and we even did it in the tease, we said more headaches for Boeing. This is a maintenance issue. This is why, while Boeing and GE Aerospace, which makes the engine, they're assisting Southwest with its investigation. As you take a look at shares of Southwest, this is not considered a Boeing manufacturing issue. So keep in mind, as you take a look at shares of Southwest, the executive pay, which came out in their proxy statement last week, part of what will be determining the pay of Bob Jordan and other executives next year, how are things happening, or what is the status of things when it comes to safety as well as quality controls there. Also, don't forget, with regard to Boeing, we get the Q1 orders and deliveries tomorrow. Do not expect strong numbers given the fact that they have dramatically slowed down production for the 737 MAX.
Phil LeBeau, thank you. We know you'll be watching that closely. Coming up, the final countdown to the solar eclipse is on. Excitement is building. Places in the path of totality are getting ready. You are looking at a live pic of the eclipse from Mexico, and we are going to go live to Burlington, Vermont, with a check on the scene there and the expected economic impact of this event. Plus, world-renowned theoretical physicist Brian Greene, he's here as well. We're back in 2 minutes. Welcome back to The Exchange. We are gearing up for the first total solar eclipse visible in the U.S. since 2017. NASA estimates that 31.6 million people live within that roughly 100-mile wide path of totality, and an additional 150 million people live within 200 miles. In North America, the path of totality, it starts in Mexico and will travel through Texas, Oklahoma, Arkansas, Missouri, Illinois, Kentucky, Indiana, Ohio, Pennsylvania, and New York. And once it hits New England, it enters Vermont, New Hampshire, and Maine before crossing into Canada. Joining me now to discuss the significance of today is renowned theoretical physicist and author Brian Greene, who is the director of the Columbia Center for Theoretical Physics. Thank you so much for being with us, Professor Greene.
My pleasure. My pleasure.
Explain to us what we are about to see.
Well, it's one of the amazing cosmic phenomenon that we can observe with the naked eye. You're going to see the moon move in front of the sun, blocking out the sun, and in that way, giving us darkness during the day. If you're in the path of totality, you're going to be able to see planets during the day. You're going to potentially see a comet if you look out there. But more importantly, you're going to have this sense of connection to the powerful forces that are governing how things evolve in the universe.
Yeah, a huge moment. Well, we do have our own Jack Stebbins, producer on The Exchange, who is there also. And Jack, you're on the ground in Burlington, Vermont. What is the atmosphere there? Are people getting excited? I'm sure.
Very, very excited. We've got apparently 30 to 60,000 people coming to Burlington, according to the Chamber of Commerce, which for a population of about 48,000 a year, we could see the population almost double to come see the eclipse and see what Dr. Green's talked about as the connection, to the universe. So everyone's got their eclipse glasses, they're ready, and the Chamber of Commerce tells me it could bring in anywhere between $12 and $50 million in tourism.
Wow. And I know hotel rooms are sold out, Airbnb occupancy rates, they are up. Professor Greene, let me come back to you. I noticed that Jack is wearing his eclipse glasses on his shirt. I don't know if those are official, Jack. I know here around Englewood Cliffs, CNBC headquarters, there's people who have made their own, purchased them on Amazon. What do we need to know about viewing this event?
Be careful. You've really got to have the right glasses to ensure that when you're looking at this wonderful spectacle that you don't damage your eye, you don't damage your retina. And there are places out there that are selling glasses that you really have to be careful about. So just make sure that they're certified. If they are, you're in great shape. And if you're in the path of totality, you can take those glasses off during those 3 minutes or so of total eclipse and just take it in with the naked eye.
Jack, what do you got? Certified glasses? I hope so. Be careful with your eyes.
I believe they are. I can put them on, but I'm not sure I'll be able to see you. But it does seem like they should be certified, and we'll be listening to make sure we put them back on once totality starts to end.
Jack, I see a scene behind you just off that balcony. So you're obviously in the path of totality. When does that happen? And will the crowds get even bigger as we approach that moment?
Yeah, they should. So we're going to see coverage start around 2:15. We're looking right now at Lake Champlain and the waterfront park behind me. So around 2:15, we'll start to see coverage, and it'll slowly get darker. Our totality hits around 3:26 p.m., and everyone is going to gather. There's live music happening. There are food vendors everywhere. It's expected to be a lot of fun.
And Brian, sort of last word for you. Is there anything that folks want to specifically look for? You said that it's going to be like nighttime in the middle of the day. Can you actually see all the constellations because it's a different time of the day?
You can certainly see the brighter stars, and you should be able to see a handful of planets, but you should also look for what's known as Bailey's beads if it happens in this one, where little streams of light passing through the deep ruts and valleys on the moon's surface. So you have to really be looking at the right moment to see that. But if you can, it's like diamonds shining through the rough there. So that's a spectacular thing to look for.
And then maybe just put into perspective how rare this event is.
Well, eclipses happen a few times a year. Total eclipses somewhere on Earth, perhaps every 18 months. But at any given location on the Earth, it's only every few centuries. So if you want to see an eclipse where you are right now, if you're in the path of totality, you're going to have to wait a few hundred years to see that again. So it is a wondrous event, and it is something to really cherish because this experience brings us all together in a way that few things do in our current world.
A lot of folks are making that pilgrimage to see it, as Jack has told us. Brian Green and our own Jack Stebbins. Thank you, Jack. Remember to wear those glasses, those certified glasses. As we look to Power Lunch, markets are flattish. Got earnings coming up. Power Lunch is next. I'll join Tyler on the other side.
Welcome to Power Lunch, everybody. Walking on the path of totality alongside Deirdre Bosa. I'm Tyler Matheson. Treasury Secretary Janet Yellen in China today with some tough words for China, saying it needs to change its policies on industry and the economy. And we'll get into more on what she wants China to do or not do coming up.
Plus, everyone, not just Tyler, is talking about the solar eclipse today, and lots of people are traveling to get a better look. We'll tell you about the hot spots, which aren't normally vacation destinations. But first, let's get a quick check on the markets. And we've seen them fairly flat today after a more volatile last week. You can see the Dow Industrials up about 0.1%, the S&P 500 and the NASDAQ Composite up a similar amount. Shares of Tesla, though, they are surging. Let's see, what are they up? Nearly 6%. Elon Musk teasing a Tesla robotaxi, tweeting that it would be unveiled on August 8th.
Gold and Bitcoin both rallying today. Gold hitting an all-time high, just shy of $2,400, and Bitcoin rallying back to above 72,000 now at 71,699. We begin, though, with today's trip to China by Secretary of Treasury Janet Yellen. Our Sarah Eisen in Beijing and sat down with the Secretary for an exclusive interview, and Sarah joins us now. Sarah, some tough words, but also a sense that maybe the relationship bilaterally is in a better place than it has been in some time.
Hi, good to see you, Tyler, from Beijing. And yes, the Treasury Secretary did say, undeniably, she said it's in a better place, that relationship, than where it was a year ago. Look, she's made all the front pages of all the state media newspapers since she's been here, and she's been on the ground in China for 4 days. Here's today's paper, and the headline reads, U.S. Finance Secretary visits China, reiterates no decoupling. And part of the message was that in our interview, our exclusive interview, she did say she does not want to discourage American companies from investing in China, didn't want to discourage investing in even production and manufacturing, even though we've seen some factories and some companies pull out of China. But she did have this harsh message, which she was scolding them for, flooding the world with cheap green technology products like EVs, like solar panels. We talked about it, and I asked her why it was such a problem and how it works.
Some of the techniques that they use, subsidizing their firms very heavily and then supporting them even when they're losing money, when demand is weak relative to this great capacity to supply products like solar panels, prices just plummet and it can drive our firms out of business. And this is something that's unacceptable from the U.S. point of view, and many of our allies feel the same way. So I think that they understand it. It's been part of their industrial strategy. It reflects the importance that they attach to advanced manufacturing. It also reflects a shortage of demand in their economy, so that they're investing heavily in manufactured goods that can be exported. And these are things that really can lead to trade tensions going forward, which we would like to avoid.
Well, I was going to ask if you actually expect them to do anything about it. Already there was a headline today that the commerce minister in China said that those accusations are groundless.
Well, I do think that they understand where we're coming from, and they have agreed to continue an intensive dialogue on this issue. I think they understand it's important, and they do have tools that they could use, perhaps that would take a while to have an effect.
Like export restrictions?
Well, I'm not thinking so much of export restrictions as some shifts in their macroeconomic policy and a reduction in the amount of particularly local government subsidies to firms in these industries.
I asked if we could see tariffs on some of those products if they don't do anything. She said everything is on the table, but she's clearly hoping that they change to focus more on consumption than manufacturing. And here's a good way to put it all in perspective. If you look, the Atlantic Council broke down the growth in EV exports from China over the last 3 years. They have surged 1,500%. It's real. And the solar industry is an early example of how damaging it can be for industries around the globe, including China. If you look at two big China solar producers, their stocks have underperformed the entire market. They're down double digits this year. I'm talking about Longi and Trina. All sorts of worries about overcapacity, putting pressure on prices, and just manufacturing solar panels where there isn't enough global demand. This glut is weighing on these companies. And that's what Secretary Yellen said as well. It hurts the Chinese companies and economy, and not just potentially threatens the U.S. companies. As far as EVs, guys, I saw firsthand just how popular they are here. About a third of new car sales in China are EVs, and these dealerships and showrooms are all over the place in fancy malls surrounded by Western brands. I even went into one of the new robocars, it's called. It's a collaboration between the Chinese auto giant Geely and Baidu. It's a self-driving car. It talks, you talk to it, it talks to you. I didn't drive it, obviously, but got into it. And look, you know, at $30,000 as a starting price, it's why so many American and European automakers feel threatened by this. And it was cool. And I have to say, I was asked earlier about the quality. It didn't look cheap. It didn't feel cheap. It was very fancy. And I think this is what Yellen and others are so worried about. In particular, EVs, but also solar panels and just these low prices and having U.S. companies struggle to compete.
Sarah, is there or is there not legitimacy in the Chinese rejoinder to American accusations that they're being protectionist and subsidizing their own industries, that we in effect do the same thing? We had subsidies on EV purchases for a long time and probably still do, for all I know. There are billions of dollars flowing to semiconductor manufacturers through the CHIPS Act and in other ways, that we subsidize the very industries that that China would like to break into here in the United States, for example, selling EV cars here?
So it's legitimate, and clearly that's what's happening. We did talk about this with the Treasury Secretary. Here's the big difference, Tyler. Part of it is just how dominant the Chinese industries are. So solar panels, 80% of the world's solar panels are supplied in China. And Secretary Yellen said it's important to have that kind of diversity of supply chain, number one, where it's not just coming from one place. Clearly, that is a risk. So that's one of the problems. And the other problem is the U.S. is a consumption-driven economy. So us subsidizing industries where we want to see manufacturing in green technologies is a far cry from China, which has been practicing industrial policy and supply-side stimulus for years and flooding the market with overcapacity. The other criticism would be that what they're doing is they're supplying too much, more than the world can handle and has demand for. And that's not necessarily what the U.S. is doing. They're trying to just get them to be U.S. made. So there's the distinction there in terms of the subsidies in the U.S. But no question, other economies have called out the Inflation Reduction Act as protectionist for prioritizing the U.S. and industrial policy and the semiconductors. We are trying to do the very same thing. But I think what Treasury would argue is that from a much smaller scale, we have to keep American companies competitive against the Chinese manufacturing, which has been their entire economy.
I sense that's right, that it's a difference in method, it's a difference in means, and it's a difference in scale of what China's doing compared with what the U.S. does. But I appreciate your taking the question. Sarah Eisen, terrific interview, and we'll see you when you get back. Thanks a lot.
Thank you.
All right, for more on what Secretary Yellen's visit to China will mean for the future of U.S.-China relations, let's bring in Warwick McNeil, Managing Director and Senior Policy Analyst at Longview Global. He's also a CNBC contributor. Let's talk about Chinese EVs, which are, I think, they have the largest EV manufacturing company in the world, surpassing by sales even Tesla. How long can the West and the United States in particular stiff-arm these automobiles from coming into domestic markets?
Well, that is a key question, Tyler. I think if we look at Sarah's interview with the Secretary, which, by the way, Sarah's done some really fantastic reporting on this trip, Secretary Yellen said, look, we don't stop Chinese cars from coming into the U.S. There is a 25% tariff on those vehicles, but if you want to sell into the market, you can. Look, I think when we look at the technological advancement of these vehicles and the cost of these vehicles, at some point the question becomes, when will American consumers start to demand other cheaper options if we really want to transition? So I think our policy will remain in place for quite some time, but this really falls on the back of consumers, and in this period, Tyler, voters, as to whether or not they want to see some greater, cheaper options in the marketplace.
Right, but even like a Geely, right, which now owns Volvo, you could argue, they're making more moves like this. And something that's been really interesting to me, Warwick, is the partnership between auto manufacturers and technology companies. Xiaomi is a smartphone company that has been able to develop an EV. We just had this report that Apple is shutting down its car project. What's happening differently in the Chinese economy to allow for this faster development and more cooperation between tech and auto?
Yeah, the Geely situation is great. Xiaomi is where I really want to focus, Deidre, because when you listen to what happened in the rollout last week with Xiaomi, Xiaomi was very clear that in their company, there are so many Tesla engineers and former employees from Tesla that's helping them to do this. And so this is what we've been saying all along, that as long as the Chinese market needs you and sees value for you as a foreign company, you're welcome. But the minute there's the ability to compete and beat you, then I think you have to really ask yourself, what's your long-term future in China? And Xiaomi literally made the case last week and talking about how many of Tesla's engineers find themselves over in Xiaomi's production.
Yeah, it's kind of incredible what it's been able to pull off. A broader question in terms of bilateral relations. Yellen is very popular among the Chinese population. Sarah's been telling us that on social media they're tracking her every move, from which Sichuan restaurant she's going to which brewery. But our guest last hour, Derek Scissors, he was saying that investors should prepare for rising tension because he said there isn't anyone to follow Secretary Treasury Yellen who's as popular as her. In fact, he said that Gina Raimondo should be there instead. So what does that look like a few years from now?
Yeah, it's a very good point, Deidre. And I'll tell you, look, I don't want to take anything from Secretary Yellen. She's had 2 trips. They've been really good trips. They've been pushing what we know as the San Francisco agreement between Biden and Xi to keep high-level dialogue open. But in many ways, this is low-hanging fruit. She is a known dove in the administration. China knows that. This is an easier conversation for them to have with Secretary Yellen. What we have not seen, what I would love to see, is a step back and say, how's the entire bilateral relationship held? And we have not had a senior level Secretary of Defense to his counterpart level dialogue on the mill-to-mill side. We have real problems right now in Second Thomas Shoal in the South China Sea with the Philippines and China literally at loggerheads. The Philippines is a treaty ally. And so we really have to take a step back and say, yes, there's been some progress over last year. Last year was a very low bar to measure, but we still need to see progress in other parts of the relationship. Mill-to-mill in particular is something that I'm keeping a close watch on.
Would you quickly address the question I asked Sarah, and that is whether how much legitimacy there is to the Chinese rejoinder that, by gosh, you guys subsidize your businesses too. And Sarah pointed out that it's a question of scale, it's a question of method, it's a question of industrial policy. How do you see that?
Yeah, I see it exactly the way Sarah sees it, the same way the Secretary laid this issue out. But that's not to dismiss their concerns about IRA, Tyler. As you know, many of our allies have issues with the IRA. And the Chinese have been pretty impressive the way they've tried to handle this. On the one hand, there's been a carrots and sticks approach. On the carrot side, they say we're going to have this balanced growth dialogue with the U.S., but I don't think that the balanced growth dialogue would do much to change China's behavior here. But they've also filed a case with the WTO saying precisely this, that this is industrial policy, and we would like to see the U.S. change their behavior. So, look, I think there's some legitimacy to that argument, but scale, scope, degree to which it happens, and the actual lack of a domestic base of consumption for all of that supply really is the difference.
DeWardwick, thank you. Always great to see you. DeWardwick McNeil, appreciate it.
Thank you, Tyler. Thank you.
One part of the plan to keep the United States more competitive with China is spending billions of dollars to revitalize the chip manufacturing industry in the U.S. Today, we're learning of another $6 billion being spent. Megan Casella has those details for us. Sounds a little twist, though. It's not an American company.
It's not. Hey, Deirdre, so the latest winner of that CHIPS Act money is actually Taiwan Semiconductor. They'll be receiving $6.5 billion in grants and up to $5 billion in loans from the Commerce Department. Now, in response, TSMC is expected to invest up to $65 billion, if not a little more, in Phoenix, Arizona. They're going to be focused in 3 fabs there on creating those 2-nanometer chips. These are the most highly sophisticated ones that power AI systems, and it makes them all the more strategically important for the U.S. as it aims to compete with China.
Right now, the U.S. makes 0% of these leading-edge chips in America, and TSMC is saying that they're going to start making this in America at scale. So it's good for our economy, but quite frankly, it's good for our national security.
Now, the goal with all of these awards, and TSMC's is the 5th so far, is to make the U.S. less dependent on China and other countries for these chips. U.S. officials want to move quickly here, but TSMC and Intel, some suppliers, and others in the past have all previously had to announce delays because of labor issues. So while there's $50 million included in this grant money for workforce training specifically, it's still an open question whether TSMC will be able to meet their goal of having all 3 fabs up and running in Arizona by the end of the decade. Guys?
And Megan, there's only really 3 main players globally, right, who have the ability to manufacture these high-end chips. It's Samsung, it's TSMC, and it's Intel. Where does this leave Intel and their ability to really develop a new business for them and compete against a Samsung and TSMC, which have well-capitalized and years of R&D experience?
Absolutely. This is a challenge for Intel. Even though Intel, we've already seen, got a really sizable award from the CHIPS Act already, they are going to be competing now to be doing this on U.S. soil. TSMC is doing this at scale in a huge way in Taiwan. If they're able to successfully bring that over to the United States to use some U.S. workers and some immigrants as well, then that's really something that's going to challenge Intel and say, we're the dominant player already overseas. We're now maybe going to be the dominant player in the U.S., and that just makes it much more difficult for Intel to really get a foothold here.
Right. I suppose the government says as long as it's in our territory, though, it's a win. Megan, thank you very much.
Thanks.
Coming up, the Fed's hesitance to hike rates fueling some fear in the market. Now with the makings of a pullback in place, has the character of this market changed, or are the bulls still in charge? Plus, further ahead, a moment in the sun, the Eclipse capturing consumers' complete attention, as well as some of their wallets. We will discuss when Power Lunch returns.
Welcome back to Power Lunch, everybody. Stocks basically flat today after a bit of a rough week last week. So was that just a brief pullback in a continued market rally, or has something actually changed? Mike Santoli's been pondering this question and joins us from the New York Stock Exchange. Mike, what do you say?
Well, Tyler, in terms of magnitude, not much has changed. It was about a 2% decline in the S&P 500 from peak to closing low last week. That's really nothing after a 28% ramp. However, it was the first 2% decline that we have seen along this rally since October. And the other piece of it is we've gone the longest stretch between making new record highs as we have since January when we first clicked to a new high. Now, it's only been a week and a half, so we're talking about, slicing the story pretty thinly here. But there are reasons to wonder about this because we have potentially some pent-up capacity for volatility. We do have Treasury yields and oil prices both threatening to break out of the top end of these sort of comfortable ranges that they've been in since December. Of course, we are also dealing with slightly less favorable seasonal patterns, especially in election years. And, you know, when we've had a 10% rally through the first quarter, as we did this year in the S&P, it's always meant that ultimately there were higher prices by the end of the year, but in no case did you avoid a 5% or 4% plus pullback along the way, all of which is to say you should expect perhaps a little more of a two-way market here. Earnings are going to come through pretty soon. We'll see if that's the test. Inflation is obviously by very good reason for it to be front and center because the Fed told you that even if the economy is good, they're going to be cutting rates at some point this year if inflation cooperates. So if they're not cutting rates, yeah, it might mean the economy's strong, but it also probably means inflation has been stickier. So it feels like it's just a little bit of a trickier backdrop for those reasons.
You know, I think back to there is no alternative era in investing when it was the only place you could really make money was in equities. And now that feels different to me. You can actually make money in bonds. You can make money. A 4.4% yield on a 10-year and what you can get in a CD is not bad. And gold is at a record high. And Bitcoin is back at 71,000. So there are alternatives.
Well, there certainly are alternatives. There's no doubt about that. I've always been of the mind, though, that even when we were saying there is no alternative back in the 2010s, investors didn't really behave that way. It wasn't as if they were shoveling money into stocks at a massive rate. Only 2013 did they really do that. And it was a matter of the market went up and it kind of did your allocation for you in stocks. But the broader point stands. I mean, you do actually have different pieces of the portfolio doing work for you right now if you are diversified. All that said, $150 billion in net new money into equity funds so far this year. So when the market goes up 20%, people don't want to hear about 4% in bonds.
No, absolutely. Thanks, Mike.
Yeah.
Our next guest says she wouldn't be surprised to see a flat market or even a pullback, but she's quick to point out that the Fed's no cuts or less cuts scenario is due to a strong economy, which is a good thing. Let's bring in Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower and a CNBC contributor. Stephanie, as we go into earnings season, what do we have to see? Obviously beats, but forward guidance as well. Is that what's going to sort of provide the next leg if interest rate cuts are uncertain now?
Yeah, I mean, I think that the market is digesting the cuts, right? Is it 0? Is it 1, 2, or 3? Personally, I do not think it's going to have a material impact, even if they did 3, on the economy. When we just raised interest rates over the last 18 months by 550 basis points. So 75 basis points of cuts isn't going to do anything, but psychologically, certainly that would be positive. But again, the reason that they're actually being a little more hesitant on cutting rates is really because of the growth that you mentioned. We're going to grow 2.5% in GDP, or something close to that in the first quarter. We just grew 3.4% all of last year. And at the same time, I know inflation is stubborn at 3.5%, but we're down from 9.1% from the peak. So we've absolutely made progress. So we have to all wait and see. We're all data dependent, but the economy is growing for the right reasons. The consumer is doing well. The job market over the last 12 months, we've seen 250,000 on average jobs produced. That's very healthy. Wages are up 4%. If you want to switch to another job, you're getting 10%. Manufacturing, you guys just did a great segment on all the onshoring and supply chains and manufacturing initiatives on the fiscal side. That's leading to better ISMs. We're just starting to see better ISMs, and new orders are going up as well. And then lastly, housing is bottoming. I mean, we were all watching housing last year, which saw a recession last year, but yet the stocks did quite well. But we're now starting to see the results in permits and starts doing better. So you add it all up, yeah, earnings I think are going to be just fine, 8-9%. Are expectations high? Yeah, they're high. But I do think you're going to see not only top line better, but margin expansion. And you're seeing a broadening out into other sectors doing just as well in terms of earnings delivering. So I think you continue to have this broader market. Lots to be excited about.
Well, Stephanie, what about some of the other stuff kind of just under the surface that
Just
Mike
keep
and
in
some
mind
of our
Biden
other
is
guests
currently
have been
making
pointing
remarks
to?
on
Higher
lowering
oil
costs for
prices,
Americans.
gold at
I'll have the
record
live stream
highs, some of the
ready momentarily.
geopolitical tensions. And Jamie Dimon's shareholder letter this morning, he was a lot more cautious.
Yeah, well, so there's plenty to worry about. Absolutely. I definitely give you that, Deirdre. But what happens is, like, I worry when I don't worry, because that means I'm being complacent. I always want to know what's out there that could actually surprise us. We kind of know all of this stuff as of now. And yeah, sure, certainly energy bothers.
So I have posted out the Biden live video on the feed for anybody interested, again discussing student loan debt relief during his visit to Wisconsin.
Higher.
You like banks, some of which report later this week, more broadly financials. Why and which ones?
Protect your trades from
so it'll be really interesting on Friday. We get
Financial
JP Morgan and Wells Fargo, and I do think the numbers are going to be good.
Service.
I do think you're going to see better net interest income for both companies. You're going to see much better controls on expenses as well, and you're going to see capital markets inflect, I think. And that's just at the beginning, Tyler. So JP is a little expensive for me. It always is. It should be because they are best in class. But I think if you can get Wells Fargo at 1.1, 1.2 times book value, that's very interesting. Doug Braunstein on the board. He came from JP Morgan. That's sort of interesting. But I own Bank of America because it's the cheapest of the three at 1.1 times, and I do think they're going to benefit from better wealth management, better capital markets, better expense control. In fact, I do think they're going to continue to take share in capital markets. And then Morgan Stanley I own, we have a new CEO we have to get through, but I do think the valuation, especially relative to Goldman Sachs, has narrowed pretty substantially.
They have a nice sort of annuity business in their wealth management area. Stephanie Link, thank you very much. Appreciate it. And ahead on the program, the race to clean up the toilet paper industry in today's Clean Start. We'll be right back.
NYMEX gasoline May futures settle at $2.74 a gallon. NYMEX diesel May futures settle at $2.72 a gallon. NYMEX natural gas May futures settle at $1.84. NYMEX WTI crude futures settle at $86.43 a barrel. That's down 48 cents or 0.55%.
Welcome back, everybody. Stocks are flattish today, but bond yields are moving higher ahead of some key data that come out later this week. Rick Santelli joins us now from Chicago with more. Rick?
Yes, and it isn't only data, Tyler. Starting tomorrow, we have 119 billion in supply, 58 billion threes, 39 billion tens, 22 billion 30s, and will make a big difference, especially with the CPI, PPI presence amongst the supply. If you look at the last 3 sessions, what should jump out at you when you see 2s, 10s, and 30s there is that this is the second consecutive staircase session where we're trading higher than the previous day's high yields. Now, granted, we reversed a little bit on the longest maturities like 20 and 30-year bonds, but that is a very aggressive formation, and we continue to hover at the high yield closes, not only for 2024, but going back towards the end of November. And if we look at the difference between tens and boons, it is really carving out a spot about 200 basis points. Our tens are 2% higher than European tens. And this is something to pay close attention to. These are the widest basically we've seen since October of last year. And finally, the dollar yen. Yes, we can't continue to look at this without knowing that the constant lower value of the yen, of course, is going to figure prominently into that export economy. But at a time where they're going to be snugging up rates, we are now in the 14th, 1-4 consecutive session where the dollar yen is closed above 151. Those are levels we haven't done since 1990. These are 34 years since we've had this many closes at that level, and it will continue to be something big in terms of Bank of Japan's influence on all the other major central banks. Deidre, back to you.
Rick Natale, thank you very much. Let's get over now to Bertha Coombs for a CNBC News update.
Hey, Deirdre. President Biden is in Madison, Wisconsin this afternoon to announce sweeping plans to provide student debt relief for an estimated 30 million Americans. Proposals are aimed at canceling runaway interest for those who are eligible for certain forgiveness programs and people experiencing hardships that prevent them from making payments. The Supreme Court struck down the president's original plan to cancel up to $20,000 in debt for about 43 million eligible borrowers. Hamas has reportedly rejected the latest Israeli ceasefire proposal in Gaza. A senior Hamas official told Reuters about the decision just hours after the group said no progress had been made in the negotiations. It also came as Israeli Prime Minister Benjamin Netanyahu said a date has been set for an invasion of the southern border city of Rafah. And the CDC is asking states to be ready with rapid tests for bird flu. It comes after Texas reported a human case last month in a person who had close contact with infected dairy cows. Despite the call to action, the agency says the risk to the public remains low. That said, they are saying don't have raw milk or raw cheeses or things like that, just to be safe.
Bertha, thanks very much. Up next, the Eclipse economy hype around today's solar event benefiting some travel stocks. That story when Power Lunch returns.
will.com.
Welcome back, everybody. The solar eclipse working its way across North America right now, from Texas to Maine. Millions of Americans standing outside, hopefully with approved glasses, to catch a glimpse. One of them is NBC News' George Solis. Hi, George.
Hey, good afternoon. On board the historic Intrepid, where history is being made as this partial solar eclipse begins. One of the best views in all of the 5 boroughs right here on board the Intrepid. Take a look at everyone here trying to grab a good seat for the partial eclipse. Keep in mind, we are not in the path of totality. That's not stopping people from having a good time. Here in New York City, we're expecting about 90% coverage, which, hey, is still pretty good when you think about it. And last I checked, as I look up and put on my special glasses, yeah, it is definitely starting to take effect here. And again, very important to wear these glasses when looking at the partial eclipse. Best I can describe it for anyone that's not able to view it, think of Pac-Man. That's what the effect that we're seeing right now. So you can see the moon being, starting to block out the sun right now, and it is just something remarkable. Obviously, the cosmic ballet that we've been referring to, one of these phenomenon, once-in-a-lifetime events. The next one not taking place for another 20 years over North America. Here, earlier, we actually spoke to an astrophysicist of all people here on board the Intrepid, who told us this is like the Super Bowl for them. So many things that they're looking to study, so many things they're hoping to learn as we look at the path of totality, where things were going to get dark, how animals react, how the climate reacts. It really is quite a phenomenon. As you can see behind me, as you see this crowd starting to grow, a lot of people taking very special interest in this cosmic convolute.
I can only imagine how early humans reacted when something like this happened, which they didn't understand. It would be totally unsettling. Who got the idea that the Intrepid would be a great place to watch an eclipse? Which it is, but it's kind of interesting.
You know, it's just such a great historic place to watch. I mean, you're high up. History was made here. You get to view this historic moment, and we're just about an hour away from actually watching this eclipse take shape here. They knew here at the museum that they have a lot of history, a lot of celestial history here, which makes it a perfect background to have an event like this. And so they actually printed up about 6,000 or so of these glasses for a viewing party. People here on board the deck, there's going to be people below us trying to get a good glimpse of this. So yeah, I mean, we can imagine a lot of places over the city trying to get a good glimpse at this. But here on board the Intrepid, I have to say, not just a good view, but it is just really, really cool to be up here.
Yeah, that's really cool. George, thanks so much. George Solis, NBC.
I guess lots of space, too, versus like
space.
One office tower.
If you're on 50th Street, and you look up, you're not going to even see the sun.
Exactly. So it can accommodate a lot of people. Well, the eclipse is turning some unlikely tourist destinations into hotspots, but just for the day, Seema Modi is looking at the travel impact of all this eclipse excitement. And here's where like Airbnbs will shine too, right? Because these aren't normally places that gets a ton of tourist traffic.
That is the story, Deidre. It's being seen as a big opportunity for the travel industry. We're seeing prices soar across the nation. Millions of travelers traveling to these smaller, lesser-known places along the path of totality, where occupancy levels are higher than what we would see during big holidays like July 4th and Memorial Day. Take a look at Geneva, Ohio, Oswego, New York, Rockwood, Maine, Kingsland, Texas, which has a population of 7,000. Homes there, on average, are going for $1,300 tonight. That's according to RDDT, which does compile data from Airbnb and Vrbo. Navid Khan of B. Riley says the eclipse will likely be a bigger win for the home rental companies because they have more exposure to smaller towns than the hotel operators. He adds that the eclipse coinciding with spring break also means potentially longer length of stays for families. The numbers from Expedia reveal an over 1,000% spike in searches as Americans look to experience this once-in-a-lifetime event. And it's not just lodging. Delta running 2 special flights today. Hertz seeing a 3,000% jump in bookings over the weekend. So it's no doubt being seen as a sales opportunity for the big travel companies, because now following 2 very strong years for the sector, this year, not so much. So they're trying to grab onto this opportunity.
Yeah, that's really amazing how it's rippling through the economy that way. Seema, thank you very much.
Yeah, thanks.
All right, coming up, a new spin on the old TP roll. A startup is using bamboo to help clean up the toilet paper industry. You don't want to miss this, folks. We'll be right back.
Brent crude futures settle at $90.38 a barrel, down 79 cents or 0.87%.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Well, most of us use this product every day, even though it is a big threat to the environment. We're not talking about oil and gas, we're talking about toilet paper. American TP is mostly made of wood pulp, which comes at the cost of Canadian forests. But there's a growing business trying to clean it all up. Diana Olick explains in her continuing series on climate startups. Hi, Di.
Hey, Ty. Yeah, toilet paper wipes out thousands of acres of Canadian forest each year, and the demand for it is actually growing. But so, too, is demand for more sustainable alternatives. And the competition is on a roll. Some of the most popular toilet paper brands on the market, like Charmin, Scott, and Cottonelle, score an F on sustainability from the Natural Resources Defense Council because they're made almost entirely from wood pulp. But new products from Whole Foods, Green Forest, Who Gives a Crap, and a startup called Real Paper are transforming an industry that is ripe for disruption.
We use bamboo for our paper. Bamboo is a grass, not a tree. It's one of the fastest growing plants in the world. And so we found it's the best sustainable resource to create high quality paper good items.
And Van Himbergen says bamboo's longer fibers make it ideal to balance softness and strength.
It's a small change that as people can transition to something more sustainable that can have a meaningful impact.
Consumer demand for environmentally cleaner products is rising fast. That has investors more interested in some of these startups and their potential payoff.
This is a very large category. There's some major companies playing, from Kimberly-Clark to P&G and others. And certainly when we invest, we say, hey, is this a business that one of those players one day may want to buy?
In addition to Bluestein, Real Paper is backed by Squared Circles, Montage, Great Oaks, Trousdale, and Mandel. Total funding so far, $14 million. Now, Real Paper has to ship its bamboo in from China, which of course burns fossil fuels, so the company purchases carbon offsets. Van Himbergen says bamboo farms are now being developed out of degraded sugar plantations in Central America, so the hope is that they can soon get it from a closer source.
I must say that the brand name Who Gives a Crap is the most inspired branding I think I've ever heard of. What about using a bidet as a better solution to all of this, which doesn't involve any plant product?
Well, it is obviously a cleaner solution, both physically and environmentally, but then you get the argument, well, what about using water? So I looked it up, Tyler, I looked it up. One shot of the bidet is 1/8 of a gallon of water, whereas to make one roll of toilet paper, it takes not only 1.5 pounds of wood pulp, but also more than 6 gallons of water. So if you're not in an area that is drought-stricken, it's much better to use the bidet. If you are in a drought-stricken area, use a sustainable TP.
Okay, so
I'm
when
here
I
for you.
go back to California, the bidet is not the better option. Is that right?
Because there's
Diana?
drought and
exactly, we deal with that. I learned a lot from that, Diana. Thank you.
Everything you want to know.
Exactly.
That was good stuff.
Still ahead on the show, pilots, power, and precious metals. We'll get the trade on United, GE Vernova, and gold and free stock lunch. That is next.
Fabletics.com.
Time now for today's three-stock lunch. Here with our trades is Victoria Green, founding partner and chief investment officer with G Squared Private Wealth. Hi, Victoria. First up, United, the airline having to delay 2 new routes amid restrictions while the FAA carries out a safety review. Shares of UAL, they're up about 1% today. Victoria, what is your trade here?
For me, UIL is a sell here. I think they're facing a lot of institutional problems. They hired so quickly, they expanded so quickly, and now they're kind of having to pay the piper. FAA investigation is not over yet, but let's step back. Let's say they were operating amazingly. They're constrained by routes right now. They're constrained by lack of planes. They have salaries and labor, which is their number one cost, is going to go up. We estimate about 15% because of all those nice new contracts they signed. And then fuel costs, which have been a bit of a tailwind to margins, likely going to bite them. So if you're not flying more routes and you're not flying more people, and they're not paying more money to fly your routes, how are you going to earn more money? I just don't buy into United right here.
It's a sell. Let's move on to GE Vernova, a new energy company spun off from General Electric just last week. They're trading higher today after it got its first upgrade to overweight from neutral. JP Morgan, the source there, shares up about 6% today. Your trade on this one?
For me at the hold, I see some potential here, but they do face a lot of headwinds, especially in their wind division, not to make a horrible pun on wind there, but their offshore wind has been a huge problem for them, and they need to fix it. They need to get that working better. They need it to actually make money. They talk about in their Investor Day presentation, they're starting to limit the losses. They're maybe profitable in 25. There's a lot of potential, but like almost every GE spinoff, they've all talked about a leaner, they're going to increase productivity, and some of that they really have to execute. And so we'd like to see how this company performs as a standalone. The power unit, 50% of it, looks like it's going to continue to generate solid free cash flow, but it's around that, specifically the wind sector, onshore and off, that we have some questions about if they can achieve their growth targets. For me, it's a hold and see how they do here.
Okay, Victoria, last one, gold hitting an all-time high, sitting just below 2,400. Is it vulnerable to a setback now? What's your trade?
I mean, for me, gold's a buy. I'm gold 3K all the way. And so for me, I look at this like potentially it's the 1979 run-up. Look, gold moved up almost 170% in 1979 alone. It has the ability to do it. Gold has been trading in a huge base, right? We were stuck from 1900 back in 2011, 2000 basically when we ended last year. We traded in that range for a very, very long time, 10, 12 years. We finally have broken out. There's legs for this, continue to push higher. Plus, you're getting so much buying from central banks. You're getting buying from international emerging markets investors that are concerned on inflation and currency devaluation. I know we're very stable here in the United States. The rest of the world can face some very extreme currency fluctuations, which we're seeing this flight to quality in gold. And I know it's run a lot, but it's done this in the past, and history says it has further to run. So I see this going to 3,000.
Victoria, thanks for all your insights. Victoria Green.
And we've got more Power Lunch after the break.
Done.
All right, we've only got about 2 minutes left in the show. Several more stories you need to know about. Let's see if any can eclipse what has come before. JP Morgan CEO Jamie Dimon highlighting AI as the first topic of his annual shareholder letter, closely watched, saying it's going to have as profound an impact on society as the printing press, electricity, and computers. Obviously, time will tell here. I wouldn't bet against it.
No, he says that they now have more than 2,000 AI and machine learning employees. Those are not cheap. Everyone's looking for those in Silicon Valley.
Probably nowhere will it be more important. I mean, maybe more important in medical and healthcare, but in banking and finance, it's going to be a huge deal.
Meanwhile, the White House announcing a new student debt relief program that aims to provide relief for millions of borrowers. If finalized, the proposal would mostly affect those with so-called runaway interest or balances that ballooned due to unpaid interest, as well as borrowers who have been paying down loans for 20 or more years.
Well, this is obviously one that's going to be interesting to watch legally because the prior attempts to get rid of student debt did not fly with the Supreme Court. And South Carolina winning the women's basketball title, completing an undefeated season, in the process knocking off Caitlin Clark in Iowa. Next up for Caitlin Clark and South Carolina's Camila Cardozo, who was a beast on the boards, among others. The WNBA draft, which is next Monday. Dawn Staley, the coach of South Carolina, incredibly gracious with respect to what Caitlin Clark has meant.
Yeah, and you said you were gripped by that game.
Yeah, it was really good. It was a really terrific game and really fun to watch. Thanks for watching Power Lunch, everybody.
Closing bell starts right now.
And stay on the path of totality.
All right, welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with a make it or break it week for the rally as rates continue to rise. Stocks remain unsettled. Never mind earnings, which are about to begin as well. We'll ask our experts over this final stretch what is really at stake this week, including the billionaire investor Mark Lazary. He'll join me in just a few. In the meantime, your scorecard with 60 minutes to go and regulation looks like this. The story really continues to be about that backup in yields. Take a look. 442 is where we currently stand on the 10-year. Well, that's putting pressure on the major averages today. No real conviction either way for the Dow, S&P, and Nas. Big week gets going. It's going to be a big one. There's your look at the major averages. Now, yes, we are green across the board, not decidedly so, but we'll take it given what's happening with yields, PPI, CPI, earnings, all in the days ahead. We are watching tech, as always. Meta and Amazon, a couple of bright spots today, both hitting new highs today. Meta then turning negative. It's down about 1%. Amazon is still in the green. It takes us to our talk of the tape. Whether stocks can continue to rise if bond yields do as well. Now, let's ask Anastasia Amoroso, iCapital's chief investment strategist, with me here at Post 9. It's good to see you.
Good to see you, Scott.
That is the key question, right? If rates continue to back up, are stocks going to go down?
Well, so far, so good for stocks, even though bond yields are rising. And of course, the reason for that is that bond yields are rising because growth is improving as well. And yes, there's also an improvement or deterioration, I should say, in inflation expectations. But for now, because you have better earnings expectations, we can shake that off. So I think if the moves are somewhat contained here, I think we're fine despite the backup. But obviously, if you have anything closer to a breakout to 480, I think we would have to worry about.
Okay, so you agree with what Tony Pasquarello of Goldman Sachs was talking about in his new note, where he says, he asks this question, which I think is the most relevant question of any right now. When do higher rates begin to bite?
Yep.
And he suggests a move towards 480 is where things could get tricky.
Yeah, I think the move right now has been more about the pickup in economic growth. It has been about stronger payrolls. It has been about stronger manufacturing, and therefore the Fed pushing back the rate cut expectations. But to the extent that the move starts being driven by inflation expectations, so of course we've got CPI on Wednesday, and if that's a surprise and that continues to reprice the inflation expectations higher, I think that's where it becomes dangerous for stocks.
Are you still optimistic about the overall direction for the market and the economy? Right, Jamie Dimon's out talking in his letter about sort of we have this foregone conclusion almost the markets do that it's going to be a soft landing, where he says markets are pricing in 70 to 80% chance of that. I believe he says, quote, the odds are a lot lower than that.
I'm still in the soft landing camp, but I actually think that the last several weeks or months of data has really reinvigorated the no landing camp. And so we wrote this piece last week about an uptick in manufacturing. I actually think that's a really big story for the rest of the year, is we're starting to see an uptick in the U.S., China, global manufacturing, new orders component is improving. But I think we're early innings of what is typically a 9-month uptick in manufacturing. So if that's the case, then you could have a lot of cyclical momentum that develops in the economy. And Scott, this used to be a one-engine economy with the U.S. consumer really supporting the globe and supporting all the industries. But now if that broadens out and you can have industrials and materials and energy participate, I think that's what gives me confidence on the economic front.
Do we need rate cuts or not? And if we need them, how soon do we need them?
Maybe not. Maybe not for the broader market. And that's really the question that we had to ask ourselves last week is, can the market still be okay without the rate cuts? I think the answer is yes, because, of course, Scott, I looked to the earnings picture, and earnings for the S&P expected to be up about 11%. We're looking at the earnings revisions, and the net earnings revisions have flipped into positive territory. And I suspect as the year progresses, and if we're right on manufacturing, we'll see the cyclical earnings uptick as well. So if that's the case, then maybe you don't actually need rate cuts, especially if the consumer is able to function with that. The caveat that I would have to that is not everybody needs a rate cut except if you're an interest rate sensitive sector. So if you're in real estate, if you're in housing, if you're in unprofitable tech, I think it does get painful.
If your stock happens to be in the Russell, you probably need a rate cut.
Yeah, and this is an interesting part of the story because typically when manufacturing picks up, when you have the cyclical momentum, you have small caps that typically outperform the S&P by 5 percentage points, except for I don't want to make the call on small caps right now because 40% of small cap exposure to debt is actually floating rate. So if the Fed doesn't cut rates, the leverage does still become prohibitive for these small caps.
So square this for me, because in let's say late October, right, the bottom, before we started this incredible rally and we set new records for stocks, we did that, one would think, on the expectation and the anticipation and the discounting of future rate cuts. Okay?
Yes.
The economy was good. Here we are, and we're saying, well, never mind that. We can still go up. And we don't even need the rate cuts that we thought we needed, that we thought sent this rally into motion in the first place. How do we square that?
So you almost had this perfect relay race because you're right. In October, we were expecting rate cuts, and that's what's going to support the economy eventually. But instead, what happened is the economy was able to find enough momentum to actually start to reaccelerate. If you look at the city surprise index, if you look at any surprise index, you see that, well, if you look at Atlanta GDP now, close to 3%, consensus going into the year was about 1% GDP growth. So that's what happened is I think the consensus realizes maybe we don't need the rate cuts if it's growth that's able to support us here.
Interesting. Steve Leisman, our senior economics correspondent, has been on this very question throughout the day. And Steve, I think you called it a hawkish tilt as you sort of looked at the current makeup of the Fed speakers who matter most in the days prior, and who are starting to maybe lean towards being a little more hawkish. I should say, though, as I ask you that, not exactly the Fed chair. And that's important.
No, I think the Fed chair still is sort of in the middle, usually gauging his committee, guides his committee. I think what's happened, Scott, is first the dots leaned hawkish, and then the rhetoric leaned hawkish. And I think that what we're hearing is the reflection
set up
of this
economic
movement
events
of
to
the dots.
rebalance
Essentially, to
China-France
the right,
relations, according to a source of the French ministry.
That maybe you would do more than 3 cuts, and then you just barely hung on to the median of 3 cuts in the dot. And you also had people move up their sense of where neutral is, and now the rhetoric's come along with that, which you kind of in this environment, Scott, you start to think about a hawk as somebody who thinks maybe more probability on the idea of no cuts or just 1 cut, more concern about the recent inflation numbers, whereas Powell still seems to be holding out hope that, or holding on to the forecast that essentially says that inflation will come down. But there's folks like Neil Kashkari there who's saying, you know what, maybe we don't need to cut it all. Chris Wilder says, you know what, let's hang out at a higher rate for longer. And then Michelle Bowman, Lori Logan talking a lot about the potential upside risk to inflation. And there's Bostic, who on our air not too long ago, Scott, talked about the idea of 1 cut in the 4th quarter.
Oh, I mean, but how far we've come, though, right? If we are declaring that a hawk now, as part of the Fed, is a 1 or maybe none, that's a long way from where we were before. Because I think our greatest worry, and maybe it still is in the backdrop of, well, what if we have to do another hike? And I don't hear that entering into the debate at all, at least now.
Well, Bowman is the one person who talks regularly about the idea that if inflation does not behave, the Fed could reverse course. It has a low probability in our Fed surveys, but you're looking right now, Scott, at the Fed rate cut probabilities, and you know what 50% is. Well, in some places it's just a toss of a coin. So right now we're even money on the idea of cutting rates at all in June. July is slipping a little bit. And then if you look at the January 2025 Fed funds contract, which, as you know, is the measure of the market's gauge of how many cuts all year, and you'll see we're trading, you know, at 2.7, 2.6, 25 basis points cuts with the 0.6 there. So there's 471. Almost at the high. If you went back on this chart to September or October, that's when it was around 480, which is where they think the rate cuts will be. So that would be 50 or 60 basis points of cuts if we got that high. So, yeah, it's slipping away right now. I just want to add to what Anastasia was saying, 100% right looking at the CPI. But as you know, over the last several months, the PPI has become almost equally important to the CPI because what fills in and tells us about the PCE, the Fed's preferred inflation indicator. And you know what, Scott? You're out of excuses if you've been excusing the data for January and February. You don't have those excuses for March. So this is really, I don't know if you want to call it the rubber match or the telltale sign or the benchmark, whatever word you want to use. It's the one that matters.
That's why we've been calling this, and we did at the top of our program today. Yes, it's the make it or break it hour, but also what is likely to make it or break it week in some respects for this rally. You stay with me, Steve. Do you think, Anastasia, are we underestimating or not listening closely enough to the rising volume of the more hawkish members now on the Federal Reserve Board?
I think we should be paying close attention because one thing that really caught my attention last week was when Loretta Mester is really talking about the balance of risks and saying the risks are now such that it might be riskier to cut too soon versus to cut too late. So that's something we have to pay attention to. The other thing she said is that we really need to see more convincing evidence that disinflation is still the trend and that it has not flipped. So I think that does set up some risk going into Wednesday. You know, to Steve's point, we have been seeing an uptick in ISM prices paid, for example. And yes, we had this goods deflation, but are we now going to the next several months where we can have an uptick in goods inflation? So the Fed is going to pay attention to that. And, you know, my answer to that is I don't think it derails the whole disinflation story because goods represent about 12% of the CPI. Energy is about another 7%. But given the hawkish rhetoric from the Fed, I could see the markets being concerned about it.
The other thing, too, Steve, I would assume is that the Fed doesn't want to see rates back up too much and put it in a more difficult spot.
I think that's right. I want to just add one thing to what Anastasia was saying and what I had said earlier. I don't think that, I don't know, rogues list of Fed mugshots we put up there, I don't feel like these are ideological hawks. I feel like this is their read of the data. And I feel like if you go back and look at the history of these folks, they have been dovish when it came to cutting rates to zero. So I don't feel like we're dealing with, you remember before we'd had what felt like ideological hawks on the Fed.
Kashkari was as dovish as you would find anywhere in the world.
Excellent point. And I think this is just Neil's read of the data right now, his sense of where we are. I don't feel like in his core, he's a hawk who wants to keep rates higher than they need to be. And in answer to the question you had to Anastasia earlier about, do we need a cut? Well, yeah, if rates are higher than they need to be, then it would be nice and I think effective and useful to reduce them if indeed you're putting too much restraint on the economy. Look, if the economy wants to run and doing so would not be inflationary, then by all means, let's let it go.
I hear you. Love your insight as always, Steve. Thank you.
Thanks,
Steve
Scott.
Leisman, our senior economics correspondent. Let's bring in Jordan Jackson now of JP Morgan Asset Management into the conversation. It's good to see you as well. Welcome. I'm going to ask you the question that Pasquarello is asking people. When do higher rates begin to bite? What would your answer be to that?
I think when we start flirting with around 5%, that's when you'll start to see rates really begin to bite. But look, I've been arguing since the beginning of the year that we're probably going to see 4.5% on the U.S. 10-year before we get down to 4%. You know, as been talked about on the show already, June, July, pretty much a coin flip on where they go again. If the markets continue to skew towards 1 to 2 cuts and fully price in 2 cuts or 1.5 cuts, you'll probably see the 10-year hit 4.5%. That being said, so long as the narrative is still around cutting rates and not hiking rates, I think the market can continue to grind higher.
Okay, so Jordan, you got a day today when you got Chris Harvey over at Wells Fargo. He bumps his target on the S&P to 55.35. Now, in fairness, I mean, it was 46.25, so he had to move it up, but he also had the choice not to move it up that much. He did not do that. Adam Parker, frequent guest on this program, gives 3 reasons for the resilience of the rally, in which he says accommodative Fed, right? That's to your point. Gross margin expansion and earnings growth for several years. Remember, we're coming off of 3 consecutive periods of bad earnings. We expect the tide to turn this quarter.
That's exactly right. And when you look over, this has really been a micro market, right? The market is now caring about earnings. We've seen earnings be the driving component of stock price appreciation this year, not so much valuations. And then I think when you look underneath the hood, right, obviously last year, if you teased out the Mag 7 earnings growth, earnings were negative for the rest of the market. When you actually forecast out to the fourth quarter of this year, so fourth quarter 2024 over fourth quarter 2023, obviously, you know, comps are going to be a bit favorable, but the rest of the market is expecting about earnings growth of around 15% by the time you hit to the fourth quarter, whereas, again, the Mag 7, or let's call them the Fab 5, so to speak, are actually going to be converging down to that number. So I think this is an earnings, a backdrop in which earnings are playing catch-up, which is really important and, again, very, very supportive for stocks in this environment.
So Anastasia, earnings expectations have come in as time has gone on, right? We're 10% growth for this quarter. Now we're looking for 4 to 5. Are we going to be that good? And if we're just that good, is that okay?
Yeah, well, I think the bar has been reset lower, and I actually do like that going into the earnings season. You know, first of all, you're right. Several weeks ago, we were looking at 5% earnings growth expected for this quarter. Now, as you mentioned, it's closer to 3%. But the other thing that's really interesting is the number of negative pre-announcements going into the quarter is really above the 5 or 10-year average. So I like the fact that the bar has been reset. What I also like, to go back to the manufacturing story, is the reason I keep talking about it is because while it's only 20% of the GDP, it's 50% of earnings are tied to the goods and the manufacturing story. And so if we could have that uptick, if we can have the upwards earnings revisions, and we have sectors from industrials to materials to financials to energy begin to benefit from that.
Well, they have already. I mean, the broadening of the market was legit, which started in March. The question, Jordan, is does the broadening story continue, and is it believable even in a market of backed up rates?
I think it does. And the fact is, obviously, as we continue to move through the year, first quarter reporters, earnings reports are going to be important. Remember, markets are forward looking, right? So as we start to look ahead towards 2025, markets are still calling for about 11% EPS growth this year, but tagging on an additional 13% EPS growth for 2025. So as you start to get into the forward PE, next 12 months, 2025 earnings start to get more and more important. The fact that you're getting that broader breadth of positive earnings growth expectations feeding through into some of the 2025 numbers, that gives me support and confidence.
So let me ask you this now, Anastasia, because I've just gotten a note passed to me, or a section of a note from Marko Kolanovic, JP Morgan, okay? He's been broadly negative U.S. equities for as long as I can remember, okay? And I mean, tongue in cheek, but we're talking like at least a year, okay? So his new mention says that he sees opportunities in utilities, okay, and real estate. It's notable, it's not like broad bullishness, but it's notable considering he has urged people for a while to stay away from U.S. equities.
Well, I don't know.
Are we finally getting some inklings of opportunity in places that we may not realize, like utilities, okay? You say, well, yields are backed up. Why would I want utilities? Because you're going to go the yield. But if you think yields are going to come down, then utilities are maybe a place to be. And then real estate, quote, is of interest too.
That's right. Well, the call on utilities doesn't scream bullish to me necessarily, because I think for utilities to do well, one of the things that would need to happen is yields need to be materially lower. But as we're just talking about, higher economic growth and also potentially higher inflation sort of goes the other way. you may make a case when it comes to utilities is that the demand for energy, the demand for the build out of the electricity grid, and the demand for wind and solar, that actually can bode well for some of those utilities. And if you get that coupled with lower yields, that's a positive story. Look, on real estate, Scott, I actually talked about this on your show, the halftime report, about that being one of the top contrarian trades for this year. If we get to the point where the Fed does actually cut interest rates, I think real estate is one of the biggest beneficiary sectors. And by the way, we were talking about the concerns about CPI, maybe not having the rate cuts, but the Fed actually looks at core PCE, which we get later in the month. If we do get a print that's below 2.8%, is inching towards 2.5%, I still do think the Fed does cut rates. If they do, real estate is that contrarian trade that you would want to add to.
Jordan, lastly, you like utilities as well, along with energy, healthcare, and staples. Last point to you.
Sure. It's generally maintaining a bit more defensive posture within portfolios relative to a cyclical one. And obviously, all that we've talked about, inflation potentially remaining a bit sticky, the Fed staying a little bit higher for longer, right? Growth, while still strong, is taking a step down in the back half of the year. All that is supportive of a more defensive posture. Now, that's not to say we're not finding opportunities in the tech sector and parts of discretionary, but we think you've got to be very, very selective and really focus on quality within those more cyclically exposed. But yeah, I think leaning a little bit more defensive makes a whole lot of sense. And importantly, when you look at the earnings stability, right? Earnings expectations stability, you're seeing a lot more resilient earnings expectations amongst the defensive parts of the market relative to the cyclicals.
All right, I appreciate it very much, the conversation. We'll see you soon. Jordan, thank you. Anastasia, of course, our thanks to you as well for being here at Post 9. Let's send it over to Steve Kovac now for a look at the biggest names moving into the close. Steve.
Hey there, Scott. Yeah, let's start with TSMC. Shares up more than 1.5% today after securing up to $6.6 billion in financing from the U.S. government to make chips in this country. The money comes from the Chips and Science Act, of course, and so far, Intel has been awarded the most money from the act, up to $8.5 billion. Meantime, shares of video game publisher Take-Two Interactive, they're up 2% after Citi analysts upgraded the stock from neutral to buy. Much of the expected growth is coming from the next Grand Theft Auto game, which Take-Two announced would launch in 2025. The analysts here expect the new GTA to drive nearly $3 billion in bookings for Take-Two, Scott.
We'll see you in a little bit. Steve Kovac, thank you very much. We're just getting started here. Up next, billionaire investor Mark Lazary of Avenue Capital is back with us. He's going to break down the Fed's next move, where he is finding the best opportunities in the markets right now and beyond. We are live from the New York Stock Exchange. You're watching Closing Bell on CNBC. Learn all about it. And there it is. Let's show it to you. There it is. That's a live shot from NASA of the total solar eclipse. It's happening right here in New York. Over the next hour, the eclipse will continue cutting diagonally across North America before exiting over eastern Canada into the Atlantic. It is the first solar eclipse to be visible in the U.S. since 2017. Be the last until 2044. You get your glasses? You're not outside. Mark Lazarus here with us as we keep an eye on the markets and the eclipse. Treasury yields hitting their highest levels of the year. Investors are awaiting key inflation data. You're not into the eclipse?
No, not really.
You're not investing in the eclipse? You're investing in everything else?
Everything else is fine. The eclipse, I'm good with.
All right, so we're talking a lot about rates and rate cuts, right? And the calculus has obviously changed. What are your own expectations in terms of rate cuts? Do you think we're going to get any this year? How many and when?
Look, I think you're going to have it. You know, the question is it one or two? I think it's closer to one. Right now, the Fed's in no rush. The economy's doing well. You're seeing that as far as the Fed is concerned, things are fine. And until they start seeing that there's a problem, their biggest worry is still inflation. So there's no rush on them cutting rates.
How have you sort of dialed back your own expectations of, you know, let's say 6 months ago, what you thought was going to happen, right? The market has come a long way from pricing in 7 to 3, and now we have people like you and others saying 1 or, hey, maybe none. So how have you reset your own expectations over this period?
I think for us, we don't really invest based on what's happening on rate cuts. Like where rates are is actually great, just simply because we're lending money around 12 to 15%.
Still, with this direct lending is still
it's specialty lending. It's people who need money.
And it's still a critical part of your investing strategy.
Yeah, it's continued. It's actually going extremely strong in Europe because there's more issues. Less here in the United States, but Europe and Asia, people need capital.
It feels like it's more, that space I feel like has exploded almost more than any other.
It has.
There's so many players. Does that impact you at all? Is it more competitive?
It is more competitive. That part has changed. But you got to remember, the biggest competitor were banks, right? So that's who we were competing, and their cost of capital was far, far lower than ours. So now if I'm competing against an Ares or an Apollo or anybody else, their cost of capital is roughly the same as mine, maybe a little bit lower. So you're still able to compete, and there's quite a bit to do for all of us. For me, we're just trying to do smaller deals because you're not going to have as much competition.
Are there any concerns about too much of that activity? In preparation for you coming on, I saw an IMF blog, okay? It said private credit warranted a closer watch. They called it opaque with limited oversight and vulnerabilities. What would your response to that be?
Well, I think what ends up happening is regulators want to know everything, right? And I don't blame them, because the more they know, the more there's a belief they can protect the economy. Here, they don't know who we're lending money to, whereas they could go into a bank because the bank's regulated and they know where the banks lend at what rate. So I think that's what the fear is, or the concern, is that when there's a problem, there's going to be less that a regulator can do because they've got less control over the economy.
Is that a legitimate concern?
Honestly, at the end of the day, I don't think so. We're going to lend based on the fact that we think we're going to get our money back plus our interest, right? We're not doing anything stupid, and I don't think any of the other firms are.
I'm not thinking about you guys doing it. Of course, you're not doing anything stupid, but what if you're lending money to, firms who ultimately, if they won't be able to pay the money back if the economy turns south or if interest rates go much higher?
I hope so. Then we'll get control of those companies.
See, that's why you're always one step ahead, Lazary. You're always thinking about that. Do you think there's going to be more issues like that are advantageous for you?
I think there will be. I think as there is a lot of capital out there, there are issues with the economy. People say that the economy is doing great, and I think it is. But ultimately, at the end of the day, the cost of that capital has gone up for companies. So because of that, you're going to have more issues. The Fed's only going to lower rates when they see we're going in a recession, right? So
really, you think that?
Yeah,
you don't think that they'll just be able to do it because inflation's going to come closer to target, and we know they're going to cut before it gets there anyway?
Yeah, but if inflation is level, why would you lower rates? and the economy's doing strong, you're not going to lower rates unless there's an issue.
Well, you could lower rates so that
you're going to
people like Mark Lasry don't get to take advantage of all of these distressed opportunities that might be caused if they left rates too high for too long.
That's true, but the Fed is never early, right? They're always late, and that's going to be the problem. So I think for us and others, you're going to have all these opportunities.
What do you make of what Jamie Dimon had to say in his letter? It's been much talked about today, and in case you didn't see it, he said, markets seem to be pricing in a 70 to 80% chance of a soft landing. I believe the odds are a lot lower than that. What do you think?
Look, I don't like betting against Jamie. He sees a ton of data, right? He sees everything. He's lending money. I think Jamie's probably right, but at the end of the day, I'd love to have the information that he has, from the seat that he's at. We just, we don't see things as much or as well as he can, just simply because we're not lending to as many people. We don't have all the consumer information that he has from sort of all the credit card info. So Jamie's got a pretty good seat, and I think he's done a really good job over the last couple of years.
He said interest rates could soar to 8% or more in coming years, that they're prepared for a broad range of outcomes. Does that sound outlandish to you?
I think that's hard. I think the only way rates really move up is if inflation really, all of a sudden the Fed hasn't been able to get that in control, and you'd have to raise rates. But by doing that, you're talking about a real recession in this country. The biggest problem people have is, if you think about it, to buy a home, the cost of that has gone up.
A lot.
Yes, 100%. In the last years. That's why people don't feel the economy's doing that great. For you and I, the economy's great because it has the stock market's gone up. All the things we're doing have worked out. But if you're an average consumer, your cost of goods has gone up 25%, and your cost of housing has gone up 100%, and your cost of fuel has gone up 25-50%. Those are real things for the average American. That's why it's an issue, and that's why you've got this disconnect between people thinking the economy's doing well and people thinking, no, actually it's not doing well, and it's worse for me.
You think that's been hurting President Biden, whom I believe you're still supporting? Because, I mean, you hit on a good point. We can sit here and say that, well, inflation is come down from 9% to 2.7 or 3 or right. What have you. Prices haven't come down. So the rate of prices going up has slowed. The price of milk and eggs hasn't come down. So people are still going to the grocery store or wherever and still paying what they were paying before. So what, the rate of inflation, all right, so the prices have stopped going up as much as they were.
I think that's the disconnect. I think that's the problem. That's what's hurting Biden. Because ultimately, the only thing people care about is, do they have a place to live? That's gone up. The cost of that, you can't afford it. Cost of food has gone up, and the cost of heating has gone up. So that's not good. Yes, the stock market has gone up 20%, and that's great if you've got money to invest in the market. But if you don't and you're just making ends meet, you've got issues.
Are you going to be giving the president or the campaign any advice this go around?
I tell them what I tell you. It's.
You do. You're in dialogue with them?
You're in dialogue with the folks that are within the campaign.
You are now.
I am, but a lot of other people are. I think that's the issue that the campaign's got to deal with.
Let me ask you about another opportunity, a big one that I know you see, and that's through sports. We talked the last time you were here, and it's gotten a lot of press, this sports fund that I think you're continuing to raise, correct?
That's correct.
So you've invested in bull riding?
Yes.
Why that? I know about pickleball, which was public already. Right. We talked about that, but bull riding now.
Yeah, because what we're trying to do is find sports that people 3 or 5 years ago were not looking at, and today they are. So right now you've got the average NBA game is about $1.5 million. Do you know what an average bull riding on CBS Sports is? It's over 1 million Americans. So what we're looking for is sports that are growing and that there's opportunities to do. It's one of the reasons we invested in the PGA. It's things where we could invest that we think media rights are going to keep going up, but also that you've got more and more people who are interested and want to watch that.
Okay, so you're part of the strategic sports group.
Yes. That
made a big investment in the PGA. Where are we on the talks between PGA and LIV as you're now starting to get the Rory McIlroys of the world and other big names who are suggesting we need to figure this out quick because it's becoming an issue, it's becoming a distraction. Are we any closer to a resolution?
I think there's been talks going on. I think it's better than it was 3 months ago. I think they're moving forward. The question is, will they be able to cut a deal? Obviously, I hope they do. Just like I would say Tiger, Rory, or anybody who's involved wants to end up having a resolution of this because it's better for the game.
Can you speak to what what's the major sticking point at this point, and how involved are you in the actual conversations?
Shockingly, it's money. But I'm not involved really in the negotiations. And that's because that's going on directly, I think, with the folks at the PGA and LIV.
Okay. It's great to visit with you.
It's always good.
It's been a minute.
It's great to see you.
Yeah, good to have your insights as always. Mark Lasry, Avenue, joining us here on Post 9. Up next, Google's Cloud Conference is kicking off tomorrow. So what could this event reveal about the tech giant's AI strategy going forward? We will discuss that and what's at stake for that stock just after the break. Closing bells coming right back. Welcome back. Shares of Alphabet up 1.5%. There's the stock today, and that's ahead of its Google Cloud Conference tomorrow. Bank of America out with a note this morning saying that event could boost AI sentiment on the stock, and I suppose that's is much needed. Deirdre Bosa joins us now. So how important, Dee, is this event tomorrow? you know, with all the narrative where it's gone over the last, I don't know, seems like forever at this point, they need a boost.
It's like musical chairs, right? And that's why these events are so important, because it's a chance for each of the mega caps, whether that's Google, whether that's Microsoft, whether that's going to be Apple at WWDC, to really tell investors and developers and customers how they are going to give them an edge in generative AI. So Google's event, the stakes are really high. It has to have a really consistent, clear message, because when we think about the last 12 to 18 months, how Google has been talking about generative AI, it's kind of been all over the place, right? We started with Bard, we had Duet, now we finally have Gemini, and it feels like everything is going to fall under Gemini, but in the same way that Microsoft has used Copilot as the name for its family of AI, generative AI tools, Google's going to have to do the same thing with Gemini, and it has an advantage here because a lot of Google applications are cloud native, right? Like Workspace. So it can get a leg up once again, but it's going to have to do it in a way that is convincing, that is clear, that shows off sort of they're pioneering in this space, right? I keep coming back to that, Scott. Google was here before anyone else, yet somehow over the last 12 to 18 months, their position has been in question.
It has. It's so interesting because it's not as though, Dee, and you know this, of course, it's not as though the stock has so dramatically underperformed, let's say Microsoft, for example, even though the narrative would have you believe that this company's AI ambitions have been all but left for dead.
Yeah, and part of that is when you come out with sort of a new product, a new chatbot like a Gemini, and ChatGPT had these issues as well. There's going to be issues because users are going to go on and try and trip it up too. So Google most recently announced its Gemini, layers of generative AI chatbots, and they had a few stumbles, like its image generating product. They had to suspend it because it was going a little bit too politically correct. So they have a lot to make up for here. One of the things that investors should listen for are options, right? And you hear about these investments. Google and Amazon both have been pouring billions of dollars into an AI darling like an Anthropic, and that is in order to bring it into sort of their cloud platform and tell developers and customers that we have so many different tools, we have so many different foundational models. The choice is yours as you're building, and whatever your ambition is with generative AI, this cloud infrastructure, whether that be Microsoft or Google or Amazon, has the right tools. So part of that race is just access to all the different foundational models.
Yeah, no, your points are well taken. And of course, they've had some self-inflicted wounds, and very much so in this whole rollout process. We'll see how this goes tomorrow. Dee, thank you. Deirdre Bosa joining us there on Alphabet. Up next, we're tracking the biggest movers into the close. Steve Kovac is back with us for that. Steve.
Hey there, Scott. Yeah, we're going to tell you about one stock upgraded to buy after a big sell-off last week, and another rising on a futuristic transportation promise. We'll reveal those names when Closing Bell comes back after this.
All right, we're about 15 from the close. Back to Steve Kovac now for the stocks he's watching. Steve.
Hey, Scott. Yeah, well, let's look at Ulta Beauty. It's up 2% or so today, following an upgrade from buy to hold from the analysts over at Loop Capital. That follows last week's sell-off of the stock, which Loop's analyst says were, quote, overdone. They said sales comps for the company will improve this year, and there's a possibility of a cash dividend. Meantime, shares of Tesla, they're up nearly 5% today after CEO Elon Musk said he would reveal the company's robo-taxi at an event on August 8th. Tesla has not given a formal update on its robo-taxi plans since Musk promised a software update would enable 1 million Tesla robo-taxis next year. That was almost 5 years ago, Scott.
All right, Steve, I appreciate that. Steve Kovac coming up. GE Vernova popping in today's session. We're going to tell you what is sending that GE spinoff higher today and why there could be more upside ahead. Closing bells coming right back.
Now.
All right, coming up next, Bitcoin rallying again, up nearly 4%. touching 72,000 earlier today. There it is, just shy of that level. The question is, can the momentum continue, and how might it impact the rest of the crypto space? We will discuss that and more when we take you inside the market zone next. We're in the closing bell market zone now. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus Seema Modi on JP Morgan's bullish GE Vernova call. And Kate Rooney on Coinbase rallying as Bitcoin tops 72,000 today. Mike, turn to you first. Looks like we touched negative on the Dow. We've gone negative on the SPY as well.
We have, and we really are waiting and seeing. I mean, sometimes we say we're waiting and seeing. We genuinely are for the inflation numbers. Some things might have changed, sort of technical, maybe just the shadings of the characteristics of this rally last week with a little more of a pullback. With the idea, by the way, we haven't made a new high in a week and a half. That's the longest stretch since January when we first made it.
Oh, the nerve of this market.
Exactly. That's the point. It's kept to such high standards of just how relentless the rally has to be. That said, the fact that oil traded soft today and the volatility index down 0.75 point suggested to me we were somewhat tensed up for potential geopolitical escalation over the weekend. We didn't get it. Now it's just inflation. Fed's on a sole mandate right now, and that's what we have to worry about.
Yeah. I like Pasquarello. I mentioned a couple times today asking when do rates take a bite. I think every investor is thinking along the same lines, and I don't know if everybody's coming up with the same answer that it needs to get, the 10-year, for example, to 4.8. I think if you still get a little bit of a backup above 4.5, you're going to say,
you would at least have a reflex back away type of an instinct, I think, at that level. 4.8 is 1 full percentage point above the recent low. So I think if the velocity does matter, as everybody says. I also, though, think it's worth reminding people, in mid-2022, we thought 3 was the number. In late 2022, market couldn't handle 3.5. Last year, it was 4. So over time, if the economy hangs in there and shows it's not fully sensitive to it, and it's not blasting higher in yield like it was last fall, we're probably okay. But I do think we're testing right now the tolerance for slightly higher rates near 4.5.
Yeah, and maybe we needed it, too. Just a bit of a reality check. Seema Modi watching GE Vernova today. What do we know?
Well, Scott, since GE Vernova spun out of GE about a week ago, we've seen the stock fall by around 8%. That may be due to existing shareholders saying, hey, I want more exposure to aerospace versus the energy story. Either way, JP Morgan this morning saying this is a buying opportunity, upgrading the stock to overweight with a price target of $141, referencing the strength in GE Vernova's electrification business. They say this business can outperform as data center electricity demand increases. There's just more demand, Scott, for these companies that operate in managing the grid as power scarcity becomes an issue. So that seems to be what's driving this upgrade, and you're seeing shares up about 6%. The next big driver for the stock, analysts are saying, is going to be earnings on April 25th.
All right, we'll look forward to that. Seema, thank you very much. Seema Modi on GE Vernova. To Kate Rooney now on Coinbase. I guess we shouldn't be surprised that Coinbase is rallying if Bitcoin is.
Yeah, exactly, Scott. As goes Bitcoin, so goes Coinbase and the rest of those crypto stocks. But for Bitcoin in particular, the rally really started over the weekend. It picked up some steam during early trading in Asia. It topped $72,000 today. We have seen strong demand really since January when that group of Bitcoin ETFs launched. Analysts over at Glassnode estimate an average of $79 billion when it comes to inflows per month this year. There is also some investor excitement around something called the halving, which is coming up later in April. That cuts the newly created supply of Bitcoin in half. And among the risks out there, though, to Bitcoin, tax season might be one. Fundstrat points out a potential pullback if traders do need to cash out to pay Uncle Sam. Coinbase also higher on the back of Bitcoin. Barclays upping its price target on that name by nearly $30 today. Still underweight, though. And there has been some retail selling around Coinbase. According to Schwab's Trading Activity Index today, Coinbase was one of the most sold names by individuals in the last month. You got MicroStrategy as well, the largest corporate holder of Bitcoin, higher today too, Scott.
All right, appreciate that, Kate. Thank you. That's Kate Rooney. Back to Mike Santoli. You know, we haven't talked about earnings yet. We're obviously kicking off with the banks, but this season is going to be interesting given the number of sectors that have done really well to start the year. It's not just saying, hey, the bar's really high for tech. No, I mean, maybe the bar's really high for financials, up 11% on the year. Maybe it's really high for industrials, up 10% on the year, and energy up 16, and comm services up 18, and tech as well.
I do think especially for certain slices of industrials, which have really run and which are seen to be these now longer-term secular growth stories, the bar is higher. What I did find interesting, FactSet says, you know, analysts always trim their estimates over the course of a quarter. They've done so again. It's now under 4% expected, 3.5%, whatever it is. But they cut estimates less than is usual over the course of the 3 months. So that suggests that, you know, company guidance, it's all getting filtered in. And it seems like we really are about to hopefully see that inflection where the majority of sectors start to participate in earnings growth. That said, even with that happening, the outside the Mag 7, I think we're still talking flattish year-over-year earnings. So it's really the second half of this year when a lot of that has to kick in, and we'll see if guidance with this reporting season starts to shed any light on that.
I'm watching 5,200 even on the
Yeah, we're kind of sticking there for a little bit.
If we can close above that, looks like we'll stick there. Dow's going to go right to the flat line. I'll see you tomorrow into OT with Morgan.
Well, interest rates keep rising, taking a late-day toll on stocks. It was a choppy session. It looks like the Dow finishing just about flat. The S&P, a similar move, and the NASDAQ as well. That's the scorecard on Wall Street, but the action's just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off. It was a volatile session for the major averages. We closed well off the highs as investors do keep an close eye on the 10-year Treasury yield, which hits the highest level of the year. Coming up, the CEO of fixed income trading platform TradeWeb on whether he thinks rates will keep rising. Plus, Neuberger Berman President Joe Amato on where stocks are heading now and the biggest opportunities for investors right now. Let's break down today's market action, though, with our market panel. Joining us now is Keith Lerner from Truist and Nicole Inouye from HSBC. It's great to have you both here. This was literally a middling day for stocks. I mean, we were higher, we were lower, and we basically have finished the session flat here. Keith, is this the calm before the storm when we have inflation data, Fed minutes, and then earnings kicking off with the banks later this week?
Well, first, yeah, Morgan, great to be with you on this Eclipse day. I think a lot of people maybe were watching the Eclipse and they want to focus on the market. It's kind of boring, but I would say boring is good. I think you're right. There's a lot of catalysts coming up. But if we also think about where this market's come, right, we've had 5 straight months that we've been up. The first quarter was up, over 10%. So to me, just digesting and being boring is actually a good thing. And most of these studies that we look at, when we see this really strong momentum that we've seen over the last 5 months, when you look at 6 to 12 months later, the market tends to be up with a high probability. It's not unusual to digest those gains on a short-term basis. That's what I think we're doing. I think the underlying trends are still positive. I think bull market rules apply, meaning you stick with the underlying trend and you look at pullbacks as opportunities. And we're likely to see an increase in volatility as the week progresses, as you mentioned.
Okay. Nicole, how do you see this market, especially at a time where strategists have really been playing catch-up with their S&P targets, given the strong start to the year we had with Q1, despite the pullback we've seen in recent sessions?
Yeah, well, I agree. I think the underlying trends are still very positive for the S&P and for equities in the U.S. We're coming up to this first quarter earnings season. Expectations are very low. If you look at consensus, they're only expecting 4% EPS growth for the first quarter. So that's actually a deceleration from what we saw in the fourth quarter. And that really doesn't, combine with what we're seeing on the macro outlook. U.S. GDP continues to be very resilient. Labor markets are very strong. And I think we're having this perfect scenario where we're having strong labor markets, and actually you're not seeing that stoking in inflation pressures. Obviously, this inflation print on Wednesday will be a key focus. But we've always had the view that it's not important when the Fed cuts, but if the Fed cuts. So if we get an inflation print that's slightly higher and that pushes out rate expectations, it's not June, it's July, a little bit later, we think that's still okay for equities. What we'd be concerned on if we get a resurgence in inflation, and then the question comes down to not when, but if the Fed will cut, and we think we're still pretty far from that right now.
Okay, so just to dig a little deeper into that, Nicole, it sounds like cuts are still part of your base case here for the markets in 2024, but you're data dependent.
Yeah, I mean, we're data dependent. The Fed's data dependent. Everybody's data dependent. We still have 3 Fed cuts expected for 2024 and another 3 in 2025. Again, this will depend on where we see these inflation prints. I think the Fed has said that they expect the road for inflation to go down will be bumpy. So I think, if we get a few more bumps on the road, it's okay. It pushes out rate cuts, but it doesn't completely take out rate cuts. And I think that is the big difference for the equity markets. And that's why we continue to stay positive, even with the strong performance we've seen year to date.
Okay. Keith, what do you think matters more? What the Fed does in terms of cuts and what's priced into the market here, or at a time where we've seen multiple expansion, earnings actually catching up to what investors have been doing with stocks?
Yeah, well, our model most of this year has been we would prefer a stronger economy with less Fed cuts than more Fed cuts because the economy is weakening. Now, at this point, the market is, pricing in a little bit less than 3 rate cuts. We've been saying since last year, we thought it was 3. When the market was at 6 cuts, we saw it was, 3. Maybe it's 2 or 3. We still think it's more likely to happen. But I think the more important thing is if the economy stays strong. Because what you've seen is the GDP estimates, if you think about coming into this year, was around 1%. Now they're closer to 2%. And that's translating into forward earning estimates for this market that are at an all-time high. So I think the one thing, though, just to be cognizant, valuations are rich. It's hard to say what level matters from an equity valuation level. But, if the 10-year does start moving at a more volatile pace and moving up, I do think that will create some headwinds, at least shorter term for the market. So even above 450, I mean, we still think more likely the peak of 5% is a good high for this cycle. But if you start moving up there, I think there will be this tension between those better earnings because, which is actually helped by inflation versus the valuation cap, which will lead to some digestion. But overall, I think a solid economy is a good thing, not a bad thing.
Okay. Keith Lerner and Nicole Inouye, thank you for joining me.
Thank you.
Well, the S&P basically finishing at 5202, so just above that level and down fractionally. JP Morgan Chase Chairman and CEO Jamie Dimon, though, releasing his